Okay, so I think we are ready to start. Welcome to the conference and the workshop. I just here to say good morning, welcome, and maybe have a quick round around the table. If you just like state your name and institution, that will create a little bit of more of a climate of interaction that we have. What? Okay, so like, Francesca, do you want to start? So this way.
Okay. I'm Francesca Zucchi, and I'm at the European Central Bank.
Eleonora Granziera, Norges Bank, and the Euro Business Cycle Network.
I'm Maximilian Conrad. I'm with the Geneva Graduate Institute.
Rick van der Ploeg, Oxford.
Fabrizio Ferriani, Banca d'Italia.
Flavia Corneli, Banca d'Italia.
Florencia Iraudo, Federal Reserve Board.
Gauthier Vermondel from École Polytechnique.
Andrea Gazzani, Banca d'Italia.
Lorenzo Prosperi from Prometeia.
Michele Cimino from Prometeia as well.
Marusha Gislen, Swedish Central Bank and World Economic Forum.
Francesco Molteni, alumnus ITUI.
Celso Brunetti, Federal Reserve Board.
Hilde Bjørnland from Norwegian Business School and Norges Bank.
Olympia Carradori from the University of Zurich.
Sylvain Leduc from the San Francisco Fed.
I'm Guido Bongianni, PhD student in the Department of Economics here.
Eva Franzmeier, also PhD student here.
Koji Takashi from BIS and Banco Japan.
Okay, and I'm Giancarlo Corsetti here at the EUI. So we can just start. Eleonora, why don't you introduce?
Sure. Good morning to all of you, and a warm welcome to beautiful Fiesole and the European University Institute. It's a pleasure to see you here today for this conference on the macroeconomic and financial dimensions of the green transition. As I said before, my name is Eleonora Granziera, and I am the network coordinator for the Euro Area Business Cycle Network, which is one of the co-sponsors of this event. Stepping in for Barbara Rossi, who is one of the co-organizers of the conference and also the chair for the EABCN, which she unfortunately couldn't be here to deliver the welcoming remarks. So I'm a pure substitute. I apologize for that. For those of you who are not familiar with the EABCN, let me just say a few words about the network. The EABCN currently consists of 22 institutional members, mainly central banks and other European institutions. It's been founded in 2002, and since then, the network has been providing a forum for a better understanding of the business cycle in the euro area, and has linked academic and researchers in central banks and other policy institutions. So what do we do concretely? We have two main tasks. First, we support the Euro Area Business Cycle Dating Committee, which establishes the chronology of recessions and expansion of the euro area and provides biannual statements on the state of the euro area economic activity, which is similar to what the NBR Business Cycle Dating Committee does for the US economy. So if you want to have accurate dating for recession and expansions in the euro area, I recommend you to download the series from our website. And second, the network organizes several events every year, both conferences and training schools, either online or in person, on topic of interest for its institutional members. For example, a couple of weeks ago, we held a training school on empirical methods for business cycle analysis by Christian Wolff. And earlier in May, one on diff and diff estimators by Jeff Woolridge. Today, in parallel with us, the University of Mannheim is hosting a Euro Business Cycle Network conference on new challenges in monetary economics with the keynote speeches by Alvarez and Gorodnichenko. Now, these are just few examples of recent events, but if you're interested in knowing more about the network and stay informed about future activities, you're welcome to visit our newly developed website. And actually, we are launching our new website just this morning. So it's exciting to be announcing this here. And you can sign up for our newsletter. Now, going back to today's event, a conference on green transition was actually highly requested by our institutional members, reflecting the fact that climate change has become high priority in the policymakers' agenda. As central bankers, we do worry about three distinct shocks that can be expected to lead to a prolonged period of upside pressure on inflation while we build a more sustainable economy. Climateflation, that is the cost of climate change and extreme weather events itself. Fossilflation, which is the increase in brown energy prices and prices. And greenflation, which is the increase in general prices induced by the green transition. More broadly, climate-related and environmental risks warrant special attention by regulators because of their size, global dimension, systematic nature, and non-linearity. Extreme weather events cause extensive damage to the environment, adversely impact the macroeconomy, and give rise to significant financial risks, therefore posing additional challenges for central bankers. A conference like this one can help us improve our understanding and assessment of climate-related and environmental-related risks, and can help policymakers to design policies to put in place to counteract these risks. Now, for this conference, we have received about 120 excellent contributions, and it was difficult to narrow it down to just a few to be presented. We were very excited about the final program. And what I found extraordinary in particular is the fact that this is a truly interdisciplinary event that covers most aspects of the green transition, from policy evaluation, so monetary, fiscal, and regulation, to green finance, to energy transition, to implications for labor markets, and to the interaction between the green transition and technological change. We will have both theoretical and empirical contributions and get insights from micro-level data as well as macro time series data. We're going to start the day with a session on carbon policy with papers showing the theoretical and empirical macroeconomic and environmental effects of carbon taxes and emissions trading systems. After this keynote speech by Rick, we will have a session on the impact of the green transition on inflation and output and the implications for monetary and fiscal policies. After lunch, the topics will switch to understanding the role of technological advancements in reducing carbon emissions and to studying the longer-run effects of climate on local population, employment, and wages. And the conference will end with a session on international dimensions of the green transmission, featuring a paper that looks at the effects of energy transition for the real exchange rate of resource-rich economies, and one on the consequences of cap-and-trade programs on supply chains and production networks. In addition to these formal sessions, we will also be able to have a look at interesting posters during the lunch break. Then it only remains for me to wish you a good day and an enriching conference. And I guess we can start on time and proceed with the first session on carbon pricing. And I leave the floor to Francesca.
Francesca, Before giving the floor to Francesca, just about the rules of the game, we have 40 minutes for each presentation. So I would say we have 30 minutes for presentation, short clarification questions, and then 10 minutes for deeper and longer questions at the end. The floor is yours.
Okay, so thanks a lot for having me. It's a great pleasure to be here. So this is a joint work with Cecilia Bustamante at the University of Maryland. And I should start by saying that, given that I'm affiliated with the ECB, that these are our views. Okay, so I shouldn't hard to convince this audience that the importance of carbon pricing and the fact that climate is changing, but here we go. So in this chart, you can see that several countries around the world have adopted or are in the process of adopting carbon pricing mechanism. And the most prevalent carbon pricing mechanism around the world are two, are carbon taxes and ETS. So under a carbon tax, a central authority sets a predetermined price that emitters have to pay for a given volume of emission. Whereas under the ETS, firms have to buy or are assigned carbon credits, and firms with a shortage of credit have to go and buy them, whereas firms that have an abundance of credits can sell them to other firms. So irrespective of the carbon pricing system, so being a carbon tax or an emission trading system, one unifying feature of carbon pricing is that it imposes additional costs on firms. So firms have this additional dimension of maximization, which is the management of carbon credits, or how to minimize the burden of a Pigouvian carbon tax. So in this new world that we live in which firms have to take into account this additional dimension, there's a big question to be asked, which is what are the actual incentives posed by carbon pricing on firms when we realize and we acknowledge that firms have several margins to adjust in order to reduce their carbon tax liability or their need to go and buy carbon credits. And so in this new world we live in, firms then have to develop a carbon emission management. And our point is that this carbon emission management encompasses many tools. So this is the motivation of this paper. So we want to embed firms into emission trading system or carbon tax system and understand the trade-off that are governed by the different regulatory environment. And we want to build a dynamic model where we allow firms to adjust several margins in response to carbon regulation and what's the optimal mix of these different instruments that firms have to can adopt. So first of all, the obvious one is production. Of course, a firm can reduce its carbon emission by cutting production, but obviously this is not the long-term solution, right? Because it also reduces the size and the profits of the firm. So then firms can tap green investment. And a key aspect that we want to emphasize in this work is that green investment is really of different types. And to simplify things, really, we can think of two polar extremes. So on the one hand, you can think of abatement, which is simply offsetting carbon emission. So you don't change your core technology, your production technology at all, but you just pay to offset what you are emitting. Of course, this has an immediate effect because, in fact, it reduces the need to go and buy carbon credit or it reduces the carbon tax liability. However, it has a short-lived effect, right? Because it's not changing the production technology of the firm. And so it means that the firm will have to continue offset what it produces in terms of carbon emission. So at the opposite extreme, you can think of green innovation. And green innovation, you can think of the big ideas that can change the world and therefore can lead us to a decarbonized world and sustainable production process. Of course, like the upside of green innovation is that it really is the solution because it has a long-term effect if it's successful. At the same time, however, it's hard to incentivize firms to do that because it's costlier. It's definitely more costly than all the other of abatement. It has a long gestation period, so the firm will have to invest for a number of years without knowing eventually if the outcome is successful, because also the failure rate can be a drag on green innovation. And an additional policy that firms can adopt under ETS is the optimal management and trading of carbon credits. And after having really zoomed into the firm-level decision and policy, we analyzed the implication for carbon regulation of the firm behavior. And we think of carbon pricing, so both that I described so far, and as well as the role for subsidies to green innovation. So let me give you a preview of the main result. So first of all, we show that carbon pricing leads firms to reduce emission, meaning that carbon pricing systems are doing what they are supposed to do. And this happens because the firms both reduce the scale of production as well as they engage in green investment. However, another key message of the paper is that carbon pricing also affect the green investment mix. In particular, as it becomes costlier to comply because the carbon prices increase over time, firms have incentive to invest more in abatement and less on green innovation. Why? The reason is that abatement can immediately and effectively reduce the carbon tax liability or the need to buy carbon credits, whereas green innovation has a delayed and an uncertain outcome. However, our analysis suggests that if regulators adopt a carrot and stick approach and therefore they couple carbon pricing with green innovation subsidies, then this shift is at least partly offset, depending, of course, on the size of the subsidy, and this can actually lead to more green innovation. A second set of results of the paper pertains specifically to the ETS. In particular, we show that firms that have a large balance of carbon credit actually have less commitment to reducing their emission. And this is associated to the inventory management that underlies the ETS system. In particular, the cost associated with buying carbon credits make the firm behave in a precautionary way, in the sense that when the firm has a small balance of carbon credits, meaning that it's depleting its availability of credits, then firms have incentive to decrease production and increase green investment. And therefore, this leads to lower emission. So, and the opposite is true when firms have a high balance of carbon credits. So this, in a way, suggests that the allocation of free carbon credits should be really weighted to avoid this kind of behavior. So the last set of results in the paper is that carbon pricing and innovation subsidies target distinct objectives. So when we nest the firm problem into the general equilibrium setting, what we find is that carbon pricing should really be meant to guarantee that firms take action today to already start reducing their emission. But on the other hand, subsidies need to step in to really ensure a timely transition to greener technology. So in a way, they complement each other because they target different objectives. So let me jump into the model. So we consider a firm that generates a stochastic flow of carbon emission. So as you can see from the equation, here, Y is production, and so is the firm production rate, which is chosen endogenously and optimally by the firm, and it implies that the more the firm produces, the more the gross emission of the firm, up to a factor nu here, which can be thought as industry specific. So in a way, if a firm belongs to the steel industry, will be always more polluting than a service firm. And this parameter captured this idea that there's heterogeneity in the cross-section. The other two terms are the effects of green investment on the firm gross emission, and therefore together they form the expected net emission of the firm. In particular, the first term, so G here, denotes the greenness of the firm or the degree of sustainability of the firm. So the higher it is, the lower the net emission of the firm. And this G jumps up lumpily every time the firm attains a green technological breakthrough. So the last term, S here, is instead the effect of abatement, which immediately leads to a reduction in the emission. So the firm chooses, as I mentioned in introduction, production and green investment. In particular, production on the one hand increases the firm emission, obviously, but also boosts revenues. And we assume that the firm faces pro-ESG preferences in the sense that the greater the greenness of the firm, the more the demand for its products. And this is introduced in a model to capture the idea that even absent carbon pricing, firms will eventually come to senses that they have to do something about the environment. So let me describe green investment. So green investment is divided into green innovation and abatement, and we denote by green innovation by Z. And we capture the idea that as an uncertain outcome, by following the modeling of innovation in the macro and growth literature, namely, we assume that the firm spends a quadratic cost, which is a function of Z, which is the firm's green innovation intensity. And the higher this cost, because Z is higher, the higher is the probability of attaining a technological breakthrough. And the idea is, in fact, that this breakthrough arises at a Poisson rate, phi Z. And upon a green breakthrough, G increases by a factor lambda. So going back to the dynamics of expected net emission, here you can see that Z doesn't show up, which captures, in fact, the idea that if I spend in green innovation today, I'm not going to get anything more likely because I have to wait until a breakthrough materializes, and so G goes up. And so this becomes higher, and this pushes my emission down. So on top of green innovation, we have abatement, which is denoted by S. And here you can see that in turn, S shows up in the dynamics of the expected net emission, meaning that if I spend S today, I'm going to get an immediate reduction in emission, but I have to invest again tomorrow to get the same reduction in emission. So in that sense, the impact of abatement is transient because I'm not building any sort of stock of sustainability or a stock of greenness as green innovation instead helps us. Okay, so next let me go to describing the carbon pricing system. So we consider both to make a comparison and derive differences among the two. So under the carbon tax system, the firm simply has to pay a tax kappa on its positive emission, and obviously this carbon tax drains the firm profit. Under the ETS, the modeling is a bit more complicated because we have to keep track of the stock of carbon credits, and carbon credits evolve over time because of emission. So the higher the emission of the firm, the lower the stock of credit, so it depletes the stock of credit. However, firms can go and buy credit or sell them if they have an excess of credit. And we assume that there's some sort of beta spread between the price at which the firm buys and sells credit, which is consistent with the current status of ETS market, where typically like firms go to an intermediary and the intermediary takes a cut on his role. Okay, and firm value obviously becomes a function of sustainability. So let me keep track of time. Okay, so first we start looking at the model solution in the carbon tax system. As I mentioned earlier, the firm maximizes value by choosing production abatement and green innovation. And here you can see that the firm is a value of sustainability, and this equation is telling us that is the valuation equation of the firm, and it is telling us that the return required by the investor is equal to the expected change in firm value on each time interval, which is given by operating profits, by the carbon tax, and it's also affected by innovation breakthrough, in which case the G goes up by this lumpy amount lambda. So to solve, we conjecture that firm value scales with sustainability, and we are looking at scale quantity. And let me give you the first set of results of the paper that look at the comparison between the carbon tax and the laissez-faire benchmark, which is simply the case in which there's no carbon pricing. So what we show is that under the carbon tax, the firm produces less compared to laissez-faire, and the more so the size of the carbon tax, because obviously the carbon tax imposes additional cost on the firm. At the same time, the firm invests more in abatement, and more so the greater the carbon tax. Whereas it does not when under laissez-faire, obviously, because there's no need to abate emission, because there's no cost of carbon emission, so there's no point in investing in abatement. And lastly, we show that the firm invests less in innovation compared to laissez-faire if it exhibits positive emissions. So if the firm is polluting, then the carbon tax will weigh on the firm, and this reduces the incentive to invest in green innovation. So let me actually rephrase what I just said into like plain English and takeaways. So compared to laissez-faire, what we show is that firms facing a carbon tax exhibit lower emission because, in fact, they reduce production and invest in green, green investment, which is good, which is really what the carbon pricing system are supposed to do. But at the same time, we show that there's a tilt in the investment mix of the firm, in which such that the firm is more inclined to invest in abatement and away from green innovation. So, in other words, the carbon tax really makes the firm less polluting already in the short term because the firm wants to reduce the carbon emission. However, somehow the firm will be slower in transitioning to greener technology because when it has to decide the green investment mix, it may give a greater focus on paying less taxes today, but this means that it will invest more in abatement. Okay, so let me now move to the ETS. So under the ETS, firm value is a function of both greenness and carbon credits. So here, the solution is a bit more convoluted because, as I mentioned earlier, we have to keep track of the stock of carbon credits. And if you are familiar with the literature, the problem solution is like the inventory model in which an agent has a stock of cash and has to manage this stock of cash optimally. So in other words, the firm has to buy carbon credits at a cost gamma when it depletes its stock of credits, because otherwise it incurs a penalty. And so this means that when the stock of carbon credit is depleted, the marginal value of carbon credits, which is captured by the first derivative of firm value, is equal to gamma, so is equal to the cost at which the firm buys the credit. At the same time, we identify an endogenous boundary C star at which the firm is willing to start selling credits to other firms. And so at that point, the marginal value of credits is equal to the gain from selling them. And this boundary C star is set optimally, and it's indeed an endogenous choice. So let me spare the detail, but the idea is that from 0 to C star, the firm has to choose its optimal production abatement and green innovation policy, as in the carbon tax, whereas like the adjustment of carbon credits happens at 0 and at C star. Okay, so here again is a comparison of the ETS and the laissez-faire benchmark. In particular, the results are basically similar to those that we find in the carbon tax. In particular, the expression for all the endogenous quantity, for instance, starting from production, are a bit more convoluted because they involve the first derivative and the concavity of the value function. But the idea here is that, as you remember from the previous slide, V prime is tightly linked and varies between the value at which the firm buys and sells credit, and so it's tightly linked to the price of carbon. And if you remember the equation from the carbon tax system, here we had kappa, which is the carbon price in the carbon tax system, and here we have V prime, which shadows really the price of carbon under the ETS. So the equations are pretty analogous, and the takeaways as well. So in particular, we find that the firm underproduces under laissez-faire, and more so the higher the price of carbon. It invests more in abatement, and more so the highest the price of carbon. And it invests less in green innovation if it has positive emission, precisely as before. So again, we said in plain English, we find that net emission, in fact, are lower than under laissez-faire, but the firm favors, in a way, abatement, because abatement helps the firm pay less for carbon pricing. Okay, so under the ETS scheme, we also have an additional set of results that relate optimal policy to the stock of carbon credit. And as I mentioned earlier, we find that firms have a precautionary behavior with respect to the stock of carbon credits, in the sense that when carbon credits are lower, the firm produces less and abates more and invests more in green innovation. So as a result, the expected net emission here increase with the stock of carbon credits, which in other words means that firms that have a large carbon credits are less committed to reduce their emission. And actually this is consistent with a paper by a colleague of mine at the ECB and his co-author, that in fact shows that when there are increase in the price of carbon in the ETS system, firms have more incentive to engage, and the free allocation of carbon credit is not doing good to firms' incentive to commit. Okay, so here is more about the results, but more from a quantitative perspective. So here we simply show that firms dynamically, in fact, adjust their net emission. And one interesting feature is that firms that have larger emissions, so are in this part over here, for instance, for the ETS, for the carbon trading system, are less engaged to invest in green innovation, which is consistent with a recent paper by Bolton, Kasperczyk, and Biedermann. And also an interesting feature here is that when firms reduce their stock of carbon credit, their innovation share, so the weight that innovation has over the overall green investment mix, reduces because firms give more emphasis to abatement. So here is more about the role of carbon price. So it looks at comparative statics with respect to kappa in the carbon tax system and gamma in the ETS system, which are the analogous. And what you can see here is that as the carbon price increases, the firm engage more in abatement and less so in green innovation. And this again, like I'm repeating myself maybe, but this implies that the firm will have lower emission in the short run, but it will face a slower transition to greener technology. So now the question is whether there are policy tools that can partly undo this or fully undo this effect. And so we assume that the regulator can complement carbon pricing with a subsidy to innovation. And basically, the innovation subsidy simply reduces the cost of innovation that is faced by the firm. And so, in fact, with the subsidy, the optimal green innovation policy goes up. And looking at chart, obviously, the greater the subsidy, the more the firm invests in green innovation, and the greater the weight that green innovation has over the overall green investment mix. And this doesn't go to the detriment of abatement, because the firm will continue to invest in abatement, but it will simply invest also more into green innovation, and so total green investment goes up. So now the question is, what are the takeaways of endogenous carbon regulation, and how should, in fact, regulators think about the way firms react to regulation, and then how they can think of design. So to do this, we nest the specific and granular firm-level analysis into a general equilibrium setting. In particular, we allow a regulator to optimally choose carbon regulation given a social cost of carbon per unit of emission. And we consider two different scenarios, so when carbon pricing is the only tool available, and when carbon pricing can be complemented by innovation subsidy. So we consider that there's a final good serving as a numeraire of the economy, which is produced competitively by using labor and an intermediate of inputs, which are produced by polluting firms, which are precisely the firm we analyzed so far. So you can think of the final consumption sector as being produced by labor and dirty inputs, and the firms that we analyzed so far are those producing these dirty inputs that serve in the production of the final good. So then the final goods sector faces a cost of inputs and of labor, and also bears a convex cost that is greater the less sustainable an input is, to capture the idea that it becomes increasingly costly to produce in a polluting way. And in fact, this assumption is what delivers the pro-ESG demand for each input that I showed you at the beginning with the assumption. So we consider a representative agent for simplicity with log preferences, and whose consumption is given by wages coming from the final goods sector, by dividends coming from the polluting firm, is drained by the social cost of carbon emissions. So these are the net emission aggregated over the continuum of inputs. And this is the social cost of carbon. And consumption is affected by government transfer, which can be positive in case of carbon tax, and negative when the government gives away subsidies. And in this setting, we calculate the greening rate of the economy, which simply aggregates the greenness of the different sectors, of the different intermediate input sector. And so G represents the pace of transition at the level of the economy. So let me show you the results. So the model shows, not surprisingly, that carbon pricing and subsidies both increase with the social cost of carbon. So here, actually, let me explain. So the magenta solid line is the case in which the regulator employs both carbon pricing and the subsidy. And the dashed line is the case in which the regulator employs only carbon pricing, so no subsidy, and the black line is laissez-faire. So what's key here is that the greenness, so the transition rate of the economy to greenness is lower absent the subsidy, but the introduction of the subsidy actually increases by a lot. The reason is, in fact, when we zoom in at the firm level, and so we investigate the optimal decision, even in the presence of endogenous carbon regulation, you can see that a firm will invest less in green innovation than under laissez-faire in the absence of the subsidy, but it can increase much more if the regulator decides to complement the carbon pricing with the subsidy. Okay.
What are the dimensions on the axis?
On the axis is the social cost of carbon.
Is it euros per ton of CO2?
Is per ton of emission, yes.
0.42 is very low.
It's
So what is it? It just seems a very strange number.
No, but I mean, it's all actually, because all the results are really more qualitative than quantitative. So it's not a quantitative model. So it's a calibration that makes sense. Yes. So, so the implication of the model are therefore that a larger carbon price leads firms to shift from green innovation to abatement. However, the innovation subsidy helps undo this shift. So complementing carbon pricing with a subsidy to green innovation lowers emission and at the same time stimulates a faster greening path. So carbon pricing guarantees lower emission already in the short term, but innovation subsidy fosters a faster greening path. So therefore, it's important to note that with the subsidy, carbon price can be set at a higher level compared to the case with no subsidy. And so it really helps attain not only the goal of reducing emission in the short term, but also foster a transition to a faster transition to a decarbonized economy by using greener technologies. So let me conclude. So simply the model formalizes the trade-off under different regulatory environments. And so we think about what's the optimal mix between carbon pricing and subsidies to innovation, and how carbon pricing affect the firm green investment mix. And we try to think about how this affects the design of carbon regulation. And we find a complementary role of carbon pricing and subsidies as opposed to being substitute. Thanks a lot.
Thank you, Francesca. So we have plenty of time for questions from the audience.
I think it's a very welcome piece of research, so thank you very much. So the idea that when you only do carbon taxes like a second best policy, but not the subsidies, that the distortions you show make a lot of sense. So you get too much emissions and not enough green innovation. So you wonder in these dynamic models how much commitment matters. So there are a number of papers by Bart Harstad and people like that, and then you say, well, look, and also by Tim Besley, it really matters a lot whether you can commit the hands of future regulators, future governments, which you can't cost commit. So is this all with commitment, or is it without political commitment, or is it?
This is obviously a great point. So it's been shown by many fine pieces of work that the lack of commitment or commitment actually have a role. So here, obviously, we are taking the simplified approach that there is commitment. Then obviously you may have to think about how lack of commitment would affect the results. That is a very interesting point, because one direction we have been thinking of taking the model is to understand, in fact, how uncertainty about the price of carbon and can affect the result. So obviously you can think of it both for the carbon tax and the ETS, but perhaps it's even more relevant for the ETS, in which the price can fluctuate more widely over time. So this is something that we are thinking in a separate.
The idea is that you would also invest in green and brown capital stocks, in a sense, which are difficult to adjust.
Yes.
And then if you have no commitment, you might overinvest in green stuff.
Yes.
To tie the hands of if a guy like Trump comes in later, then he's stuck with it.
Yes.
So anyway.
Yes, I mean, these are very obviously important questions. We just take the snapshot of abstracting from this dimension, but it's something that we are taking on board in future work.
Thank you for a very interesting presentation. I'm interested if you've done some additional thinking about how the subsidies would look like. First of all, the size of them, whether they would basically just offset the cost, or if you've done some thinking there, how much it would be needed to actually spur positive in sort of growth or to enhance the ability to innovate. And then the second one, if you've been thinking about how to target those subsidies appropriately. I realize that's a little bit outside of your scope, but on the application.
Yes.
Yeah.
I didn't hear everything, but because there was a bit of echo. But so subsidy, yes. So the way we model them is simply by assuming that it's kind of a help that the central authority hands out to firms, but is really targeted towards innovation. So it's not like just a cash flow that is given away and the firm can use it however it wants. Because of course there are misreporting issue, misuse issue. So I guess if we have to think about the design, I mean, it's very important that these are like targeted the firms that have like some programs in place to invest in green R&D. So it should really I mean, the way we think about it and the way we find it works is as a way that like the central authority covers a percentage of what you are supposed to be investing. Second question?
How you would be, first of all, the size. So I understand that the size is, you haven't really been considering how much of the subsidy is required to make it a positive impact, net impact. And the other thing would be, I think you answered that already, how you would be targeting it. So I assume that because in the slides you also said that there would be sort of an emissions-based criteria for the subsidy. But if you, I think maybe the size is
yes. So, I mean, as I replied already, I mean, this is a qualitative model, so we are not embarking into an estimation of anything. So it's really purely a theoretical contribution in which we try to show some comparative statics in a way. So, but like this is probably an important point, because if the subsidy is too low, obviously it won't undo the shift to abatement away from green innovation. So in a way, if the goal is really, it depends on what the goal is, because in a way, if the goal is really to reduce emission today and at the cost of having lower transition, then you should like put more emphasis on the carbon pricing and less on the green subsidies. However, in a world in which we think that the only way of really like meet or being close to meet climate target, then you should adopt both. And an interesting result that we have, that I didn't mention for a lack of time, is that when you introduce the subsidy, you can also afford to have a greater carbon price, because, which perhaps is in contrast with some previous work. And the idea is that when you give the subsidy, then like this this decreasing effect and this depressing effect on the green investment mix is relieved, and so you can afford to charge a higher carbon price and then also attain lower emission today. But yeah, thanks.
I don't know whether we have more time. Is there a spatial aspect, like space? Because people may have, I guess this is for the next paper, to see whether there is any issue, even without going into cooperation or non-cooperation, whether the allocation of firms and production might be affected by this.
So cooperation among countries, across countries?
Within a country, and then of course there is a bigger issue across countries. Whether you thought about any spatial implications.
But
the geography of reallocation of firms and production.
Yes, I think that is an interesting aspect, of course, because in fact, I mean, when I describe as we consider all the different margins that firms can adopt to comply, there's actually the last remaining one that will maybe be addressed in a future work, that of course firms can engage in regulatory arbitrage and just move production away. So for the moment we just, but for that I think that you really have a multi-country model, and but obviously yes, it's and actually this goes back also to the coordination, to the commitment issue that Rick raised earlier. So it's an exciting research agenda. Thanks a lot for the comments.
Can you take another one? Just a final one. I was wondering about the timing of policy in your model. So would you have more investment if the government signals a decrease in future carbon credit, given that it takes time for investment to build up? So I was just wondering if you would get exactly more investment in this case.
So the idea is that, if anything, you want to start with low carbon pricing and higher subsidy, so that firms start building their greenness and their green capital. And then once you get that started, it keeps going, and then you can reduce it, basically. So it's in a way it's better if you start with a low carbon price and you increase it over time, because
but that would do that, right? Because if you signal in the future that a carbon price is going to be higher because you're lowering credits in the future, you would tilt it exactly the way you're saying.
Yes.
But you may not have to subsidize.
Exactly. Yes. You have to decrease. You can decrease them over time.
But in the future.
Yes. 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 Thanks a lot.
Would you pass it?
And if I may say, today the acoustic of this room is not very sympathetic with us. Can you talk close to the microphone? I can see it would be an improvement.
Like this? Yeah, just let me know if it's if I'm too close or too far. Okay, so thanks a lot for having our paper on the program. It's joint work with Diego Kancik, trying to understand how climate policy in Europe affects both emissions but also the economy. This is a great part of the program, like following Francesca, because it spares me some time on the introduction. Climate change is obviously at the top of the global policy agenda. More and more countries are thinking about or actively implementing carbon pricing as part of their toolkit to mitigate the effects of climate change. Francesca did a great job of highlighting that there's carbon taxes as well as cap and trade systems, so I don't have to go into detail on that. Let me just say that we still know very little about how these policies work in practice. So are they actually effective at reducing emissions? Are there short-term economic costs associated with them? And how do different types of policies compare, which is the main question that we're trying to answer. We're going to provide a comprehensive analysis of carbon pricing policies in Europe. We focus on Europe because it can be considered the global leader in climate policy with more than 20 years of experience. There's the EU-wide emissions trading system that has been around since 2008. In addition, many countries have also started to price carbon through national carbon taxes. Those have been around since the early 90s in some Scandinavian countries. What this implies from an econometric point of view is that there's actually sufficient variation to identify these effects that we're interested in. Where the key challenge that we're trying to address is that carbon prices are, of course, not set in a vacuum. What our paper tries to do is to provide a unified framework to study the impact of both cap and trade prices in the EU ETS, as well as national carbon taxes, where we combine a high-frequency approach that has been suggested in the literature with a control-based one. And I'll be more specific about that later on. As a brief preview of our results, we find that carbon pricing actually leads to a reduction in emissions, but it can also come at economic costs, by which I mean an increase in inflation, a decline in output, and more unemployment. These economic effects turn out to be larger for the EU ETS compared to the national carbon taxes, which is robust to the identification strategy used and also in line with some of the previous evidence that has been out there. We then try to basically understand why we find these differential effects between the two types of policies, where we focus on revenue recycling, so what happens with the revenues that these different kinds of climate policies actually bring in. We also look at differences across the policies in terms of the coverage as well as differences in pass-through, because different kinds of firms are priced through these different mechanisms. We also look at spillover effects and leakage, as well as the response of monetary policy to some of these policies. In this instance, we find that the use of carbon revenues in particular turns out to be crucial for understanding the economic effects, where carbon taxes are often introduced as part of broader tax reforms that then lower income taxes and cushion some of the effects on households. Conversely, the EU ETS has no direct measures that cushion the effects on households. And in our analysis, we basically try to test that channel by looking at the effects of carbon taxes in countries that recycle and don't recycle tax revenues, and we find that those that don't recycle tax revenues actually see more adverse economic effects as well. We also provide evidence that pass-through as well as coverage is important. The energy sector in particular, which is one that has been shown to have very high pass-through, is covered by the EU ETS, but excluded from the national carbon taxes. Consistent with that, we find that energy consumer as well as producer prices increase markedly following an increase in the EU ETS price, but we only see muted price effects for an equivalent increase in the national carbon taxes that we look at. Lastly, we also show that the national carbon taxes that we look at have only very limited effects at the EU level. So while they reduce national emissions at the EU level, some of that seems to balance out, which is consistent with the idea of carbon leakage that Giancarlo mentioned earlier, that as you tax emissions in one country, production might migrate to other countries inside Europe that do not have a similar carbon tax in place, so that would be consistent with leakage. One policy implication of our work is that while both policies can be effective at reducing emissions and climate policy in general can be very effective, it might be important to complement carbon pricing with other policies that address both the economic impacts but also prevent leakage. The last part of the paper that I'm not sure I'll have time to go into detail on today looks at the regional impacts of the common European carbon market, where the idea is that while all countries face the same carbon price, they might be differentially exposed to these carbon price changes. In particular, we highlight that the share of free allowances that they receive through the EU ETS relative to the total emissions that the country produces, as well as the concentration in the national electricity markets, which ties back to the idea of pass-through, are very important for understanding the country-level effects of the European carbon market. This implies that the southern European countries in particular, which tend to receive few allowances for free relative to the emissions that they produce and have fairly concentrated electricity markets, tend to be the ones that are most adversely affected by higher ETS prices. Let me just spend a very short moment on the related literature. Obviously, we're not the first ones to ask the question of how climate policies affect both emissions as well as the economy. The main contribution of our work I would summarize as formally comparing the two policies in a unified empirical framework, and then shedding light on the potential determinants of why the two policies might differ in terms of the economic impacts. Okay, let me start by reiterating the identification challenge. Carbon prices are endogenous for at least two reasons. The first is simultaneity, that in a weaker economy, the government could be induced to reduce the carbon price. We saw some of that happening during COVID as well. The second issue is that there might be shocks that simultaneously affect both the carbon price as well as the economic variables that we're interested in. We're going to address that by relying on two approaches that have been put forth in the literature. The first is a high-frequency approach that I'll talk about now, and the second is a control-based approach where the idea is to control for sufficient economic variables on the right-hand side of our regressions, such that the leftover variation in carbon prices is plausibly exogenous. Okay, so the high-frequency approach, the idea is to collect a set of relevant events in this carbon market and then look at the response of high-frequency carbon prices in a narrow window around these policy events. This is what my co-author Diego has done in his job market paper. The resulting series of carbon policy surprises then looks something like this. So it spikes at sort of the points in time where major events happen. There's some positive and some negative surprises. The downside to this approach is that we can only do it for the cap and trade, where we actually have these high-frequency carbon prices, as opposed to the national carbon taxes that are only adjusted once a year or so. With these carbon policy surprises in hand, the challenge is still that even though we have them, they might be weaker instrument when we then actually combine them with the annual frequency data that we use for our empirical analysis. So this is somewhat following the monetary policy literature that is still, most of what Diego does in his work is you can use these carbon policy surprises in a monthly VAR model for the European economy to essentially extract a carbon policy shock. That's then at the monthly frequency. You obtain that from basically inverting the VAR. And for our purpose, we then aggregate that monthly series of carbon policy shock to the annual frequency, which matches the frequency in our data. And then we use the carbon policy shocks in turn as an instrument for the ETS price in a local projection instrumental variables approach, where reassuringly these carbon policy shocks turn out to be strong instruments for our specification. And yeah, this is just a glance at what this carbon policy shock series looks like. There's some positive, some negative surprises, shocks, and I don't think we need to spend much time on this. The main approach that we use for this paper is what we call the control-based approach, following a paper by Metcalf and Stock. The idea is to control, like I said, for enough economic and financial variables on the right-hand side of our regression, such that the leftover variation is plausibly exogenous. For this, it's useful to think of something like a carbon tax as having essentially two components, one that can be predicted by these historical economic variables, and one that can't, which is, for instance, driven by changes in political preferences for more ambitious climate policy or international climate policy pressure. And it's this latter source of variation that we essentially use to identify the effects that we're interested in. The main advantage of this control-based approach is that it's quite flexible, so we can use both the ETS price but also the carbon tax rate in this local projections model, where we recursively regress the change in the H over an H-year period in the left-hand side variable on a this doesn't work, but on a country fixed effect on the particular ETS or carbon tax variable that we're interested in. We include the lags of the left-hand side variable, and we have control vectors both at the country and European level. A bit more details, so the main dependent variables that we're going to be looking at are various price indices, carbon emissions, output, unemployment, these types of things. The country-specific controls are the standard price indices, GDP, unemployment, some interest rates, as well as the other policies. So when we want to estimate the effect of the carbon tax, we want to control for the EU ETS price. At the EU level, we also include a measure of economic activity, a stock price index, an oil price index. In some instances where we look at the effects of national carbon taxes, we can also just add a time-fixed effect that would absorb some of these variables. We've tried different robustness checks with a broader set of controls. The results turn out to be quite consistent. One thing that we do throughout is that we weigh the ETS price and the carbon tax with the emissions that they actually cover. This basically assumes that a broader carbon tax also has broader economic and emission effects. And throughout we use 2 annual lags, both for the control and the policy variables. The remaining challenges, I mentioned this already, but the ETS prices, of course, are market-based, so endogeneity is an even bigger concern. We address that by using these carbon policy shocks as instruments that I talked about before. For the carbon market, most of the variation is also at the EU level, because it's a European carbon price. So we cannot control for the time-fixed effects. We verify for the carbon tax specifications that whether we use the time-fixed effect or these global controls, turns out to be very similar in terms of the results. We look at a panel of 28 countries, half of which have also enacted carbon taxes, and the data are from the standard sources. Our sample covers 20 years starting in 1999. This is just a look at the policy variation. The left-hand chart shows you the ETS price, which has hovered between 5 and 25 euros per ton over our sample period. The right-hand chart shows you the various carbon taxes, which differ a lot in terms of the ambition. So Sweden has the largest carbon tax at 100 euros per ton, but some have very low carbon taxes, some countries. Overall, there's an increasing trend in all of these carbon taxes over time. The coverage, yeah, in Sweden, the carbon tax covers something like 40%, so we would multiply the 100 with 0.4, whereas in, I don't know, like Poland, it covers only 5%, so we would weigh it down for, yeah. And we do the same for the ETS price, but there, the differences in terms of coverage across different countries are minor. Yeah. Okay, so this is a first glance at our results for the EU ETS prices. What I'm showing you here are the dynamic impulse responses over a 4-year period of a euro increase in the EU ETS price, where the solid line shows you our baseline specification that uses the local projections IV approach, and the red dashed line shows the specification where we just use the carbon price without the IV. Interestingly, the results for these different specifications turn out to be quite comparable. However, we still focused on the local projection IV one for most of our analysis, just because it's more robust, and some of the estimates turn out to be a bit more pronounced for that specification. So what do we actually see? The top left panel over here shows the response of energy prices. There's a persistent increase in the energy price following an increase in the ETS price. There's also a fall in emissions by about 0.5% over this 4-year period. So ETS prices actually work in terms of lowering emissions. However, we also see that these ETS price changes are associated with economic effects. The increase in energy prices spills over to overall consumer prices. There's a persistent increase in inflation. There's also a fall in output by roughly 0.75% over this 4-year period, and an increase in the unemployment rate, as well as a fall in industrial production. In other words, there's economic costs associated with the EU ETS price changes. I think I mentioned most of this before. We verify that the results that we have here sort of align with what my co-author has done at the European level. I mentioned that we focused on the local projection IV because we think it's more robust. We also verify that estimating the responses with the policy shocks directly produces consistent results, at least qualitatively speaking. Next, we move on to the carbon taxes. So here the idea is very similar. We show the impulse responses over a 4-year period following a euro increase in the European carbon taxes. We see a similar increase in the energy price. So there's roughly a 0.5% increase in the energy price index after a 4-year period, as well as a fall in emissions. So this sort of is very precisely estimated at the 1-year horizon with a half a percent fall in terms of emissions. It's sort of flat over time from there. It's just that the confidence bands get a bit larger. However, we see for the carbon taxes that there don't appear large economic effects. So first off, we note that the energy prices don't spill over to overall consumer prices, as the response of headline consumer prices estimated around 0. For real GDP, it's estimated around 0 as well. If anything, it's slightly positive. For the unemployment rate, it's around 0 as well, and the same for industrial production. Oh, and I should have mentioned here, the solid line again refers to the baseline model where we use the time fixed effect, and the red dashed line is for the model where we use the global controls instead, just as an exercise that the two captures sort of, broadly speaking, the same thing. Yes?
So your analysis is annual because of carbon taxes are available annual frequency?
Yeah, exactly. It turns out to be very tough to construct higher frequency carbon taxes, at least in the European case.
What was the previous figure for? Oh, the ETS, okay.
Yeah. Oh, sorry, yeah, I should have.
Sorry, just to make sure. So comparing the two, carbon taxes are have much milder effects on industrial production, unemployment rate than ETS.
Exactly, that's the point that we're trying to make, yeah. While having if you compare the emission response, it's actually quite...
The emission is similar. So for a given emission, at least the short-run economic cost.
Exactly, yeah.
It's not obvious.
No, it's not obvious. Yeah, that's why we do what we do now. Because I guess in theory they should be comparable. Yeah. One concern that we had is that I showed you earlier. We have a lot of these national carbon taxes that might vary, or that in particular vary in terms of their ambition. So one exercise that we do is to focus only on the northern and Western European countries, which tend to have more ambitious carbon taxes. We basically run the same kind of analysis for this sample, and the results turn out to be fairly robust. So we see a similar increase in the energy price, a more precisely estimated fall in emission, no effects on inflation and real GDP as well as industrial production, but there is a slight increase in the unemployment rate in this particular specification. So taking stock at this point, we find that these two types of policies lead to comparable emission reductions, but tend to have very different economic consequences. Exactly, going back to your question, the idea is to understand why that is, and that's the second part of the paper that I'm going into now. The first thing or determinant that we wanted to look at refers to the idea of fiscal policy and revenue recycling. Theory suggests that the use of carbon revenues can be quite crucial for understanding the transmission of carbon pricing to the economy. It's relevant in practice here because, as I mentioned earlier, some of these carbon taxes were introduced as part of broader tax reforms that actually lowered some of the income taxes, whereas the European carbon market has no similar feature. So that could be one reason why we see larger economic effects in the EU ETS, just because households aren't compensated to the same extent. We tried to test that channel here by comparing the responses of countries that introduced carbon taxes with and without this revenue recycling mechanism, where in our sample the main revenue recycling countries turn out to be the Nordic countries, which by one measure recycled basically recycled 30 to 50% of the carbon tax revenues that they collected until 2014. So quite a large amount. Here I'm showing you the dynamic impulse responses following a euro increase in the carbon tax for the sample of non-revenue recycling countries in blue, as well as the revenue recycling countries in red. We see already some difference in terms of the energy price effect. The effect on emissions, interestingly, turns out to be quite consistent, at least qualitatively speaking. There's no effect on energy prices, but on overall consumer prices, but we do find quite markedly different effects on the economic variables that we're looking at. So here, as you can see, the non-revenue recycling countries that introduce a carbon tax actually see a fall in real GDP, an increase in the unemployment rate, and a fall in industrial production. Conversely, for the red confidence bands here, you can see that the revenue recycling countries, the different effects are actually estimated around 0. So this highlights to us that these differences in terms of revenue recycling could be one fairly big explanation for why the two policies differ in terms of their economic effects as well. And the interesting thing to us is that while revenue recycling countries see smaller economic effects, the emission response turns out to be comparable, which I think is also important to understand from a policy perspective.
Sorry, there is a question for the folks down here. What is exactly revenue recycling?
It's basically rebating the tax revenues. You can either have lump sum rebates, or what most of these countries did is they said we're going to increase the carbon tax, but we're going to reduce income taxes, something like that. Some countries in our sample do that, and there's basically a distinction between those that do and those that don't.
But recycling to the same subject, it would be some redistribution, no? Like to households, to
yeah, and this literature talks about revenue recycling. I often, when I talk with macroeconomists, they don't really know what to, basically, either you give it back to households or you give it back to firms. You can, of course, you're right that there can be a particular redistribution mechanism as well. But
no, what I'm saying is that as opposed to having a party Boris Johnson style during COVID, I mean, like every revenue is quote unquote recycled in the budget, right? It goes somewhere.
Yeah.
So is this recycling explicitly saying, look, this is the gift for the government for reducing carbon emission, or is it recycling? You see what I'm saying? Like the budget is a recycling thing in any case.
What we do here, you're right. What we do here is we classify, or this literature classifies countries as revenue recycling as soon as they introduce both at the same time. So when Sweden hikes up or reforms its carbon tax and says we hike up the carbon tax, but we also simultaneously reducing the income tax, then we would call that revenue recycling.
So it's a political communication marked recycling.
As far as I understand, it's not just political, but it's, I mean, you can basically look at the income tax over time and the carbon tax over time, and in those countries that we classify as revenue recycling, you would expect while the one goes down, the other goes, while the one goes up, the other goes down.
So, sorry for asking this question, because it looks like the way you do it makes a big difference, right?
Yeah.
So it would be important also in the implementation.
I think it's a very fair concern, and it's sort of a challenge in this literature in general that that we don't have a great way of distinguishing at the individual country level how exactly and where do the revenues go. I think it's something that going forward better data would allow to address that question more convincingly.
Could I just follow up, because I don't think that these countries do give rebates to the income tax. I think that it might be something to specific sectors, and those sectors are not necessarily the one who drives innovation or something. So it's more like subsidized to keep some sectors going.
Yeah.
And I think also that it might be also related to some reduction in, or some subsidized towards electricity prices.
Mm-hmm. Could you repeat that, sorry?
And it might be also subsidized towards electricity prices when electricity prices are pushed up, because these are also, so I think this is a valid something to look into. I don't think it's the example of income taxes. I definitely don't think it's the case.
Yeah, we can look more into it. As far as I understood, and as most of these Scandinavian countries in particular reformed their tax systems, as far as my reading was concerned, there did seem to be a communication that they tried to lower income taxes as well as corporate income taxes, but we can definitely look more into it. I agree. Thank you.
Sorry, one more related. Question. So I think it's also affect the difference in the impulse response function between two groups, because you show the impulse response function of the energy price CPI is different, right?
Yeah, you wouldn't.
And it affects macro total aggregate CPI. So it's definitely affect for monetary policy. So I think it's very important to distinguish recycling.
I completely agree. What we do here is we split the countries, and then we basically estimate the group-specific responses. But you're of course right that there could be other differences across these countries. I don't have a great explanation for why the energy response would be different in the two instances, for instance. I don't know how much time I have left.
Yeah. So you have 10 minutes, so let's postpone questions until the end of the presentation.
Okay, that's great. So the second channel that we wanted to look at is sort of differences in terms of sectoral coverage of the EU ETS as well as the carbon taxes. I talked about the carbon market covering mainly the power sector as well as the energy-intensive industries, where previous literatures have shown that the pass-through turns out to be particularly strong in the power sector, whereas the carbon taxes, because they mainly apply to liquid fuels, tend to cover mainly transportation and the remaining industrial sectors. So we want to look at or test a channel by looking at the response of producer prices to these different kinds of climate policies. So what I'm showing you here are the dynamic impulse responses for a euro increase in the EU ETS price in panel A and the euro increase in the European carbon tax in panel B. We see that the increase in the EU ETS price leads to a persistent increase in the producer price index of energy in the very left panel, and the overall producer price index in the second panel to the right, to the left, sorry, which are then, as we saw, passed on to consumer prices. For European carbon taxes, we do not see a similar, or the increase in producer prices for energy is somewhat muted, and when we look at the overall index there, the response turns out to be around zero, and we saw that this also shows up in overall consumer prices, that that didn't seem to be a strong impact on the overall consumer price index. So this is an additional reason related to coverage and then the associated pass-through in these different sectors that could explain why we see smaller effects in the national carbon taxes. The third channel that we wanted to look at refers to differences in coverage in terms of the geography. So the carbon market is, of course, an EU-wide policy, whereas the carbon taxes are only levied at the national level. Given the strong integration in most countries of the EU, there could be a risk-sharing channel that if one country introduces a carbon tax, it's sort of cushioned by something like increased trade. Similarly, these national carbon taxes, of course, are more subject to leakage, in particular in the manufacturing sectors. We want to test that by looking at the impact on EU-wide emissions, where for the EU ETS we can just estimate a time series local projection because everything is at the EU level. For the carbon taxes, we still estimate at the country level and use the EU level emissions as the outcome variable. Here's what that looks like. So panel A is again for the EU ETS, panel B is for the carbon taxes. We see that while the EU ETS, basically the response we see at the EU level mirrors the one we see at the country level. There's a decrease in emission. Panel B contrasts a lot with what we saw at the national level. So at the national level, we found that the carbon taxes reduce emissions. Here at the European level, we see a slight drop after 1 year, but then it even increases slightly over time. So this is suggestive that carbon leakage could be at play, that while carbon taxes reduce the national emissions, the emission in other countries, potentially neighboring ones, might increase following an introduction of the carbon tax. And this could then again explain part of the reason why we see these differential economic effects as well. The last reason, or the last channel that we looked at, refers to the monetary policy response. We saw that the ETS prices introduced quite a bit of inflation, and monetary policy in order to trying to stabilize inflation could lean against this pressure. For the national carbon taxes, first we saw that they didn't appear to be inflationary to begin with, but if anything, the inflationary pressure would be confined to a single country, so we wouldn't expect the same kind of response by the ECB. We tested here by plotting the dynamic impulse responses for both short-term and long-term interest rates, in panel A again for the EU ETS, and panel B for the carbon taxes. And we do see some evidence that's consistent with this idea that the ECB raises interest rates following an increase in the carbon price, thus leaning against the carbon price increase and thus lowering the recessionary effects that we might see. Conversely, for the carbon taxes in panel B, we see that the short rate goes down, the long rate goes up a bit, but they're sort of estimated around zero. So these are sort of the four determinants that we put forth and that we think are important for understanding the differential impacts across these two policies. What I want to do next is to ask how much of the variation in these different variables that we were looking at earlier is actually explained by the two types of policies. So this tries to address maybe a question of which policy is more important for aggregate emission reductions at the EU level, which is ultimately what we might care about. We do that empirically by estimating a variance decomposition following this R-squared estimator by Gorodnichenko and Lee that we extend to the panel setting with controls. So the cookbook, I don't have time to go into details here, but we essentially obtain a set of forecast errors for the different left-hand side variables that we're interested in by regressing or basically running the same kind of local projection we did before using the same kind of controls. We do the same for the two types of carbon price variables that we were looking at to obtain a set of residuals, and then we can basically compute the forecast error variance of a particular left-hand side variable that is explained by the carbon price or carbon tax as the R-square of a regression of the forecast errors on the residualized carbon price variables. And then we're able to conduct inference by using a block bootstrap. This is what these results look like. So here we contrast again carbon prices in the EU ETS with the carbon taxes. We look at the energy price index, greenhouse gas emissions, as well as real GDP at a horizon of 1 and 4 years, where in brackets we show the 95% confidence intervals. The main takeaway here is if you look at the first three columns, we see that ETS prices actually explain a very meaningful share of the variation of energy prices, but also greenhouse gas emissions and real GDP. Conversely, in the last three columns, we see that the same isn't true for the national carbon taxes. For energy prices, they still explain some variation, but then when we look at greenhouse gas emissions as well as real GDP, they seem to explain basically none of the variation. So this just illustrates that the ETS seems to be the main lever as well as the cornerstone of the EU's climate policy that is the main driver of emission reductions at the EU level. So while carbon taxes can be effective at lowering national emissions, at the EU level it's still mainly about the ETS. Okay, so I have 2 minutes left. So we do have one exercise where we wanted to look at the heterogeneous impacts of the carbon market on these different countries, depending on different exposure variables, in particular the share of free allowances, as well as the concentration in electricity markets. We test that by basically using an exposure variable that we interact with the instrumented carbon price. And then here we simply plot the interaction effects. So the main takeaway here is that for countries that receive more free allowances relative to the emissions that they produce, they effectively face a lower carbon price, and thus they also see a lower increase in energy prices, as well as lower response of, or real GDP falls less. Greenhouse gas emissions are roughly comparable, and then the unemployment rate falls by or increases by less. Similarly, for the concentration in national electricity market, this ties back to the idea of pass-through, that in a very concentrated electricity market, the increase in the EU ETS price is passed on to consumer prices at a higher rate. We see some evidence consistent with that in countries that have more concentrated electricity markets, the energy price increase turns out to be larger, and the economic effects also turn out to be more pronounced. We have some additional results on the distributional impacts across different countries. Basically, if you want to understand which GDP per capita income groups are the most affected of the 28 countries that we're looking at, it seems to be the group in the middle of the income distribution. Why is that? Because they tend to receive very few free allowances while still having highly concentrated electricity markets. And these in particular turn out to be the southern European countries that suffer the largest in terms of the economic costs associated with the EU ETS. With that, I think I'm out of time. We provided new evidence on the effects of carbon pricing in Europe. We find these differential effects of the EU ETS and the national carbon taxes. While both are effective at reducing emissions, the former policy seems to have larger economic effects. We also provided some evidence that these economic costs depend on country-specific exposures. For those interested in the paper, in those results, in terms of the distributional effects, the paper is online. Thank you very much for the comments and looking forward to more. Thank you.
We have time for one quick question.
Wondering whether you consider extending the sample of price surprises, because at the end of your sample, actually, there was this big reform of the EU ETS, and so like the carbon price skyrocketed, and so, I mean, in principle, I think you should get even like stronger result if you extend. So I was wondering if you consider that.
Yeah, that's a great point. The main bottleneck right now is that the policy shocks only extend until 2019, I think. That's why we stopped there. But going forward, I agree that it would be very, very interesting to look at that particular period, because I think it was the first one we actually had high carbon prices compared to the 25 euros per ton. That's the max in our sample period. Yeah. Thank you.
Great, I guess we can thank the speakers and move to the next session.
It is a great pleasure to introduce Rick. First of all, thank you for inviting me. Thank you for organizing this incredible conference. I wasn't aware of this association. I'm very happy to be here. Presenting Rick gave me the opportunity to look at his CV, and although I knew many things about him, I didn't know many other things. So he has been one of the pioneers in this area. He has been preaching that we should pay attention to climate change for quite a while. He was among the first economists looking at the problems that we face with climate change, and we thank you for that. I also learned that a few things, that he is an aficionado of this European Institute. He has been here teaching in the past. He has been here again a few years later, not too long ago. And he's also a politician. And first of all, before I say what I'm going to say, I have to say the usual disclaimer. The views expressed here are my own. They do not represent at all the views of the Federal Reserve System. If you don't like what I'm going to say, please write an email to me. You can Google my name. It's easy to find my email. Don't write, don't complain with the chair of the Federal Reserve System. Thank you. I learned that Rick was also a politician. I'm very happy that I saw that, especially after the debate that we saw last night. It's good that some economists are involved into politics. And that may help addressing the issues that we are debating here. Without further ado, the floor is yours.
Thank you very, very much for your kind introduction. I don't know whether you saw the debate last night between Trump and Biden. I hope I come out of my words better than President Biden. It was a disaster for anybody wanting to do anything, at least a modest climate policy, because the alternative is Trump, which looks very likely to win, and it's back to coal. and it's climate policy down the drain. In a sense, that's a topic of what I want to talk about. So we all know about physical risks in climate change. Indeed, I've done a lot of work on myself on that stuff. So it goes much further than the damages we see calculated by Nordhaus and 99% of integrated assessment models. But we also have to look at the risks of climate disasters. So you have to look at hurricanes, floods, extreme heat, droughts, and the intensity of these things. They increase by a factor 5 to 10 if temperature goes up, say, from 1.5 to 2 degrees. And the severity may also increase, differing slightly between the different types of disaster. So I think any model of physical risks, which only looks at a bit of bite taken out of GDP, is insufficient. You really need to look at these extreme weather events and these climate-related disasters, which in contrast to Barrow-style disasters, they increase with global warming. So they get more and more serious, they get more and more damaging with global warming. Then there's a third thing we need to think about. These are just the physical risks. And that's the risk of tipping. So maybe you've read recently, you see this, if you look at these heat maps of the oceans, you see that there's a blue spot near Greenland. Shouldn't be there, but the North Pole is heating up. The blue means cold. So really what's happening is that there's a lot of fresh water from melting of Greenland going into the oceans near the Arctic. And that's making the water less salty. So it doesn't sink to the sea. So it really, that's, if you think about it, that's the way it stops kind of the circulation of the Gulf Stream. If that happens, the UK and the Netherlands, my father's and my mother's country, they'll be royally screwed because we will lose our temperate climate and we'll have extreme winters and extreme summers with a lot of extreme weather events. So that's an example of an irreversible tipping point. The other one is, of course, melting Greenland, melting other forms of ice sheets, melting the Siberian tundra, which will release a lot of methane. And these are one-off kind of climate tipping points, which I think we as economists should take account of. So the risks, so just pretending like 99% of integrated assessment models that the costs of climate change are a little bite out of GDP, and people argue about it, of course. Nordhaus, they're very small. By your call for is a recent paper by Diego Keynes, and he might find that it's much, much larger, hence leading to much larger social cost of carbon. But I think in his framework, in a very indirect way, there's probably these tipping points and extreme weather events are maybe a bit mashed in. But anyway, we need to think conceptually about these three types of physical risks. There are 9 tipping points, and I won't have time to discuss them here. So if you don't do anything about these physical risks, you screw up. You're really storing in transition risk, because the more you procrastinate, the more you're not taking action, the more trumps you've got, if you want, and the more people are dilly-dallying and are basically being climate wimps, then you need to take more and more action later on to achieve your climate goals. Furthermore, financial markets will react by any of these carbon assets. Fossil fuel-based assets will become dodgy assets. So they might carry a premium. They might carry a carbon premium, because if they're dodgy assets, an investment fund or other institutional investors will say, I want to be compensated for the risk that it goes belly up. When climate policy comes green, all these brown investments become less profitable, so they want to be compensated for that by demanding a higher rate of return. So then we're talking about transition risks. Furthermore, it's also the case if you screw up dealing with physical risk, you get another problem with transition risk, and that's the idea that you may get ending up with stranded financial assets. So today I want to talk a little bit about the nitty-gritty of when climate policy is screwed up. So you really have a view of the world where climate policy may become good and maybe just business as usual, and maybe stepped up to a bit modest, ambitiously climate policy, and may become, a properly ambitious climate policy. And there may be probabilities of switching from that to that, like we will have, for example, in the American elections. So let me just see. So that was a bit of a talk. So I'm going to talk basically about these three topics. I'll have a few words on physical risk. I'll keep that short. Then I'll talk a little bit about, as if you were a policy audience, to what's holding us back. Because I think we have much too few papers on political economy and why climate policy has been so hopeless. It's been a complete disaster. I mean, despite some stuff going on in Europe, Europe will only become effective from 2026 onwards, because then we will have the CBAM, then we'll have the border carbon taxes. But up to now, most of the big polluters have been exempted, so we will look forward to future studies in that. But really, the political economy is really gruesome, and I want to take it. And then I will talk about that third part, which is quite a technical paper with Christoph Hamill, which deals with both types of risks. So just to set the scene, loads of people are working on this stuff. Now, not just us, also scientists, and they publish Nature and Science. It's full of papers like that. So I grabbed a recent one. And then what they find is that the cost if you do nothing, which is like an 8.5 scenario, the brown line, are very high. They can go up to 40% of GDP, but whereas the cost of the mitigation cost are very small. So really what that's saying that it's a no-brainer. So to deal with the climate issue, of course it depends on the model, but in most models, mitigation costs are much smaller than the total cost of actually you would have if you don't do anything. So this is a crucial thing to keep in mind. In lots of different models, the graphs look a bit different, but qualitatively they all convey that message. So the first thing is then the normal things you want to price carbon, not just to cut demand, but also to boost green R&D. Also to otherwise you wouldn't have a market for carbon capture and sequestration. So when you deal with these physical risks, so the way I would like to talk about it is I'm going to have these three types of externalities. And I just give you an example of it, just a baby toy model, but we can make these things much more detailed and much more granular, multiple countries, multiple types of shocks, and things like that. But just to give you an idea, conceptually, it's about these three types of shocks, where the north-house damage is actually quite unimportant. So the damages you see in the... so the most important ones are 2 and 3. In terms of the effects on the cost of carbon, and since the cost of carbon is the anchor for all climate policies, any other of the climate policies, they relate to the cost of carbon. So if the cost of carbon is high, that's why President Biden, this first day in office, he asked for a study, he commissioned a study to the carbon price, and came out by Rennet et al. Recently last year, and they increased the carbon price to about $200 per ton of CO2, which is much higher, 4 times higher than before. The recent papers put it even higher. So I'm going to put it very easy. So you have these damages from temperature and output. There it is. I take the Nordhaus temperatures just as an example. You may have that the intensities, the probability of a disaster occurring, if you compare them with Barrow-style disasters, they occur less frequently, but the size is much bigger. Whereas these temperature-related disasters, droughts, floods and storms, they tend to occur more frequently, but then the damage is not as big and more local, if you want, than these Barrow-style damages. But nevertheless, they are important. So for this purpose of this little joke exercise, we aggregate storms, floods, and droughts. And then the third one is just to get your mind around it, is a tipping point. So typically, there's something called the transient climate response to cumulative emissions, and that shows you by how much temperature goes up if cumulative global emissions go up by 1 trillion tons of carbon. In actual fact, it's a ballpark measure is 1.8 degrees Celsius per trillion ton of carbon. So it's the slope of the line. If you plot temperature since the Industrial Revolution against cumulative emissions, it's an upward sloping line, and the slope is about 1.8 degrees. The biggest tipping expert in the world is a guy called Timothy Lenton. So he's done most of these studies for the IPCC, and he would say, well, a good short-run thing, we normally do more complicated ones, but just for the purpose of exercise, you just push it up, it gets pushed up by 2.5. In actual fact, that's the simplest tipping point I'm going to put in here. So then you calibrate these things to world data. So typically most of these models nowadays have Epstein-Zinn, so they're very stochastic, so your aversion to risk is bigger than your aversion to intertemporal fluctuations. They can be either calibrated to market-based data, I'll show you that, and I'll also do a more ethics-based calibration. Then I want to show you briefly, because there are quite a few finance people here, that you can either run your computer overnight for a couple of nights to get the answers out, because these are horrific computational exercises. Nowadays they're done with machine learning, so I think of Simon Scheidegger or Jesus Fernandez Villaverde. But I have a paper in the AR where we use perturbation theory, you just get formulas out which look just like the asset pricing in finance. So what's the price of a stock or share? It's the expected present discounted value of future dividends. What's the social cost of carbon? It's the expected present discounted value of all future damages, expected future damages from emitting 1 ton of carbon today. They are just literally the same thing. It's the same thing as a house and a stock or share or the social cost of carbon. So the whole machinery from finance you can apply to that. So what you see, if you just look at the first formula, let's assume that damages are proportional to temperature, that lambda is the frequency or the intensity of these disasters occurring that increases in temperature. And then typically you will get these risk-free rates and these risk premiums. The risk premium is not just the one from geometric Brownian motion, the gamma sigma squared, but there's a whole lot there for Barrow-style disasters and also for the climate-related disasters. What you see in the risk-free rate is pushed down by more and more uncertainty. It's pushed down because of precautionary saving. You can't insure against all of the climate risk. So then what your formula looks like, and again, don't look too much at the formula, but in equation 22, there's a very heavily cited article by Golosov et al. In Econometrica, and that would just have the first term D1T. And it just says that the price of carbon is proportional to aggregate economic activity. Why? It's proportional to transient climate response to cumulative emissions, and it's a discounted thing, so it's divided by the R star, by the discount rate. So all we're saying is that now there comes an extra term where lambda 1T, that the second encircled one, shows the effect of temperature on the intensity of these climate-related disasters. So you want to price that in. And that's the way you price it in. So you can just write it down and it works very well. And the rate of interest you have to use, the discount rate you have to use, is a bit like a Keynes-Ramsey rule, an Euler equation, but it's basically a discount rate you use in capital asset pricing model. So you have a pure time preference, you have a wealth effect. You have to subtract the growing damage, and then you have these prudence effects, and then you have an insurance effect. So we can allow also for a risk of climate tipping, which I've already said, where the transient climate response follows a Markov chain. And then basically, again, let's not look at the maths here, but you can just write down the answer, and it's basically the price without climate tipping plus the probability that tipping occurs. The marginal probability that tipping occurs is at h prime. So imagine that cumulative emissions or temperature goes up. That increases the probability of an irreversible disaster. And then you have to look at the cost you occur then. And you can just write it down that, and you can put it in the back of an envelope and you can calculate it. The third term there is a repricing term for before and after the regime shift. So anyway, this is what you get. So the top one, A, is a market-based calibration. So the rule-based approach is what I do just by the back on the envelope. The grid is a grid-based optimization. And to be honest, it takes a hell of a lot of computer time. But they turn out, as you can see, the error is negligible. It's actually, in the market-based calibration, the optimal cost of carbon is very small, because the discount rates are very high. But if you allow for tipping points in climate disasters, you end up with something like $37 per ton of CO2. We think it's more realistic to have a growth-adjusted discount rate of 2%, which is more in line with what the IPCC uses. And then if you look at the last row, you find that the cost of carbon is about $180 per ton of CO2, which is very much in line with the study commissioned by President Biden and the Rennet et al. Study. Again, if you look at the grid search, which you just treated as a black box optimization exercise, and if you look at the simple rule, it's more or less the same answer. It's 180. So and basically, you can redo these exercises with a whole string of climate-related disasters or with a variety of tipping points. And this is the kind of state of the art, the way you would do tipping points. Now, of course, you're in a world with lots of jurisdictions and lots of different economies. So there is very little work, almost no work. I think any model which doesn't deal with the stochastics of tipping points and climate-related disasters, I don't take serious. But there are no papers where they do this in a multi-country context and things like that. But I think they will be appearing soon. So a final thing before I go to the more important parts is that the IPCC doesn't take the economists serious. So they say all your stuff on the Pigouvian price, the social cost of carbon, you're arguing so much, Stern versus Nordhaus, we're just going to have a cap of 2 degrees temperature or 1.5 degrees temperature. Then the optimal price, so the prices that I showed you, the optimal price of carbon goes in line with the growth rate of the economy. The growth rate of the carbon price is in line with the growth rate of the economy. If you have a cap on cumulative emissions, a cap on temperature, then it's different. Then you get a hoteling path, because then the growth rate of the carbon price is equal to the risk-adjusted rate of interest, which is a much faster rate. Why did politicians choose that? They love it. What do politicians like? They like to procrastinate things that are unpopular. So if they're on the table, a welfare-based measure and a cap-based measure, but the cap-based measure, you say you take much more of the action later on, then the politicians say, let's have that. And that's in effect more or less what happened. Just like the permit system in Europe was not chosen because of a careful study of the work of Martin Weitzman on prices versus quantities. It was just that you could just suffice with a simple majority for an ETS, but you needed, anybody could block. Hungary could just block a European carbon tax, and that's why Europe has got the ETS system. So it's not based on a proper economic analysis. It was actually, in the end, it was decided by a simple political reality. So, and then of course you need lots of supplementary policies which we know all about and I won't talk about now. So what are all these obstacles? The first obstacle, or the first thing we should realize is that if you look, every year I ask MPhil students, go and tell me how much CO2 is on the books of these oil, gas and coal companies. So how much embedded CO2 is in there? And it's colossal. So we can only burn about 400 or 500 billion tons of CO2 to stay below 1.5 degrees Celsius. It's much lower than that now, I think. But if you look in the books, it's a 3.5 trillion tons of CO2 in proven reserves. They also have probable reserves, and they also have countries which don't have companies, but have state companies for which we don't have the figures, like Russia or Algeria. So really, we have 7 times as much oil, coal and gas on the books that we are allowed to burn. So what are these? Should I short those companies? Does it mean that nobody takes climate policy serious? There's a huge amount of transition risk here. And furthermore, these companies are investing in new discoveries. And billions of money is being poured in like that. So if you look at this graph, you see there's a 3.5 trillion tons of CO2 on the books. And it's only, it doesn't contain everything. Because there's still the probable reserves and the gray area, that's what we are allowed to burn. So either all these companies that are involved there go belly up, or climate policy cannot be taken seriously. So this is the big elephant in the room. And exploration is still going on at 2% per year. The stock of reserves measured in CO2 is going up each year. So what the hell is going on? So, and then secondly, the big second elephant in the room is that we all talk about pricing carbon. and even Europe is making progress. But if I look at my own country, the fossil fuel subsidies are much bigger than even the ETS. And then the government, there was Extinction Rebellion, and they said, no, they're just mad. Well, their methods are mad, but their argument was correct. So then finally, that the Dutch government said, no, only 10 or 20 million. In the end, they agreed it was 40 billion of fossil fuel subsidies. The IMF, if you calculate implicit and explicit fossil fuel subsidies, comes up between 6 and 7% per world GDP. So this is a bit like we're pricing carbon and subsidizing fossil fuel at the same time. That's crazy. That's like America. You put a central heating on, and at the same time you're air conditioning. I mean, it's just the most idiotic policy you can imagine. So then the third one, I don't know whether many of you have heard of this Energy Charter Treaty. That's a dangerous treaty. It's orthogonal to the Paris Treaty. It gives all the property rights to pollute to these polluting firms. So then if the governments turn green, they can go to the judge and say, have myself compensated, please. I want lots of litigation money. And the governments have signed up to that. So they basically loaded the dice against them. So there's still many countries that have to leave that treaty in order before they can do a proper green transition. So that's a reason why people are procrastinating. The previous two reasons are also reasons or indicators of procrastination. So this treaty is totally out of date. It's a scandal that some countries are still signed up to it. So this obstacle is this, so a politician, I've been one myself, they like two things. They want to be popular today, they don't care about the future, so they want to procrastinate anything that's unpopular, bring forward anything that makes them popular. So they love subsidies, they hate taxes. So that causes all kinds of incentives. There's huge literature. It increases risk of stranded financial assets. I will give some cost. It increases the cost of litigation and compensation. There's the small manner that when we teach macro, the first lecture of macro, I think I always used, if in doubt, smooth it out, because you always want to smooth things. So it's obviously not smoothing things, so it's costly from a welfare point of view, and it induces green paradox. So, and then you can ask, is this risk of stranded assets priced in? To be fair, the jury is still out. So there are other papers coming out. There's the papers by Bolton and Kasperczyk and others. There's a nice paper by Sully and Soudet, taken much more further than climate externalities. But on the whole, you find that it's priced in. Just like that banks charge carbon incentive projects higher rates of interest. So you might think that's good, because if they price it in, that's an incentive to speed up the green transition if it's really properly priced in. So it's very important to get empirical clarity on that. And these studies are very recent. There still needs to be more mature, and there are other people also in the room who may have different views on it. For the time being, I'm with Bolton and Kasperczyk, but this is absolutely crucial to do that. So here you see these cumulative risk premium. Carbon premium. So that basically, to be clear, it means that the return, the excess return on brown assets is bigger than on green assets. That's what we mean by the difference between these two returns is the carbon premium. And that carbon premium, the debate is that carbon premium positive or negative. I'm going to give you in a paper a mechanism for why it may be positive, and then also that if it's positive, how does it accelerate the green transition? Yeah. So there are loads of other obstacles which I don't have time to talk about: carbon leakage, intergenerational hurdles, policy failure and capture, the need to get political majorities, the need to recycle, as was discussed in the previous paper. People don't realize that renewables need much more space per kilojoule, so and space is very scarce. And then the last thing, 11, I could talk for hours on that. I think most of our models don't allow for behavioral distortions, but you must realize carbon pricing is highly salient. So if anything you do with carbon prices, you get a yellow vest out on the street. If you don't allow for these behavioral aberrations, you really not getting it right. I won't have time to talk about it, but that's not to say that it's unimportant. So I come to the last part of the talk, which is this more technical bit. So this is a climate dynamic stochastic general equilibrium model. We have all these different risks I talked about, but you'll also have these transition risks. So transition risks can be political. So there may be a change in the ambition of climate policy. They can be technological. So there may be a sudden breakthrough in technology, and further there may be a sudden change in preferences. Think of a Greta Thunberg effect. I will look at the first two in this model. So I'll have two types of transition risks. And then the thing is how, so you have a, and then to do this properly, we have a model where you have green stocks of capital and brown stock of capital. So and then you can switch between them, but switching between them is costly. So you could even think of it as irreversible, but we think it's very costly. And there's also intertemporal adjustment costs. So there are also in the model, there are stock market values and there are excess returns, and we can address the whole issue of carbon premiums, as well as the issue of financial stranded assets. So that just to set the frame. So basically the idea is to find the mechanism to underpin these empirical findings for carbon premiums and for stranded financial assets. So really to get a handle on transition risks. I should say there's a huge amount of work by the Network for Greening the Financial System, all these central banks. And I found out in a recent conference in Venice that people there, they basically see transition risk as people not pricing it in completely. But that's a different, so I'm not saying that's not unimportant, but here everything is priced in. So there's still a transition risk, but they're pricing in. Of course, if you're not pricing it in, which we could run our model, I'm not showing you today. So if I have slightly irrational investors that they're not pricing in, then those carbon premiums will be higher, risk of stranded financial assets will be even bigger. So I'm trying to load the dice against me in this framework. But there is this issue. And then another thing that in much of these climate stress tests that you see nowadays appearing all over the place, most of the economy is treated as exogenous. So they don't play through a general equilibrium framework, and they don't trace it through a capital asset pricing framework, which is what we try to do here. These are these stress tests they do, and our work is complementary. We try to dig deeper, and we allow for all this heterogeneity that you have in a DSG model. So there is one paper on transition risks, which I've seen published in an economics journal, and that's by Kai and Thomas Lonsek in the JPE. It's a huge paper, and so really what I did in the first bit was extend their framework to allow for more risk and things like that. So that there's not many other papers. It's computationally such a bugger to do it. But now we're much better with computations, and now other people can do it as well. So, and there have been other models of transition risk. This paper in Journal of Finance, but then they see transition risk just as a random walk or something like that, as a stochastic process. So very exogenous. That's not the way we do it. And that's a very reduced form framework. So we want to see how this disruptive changes affect the cost of carbon. We want to see how does this risk of assets trending interact with the transition, and how do financial markets price in those risks. Okay, so we have three types of policy risk. The difference between transition risk and technology risk, policy risk, is that that's reversible. Whereas the technology risk, and I will look at the technology for negative emissions technology, once you've got a breakthrough in technology, it's there. So that's irreversible. The physical risks are always irreversible. So these are these irreversible tipping points. So we model those things on top of our normal kind of Poisson risks and our geometric grounding motion risks as a Markov chain. So we have 3 times 2 times 2, 18 states. I won't talk about it today for lack of time, but it may well be that certain tipping of one particular tip of the Greenland ice sheet may lead to a tip in the Gulf Stream, or you may get that a tip in the climate system may tip policymakers to tip them into action. So this cascading or tipping the dominoes, if you do it, it will amplify the effects enormously. So I will try not to go through the equations. So I'm going to go I don't expect you to look at the equations too much, but it's just a way to say it. So you have you basically have a production function which depends on capital and an energy composite, and labor, of course, which is exogenous. And that energy composite is a SAS aggregate of green and brown energy. Yeah, and then there is a TFP, and that TFP depends negatively on temperature. That's a lambda function, and that X is the Markov chain, so it may depend on whether the climate system has tipped or not, and things like that. The climate model is a bit different to in the first paper, in the sense that we also have we don't have your green innovation terms, but we do have negative emissions, this DACSS technology. So that's why you see a minus D. So you must realize that all the projections you see of the IPCC, they all assume that negative emissions technology come on stream, but nobody knows when. We know how to do it, but it's not competitive yet. So that's a big uncertainty in all of the IPCC things. So we thought we model it as a Poisson process and the form as breakthrough technology. But that means that if you look at temperature, it's proportional to cumulative emissions, and it's cumulative net emissions, so it's net of this negative emissions technology. And then we have this theta x, that's the slope, and we allow for tipping points in there, so there can be 3 tipping points in there. Okay, so this is what this Markov chain for disruptive changes look like. On the left column, you have the 3 climate responses, temperature responses, 1.8, 2.1, and 2.4 degrees Celsius per trillion tons of carbon, and you can tip between them. You can't tip back. Once you've tipped, you're screwed. Then there is the second one, the middle one, is for the breakthrough in negative emissions technology, and the one on the right is the policy transition chain. You either do nothing, business as usual, or you have a modest climate policy, which is, like we say, Pigouvian, or you might have a very ambitious climate policy, which is Pigou plus a temperature cap. And then you might think, where do all these numbers come from? There's been a descriptive paper in Science by Moore et al., and we basically model their policy chain from that. But of course, that could be much improved. It's of course pretty ad hoc, I think, but it's just a way. But we looked at numbers of variations in robustness. So here we have our consumption, which is output minus investment minus the cost of the energy composite and minus the cost of negative emissions. We have Epstein-Zinn recursive preferences. So for your memory, we have a risk aversion parameter. We have elasticity and temporal substitution. The two need not be related, and we have time preferences. Now these results look like that. They're very similar to extra excess, but you get extra precautionary savings terms in the risk-free rate to allow for transition risk. I will take this away because there's too much algebra for one slide. So now we calibrate it, and then I'll show you some graphs which I think are the main interesting ones. So the calibration is to a market-based calibration. So the climate policies will be less ambitious than you think. And what we will see is then I'll show you. We calibrate the climate part to a kind of a relaxed business as usual, RCP 8.5 scenario. We have the tipping points from the science literature, and we copy that from the Kai and Lonsek JPE paper. And climate disasters are in line with a paper which just looked at that by Caritas and Sipapadeas. Here, this is how the way the the carbon removal technology, the negative emissions technology was calibrated, and the political Markov chain was calibrated along the lines of this Moore et al. Science paper. So let's take that for granted. Then the carbon emissions intensity, we assume that there is that emissions intensity over time, due to technological progress, get less and less and less, and we've modeled that in a way that it fits the other models. So take that for granted. You don't want to look at it, but this is the calibration table in case you're interested. I should tell you that we have in this model also learning by doing. So we have that if you use more and more green energy, it gets cheaper. So every doubling of solar panels, the cost of a solar panel drops by 30%. So in here, in the policies, there will not just be a carbon tax. So to Francesca, there'll be floating around a renewable energy subsidy as well. You need both. And if you don't do one, you do more of the other, as you get in the second best framework. So in that sense, there's a link with your paper. So just to give you some simulation paths, give you an idea, to not overdo time too much. So look at the left panel first. So that's the mean path for carbon prices, the solid line. And then you get 5% and 95% quintiles. So I think we have about 100,000 paths. So we have a box, 100,000 paths, and then we can look at those quintiles. So first thing you see, carbon taxes, we start from business as usual. And then sometimes it tips into, so it starts with about 0 and slowly it goes up. However, if you look on the right-hand panel, panel B, there we only take those paths that have tipped into policy action. So those paths that have tipped into either modest policy action or ambitious policy, climate policy action. And then you start off with about $308 per ton of carbon or $84 per ton of CO2, and it gradually rises. And then, but this hides this thing, and I'll show you a bit later on, many different paths within that thing. The actual carbon price individual paths may be very volatile. So then if you look at this, to give you a bit of a feel for it, so if you look at the top left panel, panel A, you see the light gray region are all those paths which are still in business as usual. And then the dark gray panels are where they're in modest climate action, the Pigouvian one, and the black ones are where they're ambitious climate action. So you see, as time progresses towards the end of the century, more and more people, more and more states have ambitious climate policy. Notice that due to transition risk, climate policy is much less ambitious than in the first best policy, obviously. So therefore, we're doing better than business as usual, but not as good as we are because of the transition risk. Then if you look at the top right panel B, you see the climate tipping state. The light green one, where we're still in our own climate system. But you see, as time goes on, it's more and more likely that Greenland and ice sheet and other tipping points are set into motion, and that therefore the temperature response becomes much bigger, and we go into the dark gray or the black area. And you want to avoid that. So you're pricing in carbon. If you get into action, you will try to avoid it. Then the bottom left panel C shows you the light gray is where no negative emissions technology, and you see over time it becomes more likely that negative emissions technology comes into stream. Then the bottom right panel shows those paths with less than 1.8 degrees. Notice that many paths are over 1.5. So we've already screwed that. And that's because we have transition risk. Then the light gray area is between 1.8 and 2 degrees. Then you have another area with 2 and 2.5, and then there's also quite a few paths, the black paths with more than 2.5 degrees. So let's delve into it a bit deeper. So what you see is there on the top left panel, you see that the share of brown capital slowly goes down to 0 in the year 2100. Not as fast as under a first best policy, which we explain in depth in the paper. You see that the dotted line on the top left is the mean energy, the share of energy of clean, dirty energy goes also down to 0 a bit more quickly, and it gives the quintiles as well. Look at net emissions. You see that is still positive. It's now about 10 gigatons of carbon per year in the global economy. We managed, even though there is transition risk, to keep it fairly stable. And then once negative emission technology comes in at the very end, we can even have negative net emissions, and that's really crucial for IPCC and also in these exercises to have these relatively positive results we have. And as a result, if you look at the paths for temperature, the mean path is that solid line stays just about 2 degrees, just a bit above. But of course, many paths can go up to 3 degrees, or some of them can even go to 4 degrees. So this hides a lot of variety, which I will talk about. And the same thing there, you see the output path. So if you look now at some of the asset prices, which is what I'm more interested in. So first you should look at the risk-free rate, which is in the top left panel. So of course, you see the mean path is fairly stable and things like that. It goes down a bit. But in many paths for which there is a lot of risk, a lot of tipping risk, a lot of climate disaster risk, and if you're close to these things, you get a hell of a lot of precautionary saving. And that really pushes down the risk-free rates in those paths. We see that when we look at individual paths, as I might do in a second later. Secondly, if you look at the bottom panels, you see that the risk premium for both green assets and brown assets goes up. But for brown assets, it goes up more than for green assets. So you see that on average you get a carbon premium. Now, for individual paths, notice the asymmetry for the quintiles. There are many more paths where the carbon premium goes up maybe to 2 or 3% than negative carbon premiums. So on average, you get a lot of evidence for these carbon premiums, and that's in line with the evidence of Bolton and Kakpachik and others as well. So to put a little bit more, to give you an individual path, just to show you some of that, you see, for example, if you look at negative emissions, the top right panel, you see that certainly negative emission comes down, and that's because of a tipping point, and then certainly can go up because of another tipping point. So these abrupt changes are either due to the availability of a new technology, or it is to the availability, if there's a big negative shock to the economy, then the economy is from then on operating at a lower rate, and therefore emissions will be lower. And that's actually what's happening at the first tip. And then right at the end, towards 2100, you see a big drop in emissions, and that big drop in emissions is due to the fact that there is finally negative emissions technology comes on stream. Before, in the middle, you see emissions going up, and that's just due to a climate tipping point. So you can then go for all of these things for individual things, and then you see that hides a lot of detail which you don't really see everywhere there. So it gives the intuition, but let's not do that. Basically, there's a sizable carbon premium of about 3 percentage points that reacts very sensitively to small temporary fluctuations. I've discussed that. So now I want to show you briefly before finishing how would you get stranded financial assets. So let's now assume, just for sake of purposes, that the brown sector has to rely on fossil fuel only. The brown sector doesn't take renewable energy, whereas the green sector uses mostly renewable energy and a bit of fossil fuel. So then if the cap is exceeded, if temperature exceeds 2 degrees Celsius, then the brown, if you then switch to the cap strategy, if you switch to the most ambitious climate strategy, the brown sector has to shut down. It shuts down, and therefore assets get stranded. What we show is that the cost of stranding is sizable, but also that the price that is priced in, the price of carbon immediately rises to $360 per ton of carbon, and the green transition accelerates. So the risk of assets being stranded is one, it's priced in financial markets, but secondly, it's also priced in by the governments if they're in action, that they do more vigorous climate action to try to minimize that, to make the chance of that financial stranded assets lower. So the financial markets also price it in. You get higher premium for brown and green assets, and the price of brown assets is sizably larger than in the paths without stranded assets. So here you see it. You see the share of brown assets now goes down much more quickly. That's the acceleration of the green transition I have. So when there's a possibility of stranded financial assets, climate policy is more ambitious. You see the temperature is now rather lower. It's much below 2 degrees rather than higher than 2 degrees. And you see that negative emissions, they drop down much more quickly than before. So the risk of stranded financial assets has this strange effect that if governments get into action, they take more aggressive climate action, and then oddly enough, that's costly, but oddly enough, more action is taken. So you see that here. You see here that the carbon premium is now rather higher than before. You get a lot more precautionary saving. I read that from the top left diagram, and there are some paths with the different ratios as well. So here you see that only 50% of paths contain stranded financial assets, and they occur mostly around 2080. The stranded capital paths are a percentage only about that. So the stranding is trying to be reverted, to try to be mitigated by actually taking more aggressive climate action. So it's also important to realize that this negative emissions technology, this DACCS technology, is crucial for mitigating the likelihood of stranding assets and increases the likelihood that the brown technology may eventually be taken out of the mothballs and maybe put in operation again. So basically, brown technology is mothballed during these stranded financial assets, but at some future case, if you have negative emissions technology, you may bring it into operation again. So these are some of the insights. So more generally, I think this is just only a model. I think it's a fairly simple model, but it's quite complicated. But the main point is I want to say that most of these integrated assessment models being used now, they're not very good on stochastics. They rarely have physical risks. They usually have damages, of course, of global warming. They usually have, but they don't have these extreme weather events. Some of them do, but beginning to get, their tipping points are only one paper. But then the combination, how that interacts with transition risk, how that interacts with political economy, this is not the be and end all. This is just a first study, and it's many things wrong with it. You could take different choices. But all I want to leave you with the impression that I think we need more work on political economy. We need more work on delving deeper into the mechanisms of transition risk and political economy, and how if you screw things up by dealing with climate risk, that's what politicians inevitably will do. Yeah, how that interacts with, in a general equilibrium framework, with asset prices, with the green transition, and with government policy in general. So I'll leave you that. Hopefully there's some time for discussion. Thank you.
Thank you very much. This is very insightful. I love that you are putting together transition and physical risk. And in the first bullet in this slide, to me, is I always thought about it. I saw very few papers making that point. It's very important, especially for the US, that's my experience, that physical risk needs to be addressed. Otherwise, stranded assets actually is one of the biggest issues that we face in the US. Let's open the discussion. We are over time, so we'll totally fine, totally fine. We will have, this is a small conference, people can approach you during the coffee break or lunch or dinner. If there are questions, please.
So I'm just curious. So well, first, thanks for the presentation, because this is terrific. But at the beginning, you put this paper up in Nature, like this idea that mitigation costs are so much smaller than the cost from climate change. And so why is it that we can get our acts together, basically, and implement policies? So the costs might be small, but they seem to be concentrated. Like they're unevenly distributed, either within a country or across the world. And I'm kind of wondering, what do you think? Where is the biggest impediment? The fact that you have free rider problem across the world, or it's more like within a country that the costs are unevenly distributed? And you had two sectors, so it gets at that a little bit. But I guess it's much more complicated when you take a global perspective.
Yeah, I have separate papers on international climate negotiations, which is again political. We've had more than 30 years of climate summits. Zilch came out of it. Well, I'm being I'm not being unfair. More, if you round it off, it's zero. So it's very disappointing. And that's because, why does it not happen? One, the costs come up front. So you probably need some government debt because you're making sacrifices now to help people in the future. So ideally, you want the future people to pay for it, so you run up a government debt. But of course, people don't like running up government debts. You wouldn't make you popular with your prime minister if you suggested that. And secondly, of course, more importantly, you need to compensate those that lose, which includes countries like Russia or Algeria or Nigeria, those who hold a lot of those fossil fuel assets. You need to bribe them to keep the stuff in the ground. And you also need to help those countries that are that poor, have such high marginalities of consumption that they say, we want to eat, we want to have shelter. We're worried about that, and climate policy second. So there's huge political issues on the global scale which I have not touched upon. But so just as there are political issues within a country. So I mean, if you try to do climate policy, when I was in government, I did two big mistakes just for the break. One, I said, let's tax the royal family. Within a half an hour, the chauffeur of my prime minister arrived at my house, picked me up to take me to the prime minister, and I got slap, 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 slap. So I thought, well, I'll try to make a better impression. So I went on the front newspapers, big chocolate letters. Van der Ploeg is in favor of carbon taxes. But that's what I thought it would say. But of course, they didn't say that. They say, Van der Ploeg wants to take your car away. So that, of course, my political party went down in the polls. So the car, the limousine of the Prime Minister, again arrived at my house. I got picked up again, and then I got a very tough talking. You see, if you do this once again, you're out. And I was still quite a prominent MP. And then he said to me, we're only going to do climate policy if the Germans do it. If you can show me somewhere where they're ahead, then I'm going to jump. But I'm not going to jump if somebody else jumps. That's your free rider problem. So I think these international political issues are, I've talked about the stochastic and transition risks like that. But there is this issue of political tipping, and may I make a jump to your paper, Maximilian. So this ETS thing, I think of it, once we've got the carbon tax, the CBAM, so there's going to be a big wall around Europe. There's going to be a big trading zone. Everybody wants to trade with them. Now imagine you're Vietnam or Turkey. Then you won't have to do all your administration right, blah, 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 and then to pay a tax to Europe. So if you think about it, if you were the finance minister of Vietnam, you say, what a crazy thing. Let's do our own carbon tax so that we can keep the money in our country rather than give it to Europe. So what I expect is going to be huge positive tipping points that maybe Vietnam, Turkey, once we've got it, that many other countries will tip, and let's do carbon taxes as well. You get these strategic complementarities on the international level, a political tipping point, and then suddenly it may work in our favor. So that ending on a positive note. Yeah.
I think we have time for a very, very quick question before the coffee break. When do we restart, please?
We can reconvene at 11:40, so we'll stick to more or less 15 minutes. Okay, thank you.
Thank you.
Okay, can we restart?
Okay, maybe we can start session 2 on modeling the green transition. I'm again Koji from BIS, and I'm going to chair this session. So the same rule applies. So we have 2 papers and 40 minutes for each, and including Q&A session. And please postpone like fundamental question in the end, so we correct the question. So just interrupt when you have a clarification question. Okay, so our first speaker is Florencia, who is going to talking about the green metamorphosis and of the small open economy. Okay, floor is yours.
Thank you. Hello, everyone, and thank you so much for including my paper in the program. I'm really happy to be here. So this paper is called The Green Metamorphosis of a Small Open Economy, and is joint work with Evi Papa and Hernan Seoane. And as I work at the Federal Reserve, the standard disclaimer applies. So these are my views, not the ones of the Federal Reserve System. So the motivation for writing this paper is the following. Many small open economies, and especially emerging countries, are lagging behind in the adoption of clean energy. And this is true if we look at different measures, such as the ratio of renewable sources of energy over total energy, or if we look at the installed capacity to produce renewable sources of energy. And one of the main reasons behind this is the presence of very low or even inexistent fiscal incentives to adopt the green transition. So most of these small open economies, and especially Latin American countries, lack they lack the presence of a trading market system. They have very low or inexistent carbon taxes, and most of them still have subsidies to fossil fuel energies. So even though these small open economies may not individually make a really big contribution to global emissions, if we consider them as a whole, they certainly provide a sizable contribution. So it's very important to also look at these economies and try to incentivize the green transition in those countries. So in this paper, we propose a canonical model to study the macroeconomic impact of the green transition in a small open economy by looking at alternative fiscal policies. So here we are looking at the green transition that is triggered by different fiscal policies, and are going to study the implications of several macro variables. So the main features of this model are the following. This is a new Keynesian, a small open economy with endogenous growth and 2 types of energy, green and brown, where green represents renewable sources of energy, and in this case, it is endogenously produced in the small open economy, while brown energy represents the polluting sources of energy and is exogenously determined in the small open economy. So in our calibration, we're going to have that this country imports energy from the rest of the world. The second main feature is given by endogenous growth, that in this case is modeled as directed input-saving technical change between energy and other inputs of production, labor and capital. And here we follow the methodology of Hassler and co-authors. And here the intuition is that even though the elasticity of substitution between energy and other inputs of production may be low in short terms, so firms are restricted when they face a price in the energy inputs of production, for instance. What they can do is to reassign researchers or to invest in other R&D in order to improve the efficiency in the use of energy, and through this they can increase the substitutability between inputs in longer horizons. So this characteristic of the model, together with the endogenous production of green energy, are going to embed the model with supply-side effects of the green transition, and this, together with considering the open economy aspects of the model, constitute the main contributions of this paper. Finally, what we do with this paper is to calibrate it to Chile, that is a representative small open economy and representative emerging country. And we study policy-induced green transitions. So here we start by studying carbon taxes. This will constitute our baseline transition. And then we are going to compare it with green subsidies and with public investment in green capital. Okay, so I'm going to be more specific in a few slides, but here we are going to have traditional capital and also a specific green capital that can only be used to produce the green energy in this economy. Through this, we offer a laboratory to study policy evaluations and welfare implications of the different policies. So let me skip the literature and go directly to the main features of the model. So as I said, this is a small open economy model. We have a representative household, the production of two types of energy, brown and green. We have an intermediate sector, that is where nominal rigidities appear. So here we have a variety of firms producing intermediate goods by combining brown and green energy together with labor and capital. And then the final good will combine all these varieties to produce the domestic good that can be traded internationally with the rest of the world. And in the middle, we also have the fiscal and the monetary authorities that will be applying the different policies in this economy. So now I'm going to present the main features of the model. I will not present all the optimization problems, but please keep in mind that behind we have many standard characteristics that come from small open economy models, for instance. So this is the optimization problem of the representative household in this small open economy. And we have that the problem consists in maximizing lifetime utilities subject to budget constraint and two law of motions of capital. So here, KT+1 stands for the standard capital, while SG represents the specific green capital that can only be used to produce the green energy in this economy. So here, the household is in charge of accumulating the two types of capital. And that is why they have to choose two types of investment and the final stock of these capitals, together with consumption and two different bonds, B and B star, which are both one-period maturity and nominal bonds, but the difference is that BT is issued by the government and B star can be traded internationally and is in foreign currency. So this gives rise to the presence of the exchange rate, and also of the sovereign spread, that is one of the main features of these small open economies. On top of that, we have that households receive the profits from all the firms in the economy, and they have to pay lump sum taxes to the government. Intermediate good producers, we have that they produce in a monopolistic competition setting, as in the new Keynesian literature, and they are subject to Rothenberg adjustment costs. And here we have that the technology to produce the variety I depends or has this functional form, where firms combine traditional inputs of production, capital and labor, together with energy. And energy is a composite of the two types of energy, green and brown, which are imperfect substitution in the production of the final good. Now, notice that in the short term, the elasticity of substitution between energy and traditional capital and labor is fixed. But as I mentioned before, we are going to have input-saving technical change embedded in this technology, in this production function. And this appears through AT and AET, which stands for the efficiency in the use of different inputs of production, which are endogenous. And in the following slide, I will provide you more details. Finally, when I talk about carbon taxes in this model, I will be talking to a tax, or I will be referring to a tax to the consumption of brown energy. Why is that? Notice that here I never mention any externality or even carbon emissions. And the reason is that typically in the literature we model this as a cost to total factor productivity that depends on the total stock of carbon in the atmosphere, which depends on local emissions and global emissions. But here I'm talking about a small open economy, which contribution to global stock of carbon emissions is less than 1%. So that really doesn't play a big role in this model. Okay? However, in the paper we also provide an extension where we try to proxy this cost or the cost of consuming fossil fuels in this economy. Well, directed technical change is modeled in the following fashion. We assume that there is a stock of researchers normalized to 1 and represented by the letter N, which can be assigned to improve productivity in the traditional sector or improve efficiency in the use of total energy. However, as you notice from the functional forms, there is a trade-off between assigning researchers to one sector or the other because you are affecting the growth rate or the productivity in the other sector. And we assume that the allocation of researchers is also a choice variable by the firms. Well, green energy production here is the following. We have that firms maximize profit, but profits come not only from the sales of green energy, but also they can receive a subsidy from the government when they produce more green energy. And they have to pay the returns to green capital that we assume the total stock of green capital is a composite of the specific green capital that is accumulated by the private sector, so the household that I just mentioned 2 slides ago, or the government. So here is where the last fiscal instrument will play a role, and is given by the public capital that is accumulated by the government in this small open economy. Okay. Well, finally, omegas tell us if these private and public green capital are substitutes or complements in production. Okay. Brown energy, as I mentioned, is exogenously given, can be traded internationally at the international price, which is in foreign currency, so that is why the real exchange rate will also play a role in determining the domestic price of brown energy here. Well, and to close the model description, let me see. We have the government. So here we assume that the central bank is a standard. It follows a Taylor rule and tries to stabilize inflation and output to their steady state levels, while the fiscal authority has to satisfy a budget constraint that depends on the different fiscal instruments and also on the lump sum tax to households and the government debt. So from here we can already preview that these different fiscal instruments are going to have a different impact on public finances. And finally, we have a tax rule that tells us that even though this transition could temporarily be financed through government debt, in the end, the government has to ensure the debt sustainability, so taxes will have to adjust, and in the end, the domestic households are the ones that will pay for the transitions or the changes in these revenues for the government. Well, now let's go to the solution and calibration. First, just to mention, here we have a balanced growth path. we have to impose some conditions on the growth rate of different variables in order to attain it. In the paper, we show the details of that. And today, I'm not going to show you the variables in level, but I will show you the stationarized variables. Okay. Now, we solved the model for the perfect foresight solution, and where calibration strategy consists in targeting first-order real business cycle models for, real business cycle data for Chile in the initial steady state. So we want to reproduce the average moments in Chile at the initial of this transition, and then we are going to change the different fiscal instruments, and this endogenously will take the economy towards a new steady state. And we are interested in this transition, or in how different macro variables behave along the transition. So I will not describe all the calibration, but just let me tell you that we match, or that we calibrate some parameters to match, for instance, the average inflation rate in Chile, which has been 4%, the average debt to GDP level of 16%, public spending to GDP, we also, and the country spread. We also look at the literature for some standard parameters, and also to specific papers that estimate the Taylor rule in this country. And in the case of energy, we have, well, mixed strategy in the calibration. First, we take some parameters from the literature, for instance, the elasticity of substitution between the two different energies. Okay? In this paper that we cite, they present a range of values. So in our baseline, this is the value of the elasticity of the parameter that characterizes the elasticity of substitution, but then we provide sensitivity to these values. We also have data for the ratio of imported over total energy consumption in this country, with each roughly 50%. And, well, for instance, private and public investment in green capital are substitutes. This comes from a previous study. However, to be fully honest, their studies look at all, total investment, total public and private investment, not green investment, and we lack of good data in order to calibrate a bit better this parameter. Finally, we calibrate some parameters together in order to match some central moments, such as the ratio of brown energy over total energy, which is 72%, and different ratios of investment in this country. Okay. So if there are no questions about model and calibration, let me go to the baseline transition.
One question.
Yes.
So in the table you showed us, so the share of brown energy is 30%, means only 30% of like electricity comes from fossil fuels in Chile?
No, brown energy over total energy is 70%. So green energy is 30%.
Ah, okay.
Yes, but this is not only electricity.
Okay,
this is the
general,
whole consumption.
okay.
Exactly. Okay. So our baseline scenario consists in a carbon tax hike from $5 per ton to 35. Okay, you're going to notice that these values are really low, but these are the values in a country like Chile. And still, this implies an increase of 7 times the price of carbon. And, well, starting from the initial steady state, we assume a 40-year transition. However, this carbon tax is implemented in the first 15 years. We also do some sensitivity in the speed of introduction of this carbon tax. And this tells us that the transition generates roughly a 35% decrease in the consumption of brown energy over the whole period. So let me show you the behavior of the main variables. I will try to have the mic. So we have that when the carbon tax is or increases in this model, the price of brown energy increases, and this is what generates the fall in brown energy of 35% after 40 years. Now, this increase in the carbon tax generates a substitution of brown for green energy. However, given that it's necessary to accumulate the green capital in order to face the demand for green energy in this economy, the supply takes some time to react to the increasing demand of green energy, and that is why the price of green energy increases under this baseline scenario. So notice that here the price of both types of energy, green and brown, increases. So this puts some upward pressure on marginal cost in the firms that produce the intermediate good, and this ends up generating inflationary effects in this economy. So here we have that inflation increases from 4 to almost 9% in the first year, and even though this starts to decrease after one period in the transition, it remains above the initial steady state level for many periods. So this increase in inflation is quite persistent. Second, we have here that now energy is the expensive input of production because both green and brown energy are more expensive under this scenario. So firms react to this by trying to reallocate the researchers from one sector to other. Here, researchers represent the fraction of researchers that are assigned to the efficiency in the use of traditional capital. So here, firms are reassigning them from the traditional sector to energy in order to improve the efficiency in the use of energy to decrease the cost of production. That is why, at the end of the transition, the total energy consumption in this economy goes down because they have become more efficient in the use of it. But at the same time, the productivity of traditional capital decreased, so that is why capital investment goes down, and this ends up generating a recession in this economy. That notice that quantitatively this is not very high, but still output, the trended output, is below the initial steady state for the whole transition period. So, sorry, and finally, even though GDP goes down, the carbon tax implies higher revenues for the government. So under this scenario, we have that debt to GDP decreases in this economy. Okay, so the fiscal cost is not a feature of the introduction of carbon taxes, as we are going to see in other policies. So to summarize, the carbon tax here generates a reduction in brown energy consumption of 35%, but is associated with greenflation and a recession. Now, yes?
One question. Does the different effect on prices depend on different stickiness of the two sectors? Or?
Yes. Well, here we have that the intermediate good producer is the one that has the nominal rigidity, so there is one parameter that characterizes stickiness here. But we do some sensitivity analysis with respect to that parameter, but actually, yes, we cannot measure how different sectors, yes. But thank you for that. Yeah.
The inflation here, is it 8% of inflation or 9%?
Yes, so this is the gross rate of inflation. All the variables are in percentage deviations from the steady state except the inflation rate. So here, the average inflation in Chile since the 90s is 4%, and this transition would imply a jump to almost 9% in the first period, and then this goes down. Okay. So in the paper, we provide different sensitivity analysis to many of the parameters that are key to determine this transition. But just let me tell you that, of course, the quantitative results change, but the qualitative conclusions are the same when we change these parameters. Okay. And in the paper, you can check what happens when we change the different elasticity of substitution between different inputs of production. We also look at the exporter country, so what happens if this country has more brown energy than the one that it wants to consume, and also look at complementarity in the green capital. But for today, let me move on to alternative fiscal instruments. Yeah. So, I mentioned that carbon taxes decrease brown energy consumption by 35%. What about other instruments? Well, the first conclusion is that we need huge fiscal expansions in order to generate the same reduction in brown energy consumption if we only want to use green subsidies or public investment in green capital. Why is that? Because they mainly expand the green sector, but they are not able to, or they need to be really, really high to crowd out part of the consumption of brown energy in this economy. So in the case of green subsidies, we find that they can achieve similar decrease at the end of the transition, only if they are raised to 300%, representing 12% of the GDP, while investment in public green capital has to increase from 0 to 7% of the GDP. So huge fiscal expansions. We don't think that they are implementable, of course, but I would like to show you the transitions that they would generate in order to compare the dynamics. Okay, in this plot, we are comparing the transition results from the carbon tax in blue, the same that I showed you before. And in orange, we have the transition generated by an increase in public investment in green capital. Remember the stock of capital that we need to produce green energy. And the main differences are the following. So when the government starts to accumulate capital or to invest in infrastructure to produce the green energy in this economy, we have that the productivity in the production of green energy increases, and that is why the green sector expands at the same time as we have a reduction in the price of green energy in this economy. So now, this increase in productivity in the green sector generates a downward pressure in marginal cost for firms, because it's possible to consume energy at a lower price if you substitute enough green for brown energy, brown for green energy. And this ends up generating dynamics with the opposite sign that I described before. So here we have deflationary pressures or negative pressures on the inflation rate coming from this policy. And at the same time, firms try to allocate more researchers from energy to the use of traditional capital, because now energy it has a lower price. Okay? This triggers an increase in investment in the traditional capital, and that is why it's able to avoid the recession along the transition. However, as we mentioned before, this is associated with huge fiscal cost. So here we have that debt to GDP increases almost 200%. Okay? It was 16%, and this would imply an increase in 200% in that debt to GDP. So these are the downside of this policy. Yeah.
So how should we compare the two instruments, in the sense the scales seem different? So is there a variable that you target that has the same dynamics over time or not?
Yes. So here I'm showing you the first 40 years of the transition. However, many variables are very persistent and they take longer to converge to the new steady state. But these variables end up in the same level. So the reduction in brown energy is the same. Now, we would like to have identical path, but we couldn't generate that. Finally, what happens if we compare green subsidies, and this is in yellow in this plot. So here the dynamics are very similar to the one generated by the public investment, but the main differences are that here the price of green energy goes down even without improvements in the productivity in this sector, in the production of green energy. And that is why firms try to substitute faster brown for green. And then the price of brown energy can even go down at the beginning of the transition because demand decreases really fast. Second, here what we have is that the demand for green energy increases a lot at the beginning of the transition, but someone has to accumulate the green capital in order to be able to face or to respond to that demand. So households here are substituting traditional capital and also consumption for investment in the green capital in order to be able to face this demand. So they are investing like crazy in the green technology here.
One question.
Yes.
I didn't understand why inflation goes down, actually. So it's like a government spending shock, this one, right? Government spending tilted to the green sector.
Yes, and also...
Or it's a recomposition to green and out of the brown sector.
Yeah, so the first mechanism that you mentioned is part of the story, but also we have that the price of energy decreases. I think that the energy is a composite here, and the price of green energy is going down in the two instruments, in the subsidy and public investment. And in the second case, also the price of brown energy can decrease temporarily. So this decreases the marginal cost and put downward pressures on inflation. Okay. 2 minutes? Okay. Let me wrap up. So, well, the conclusion from this part is that cost of transition depends on the fiscal policy instrument. As we mentioned, carbon taxes generate inflation and output losses, but public investment and subsidies are deflationary, and even though they are able to avoid the output losses, they come at the cost of huge fiscal costs, so huge fiscal debt to GDP here. We also look at the role of monetary policy, but we find that it can moderate the greenflation in the case of carbon taxes, but the output costs are still there, and fiscal costs can even increase in the carbon tax because now the debt service will also be higher if the central bank reacts stronger to the rise in inflation. Now, the natural extension here is to look at the policy mix, so some kind of policy recycling, but through different fiscal instruments. So what we do is to look at the case where the government uses the revenue from the carbon tax in order to finance public investment or subsidies in the green sector. And we find that through that, it's possible to alleviate some of the unintended consequences. So I don't have much time to talk about welfare, but let me tell you that we look at welfare as consumption equivalence from the initial steady state in the baseline, and then in externality extension, where we consider that brown energy can decrease consumption in the economy. You can think of this as either health cost from pollution or some kind of retaliation from the rest of the world because you are still consuming a lot of fossil fuels. And in the baseline, we find that the transition here is costly in terms of welfare, and this makes sense because we don't have any, or for these small open economies, the benefits of going through the transition are not that clear, but the costs are there in terms of consumption and possibly higher debt to GDP. Still, in the ranking, we find that carbon tax is the best instrument for this economy. But if we extend the model to consider externalities from the consumption of brown energy, then the transition could could increase welfare, but the ranking doesn't change much. Well, let me skip the part about policy mix. Just to mention, without externality, households would prefer no intervention at all in this economy, but that would generate no reductions in the consumption of brown energy. So we have to think about this problem as a constrained optimal policy where we want to attain certain level of reduction in consumption of brown. So the conclusions are there. Thank you so much.
Thank you very much for the great presentation. So let's open the floor for questions, comment.
Is it costly having an increase in public debt in your model? Or, I mean, it just doesn't matter whether the government sets a fixed, a constant level of public debt along the transition?
Yeah, so this matters for welfare and for households because we also have the fiscal rule. So in the middle taxes, lump sum taxes that are paid by domestic households will be adjusting to at the end of the transition, generate the consolidation of that debt.
But they are neutral, right?
Sorry?
So lump sum taxes are neutral, right? So suppose that the government says, okay, during the transition, public debt will be always zero. So carbon revenues will be distributed through lump sum transfers. Would this change the impulse responses, or the impulse response will be just the same?
So what we want to do now is the scenario where debt to GDP doesn't increase under a policy mix. So we want to combine carbon taxes with subsidies or carbon taxes with public investment to generate exactly the situation that you mentioned, so no increases in public debt. I still cannot tell you which are the macro dynamics of that scenario, but yes, they are going to be different between consumption and investment in the different capitals are going to change.
Okay, thank you.
Okay.
Yeah, one suggestion I would have, to me, it wasn't obvious what the small open economy role, like what was the role of the small open economy in generating the results. I think like it would benefit to maybe have, kind of a section, just a pure macro framework, and see like what's playing a role in generating maybe some of these impulse responses from the open economy dimension. And then I think like it wasn't clear why using lump sum taxes, maybe like it's related to the other question. It seemed like that's kind of important. In fact, when you finance, let's say, public investment through lump sum taxes versus distortionary taxes, I mean, you're solving this. The model could just use distortionary taxes. I think would be more convincing.
Yes, thank you so much for the comments. Yeah, we certainly could consider distortionary taxation. And related to your first question about the small open economy features of the model, so today I didn't go through the details there, but we also show the dynamics of the small open economy variables, such as the real exchange rate and the trade balance in this economy, and the spreads of the debt because these are typically main variables in a small open economy, so main drivers of the macro effects there. But yes, I didn't spend much time explaining them here. Just to mention, in the case of carbon tax, resembles a sudden stop in this economy. So when you introduce it, also the exchange rate, or we have a depreciation and an increase in the trade balance due to this policy.
A quick one. So probably I didn't get it through the presentation when you showed the different path of the debt to GDP for the green subsidies and the policy and the public investments. So are you implicit, because there is quite a difference, are you implicitly assuming a different multiplier effect of the two policies?
No, we don't assume a different multiplier, but as they enter in different parts of the budget constraint, well, for sure carbon taxes increase revenues while the other two instruments increase expenses. And then the final impact over GDP is endogenous, so it depends on the dynamic of the brown energy, for instance, or the green energy that is typically multiplying the variables. Yes, did I respond? Or
No, I was quite surprised because probably I didn't get the exact definition of the two interventions, but there was quite a difference in the impact that they have on the debt to GDP. So just to understand what was the rationale of this wedge, let's say.
Yes, okay, let me maybe, sorry for this. So here we can see that other endogenous variables in the model will be affecting this ratio of debt to GDP. Well, first because they affect output or GDP in different measures, and also because endogenously the other variables will be changing, so the final effect can differ. But yeah, we are not imposing different multipliers per se.
So you may ask the question, if you spend $1 on public funds, and you either use it for a green subsidy or for a public investment, or you can even also look at carbon taxes, what gives you more bang per buck?
Sorry, will give me more what?
What gives you more emissions reductions per buck? So you could calculate with your model, like what's the, now I walk away and I don't know which one is more effective in a way, but you could do like a bang per buck ratio.
Yes, yes. No, absolutely. Thank you for that suggestion. We definitely can do that. I mean, we briefly mentioned that you need to spend more in order to attain a reduction in brown with the the supply side fiscal or green fiscal measures, but of course we can do it by unit of emissions.
So if your cost of carbon, you know, to get the same emissions reduction as the cost of carbon, how much money would it cost you?
Yes.
With these two other instruments, and you could do a cost-benefit analysis, but it doesn't quite. It's just one step further, and then you're there.
Okay. Yes, absolutely. Thank you. Thank you for that.
Maybe we are a little bit behind schedule, so thank you very much. Okay, let's move on to the next speaker. Next speaker is Gauthier Farmander from École Polytechnique, and who will talk about the new Keynesian climate model. Floor is yours. Go ahead.
So thank you very much for having the paper included in the program. I know I have to keep your attention alive for before lunch, so it's a big task. So this paper is a joint work with Jean-Guillaume and Frank, and in this paper we intend to update the new Keynesian model by having the climate to be included, but in the most simplistic way. So as it was also discussed today, we can think about the future of macro based on climate, and you can see two possible scenarios in the future, which are extreme. The first one would be a planet in which we would experience an increase in temperatures. We would end up with more damages, aridification, weather shocks, and these will make resources to be much scarcer in the future. And we would end up with higher prices, and so we would end up also with climateflation. So the fact that the climate could bring more inflation. But on the other side, if we are more optimistic, which is not my case right now, but if we are more optimistic about the future, we could think about the government could implement a carbon tax in order to reduce carbon emissions. And obviously, this will make fossil fuels to be more expensive. It will make also our demand for specific raw material to increase, and we would live in a planet with more inflation. And so greening the planet will imply to have more inflation in the future. And so the question is how the central bank could manage those events. And so to answer this question, we need to have some models which can analyze the question of green and climate inflation into a baseline model. So obviously the new Keynesian model, our beloved new Keynesian model, has not been built to take into account the climate. So what we do here is that we propose a new Keynesian climate model, so we call it NAKC, in which we're going to extend it by taking the core ingredient of the integrated assessment literature. So I don't know if you're familiar with integrated assessment literature, but this is the pool of models that is used by IPCC to make predictions. And so basically in the media, you may have seen those paths of temperature, GDP, and so on, which are really smooth because these are long-term models. And so, for instance, Rick presented some paths of IPCC based on those models. So we are going to take the core ingredient of this literature. Once we have our new Keynesian models, we are going to estimate it, and so we will bring it with Bayesian techniques, and we will try to keep nonlinearities to be as accurate as possible. And so once the model is estimated, we're going to make out-of-sample forecasts based on specific different scenarios of carbon taxes. One in which there is no implementation at all, and so the planet will keep warming, or the other one in which we implement a carbon tax, and so in that scenario, we will experience a greenflation. And so if we're able to explain the mechanism on inflation, we will be able also to explain what's going on for monetary policy in any of these two scenarios. But when we work on the climate, I mean, in macro, there is a big issue which is related to the climate problem. So in macro, we usually have really complicated, sophisticated models with a lot of nonlinearities. But when we go to the numerics of it, we linearize them around some fixed point. And the issue is that with the climate, we don't have the fixed point anymore because the fixed point depends on how much or how quick we reduce carbon emissions. And so to get around this situation, we're going to use the Fair and Taylor extended path approach, which is a way to take into account non-linearities, but also keeping the cyclical effect from the realization of shocks. And we're going also to update the fair and Taylor approach in order to estimate it, in order to be able to make some estimation of the D parameter and use it for forecasting purposes. So this paper is going to be connected to 3 different fields of the literature. The first one is the IM model, so the integrated assessment literatures. And these type of models are really long-term oriented. And so if you're familiar with this literature, it's really smooth path that they provide with their model. And so they do not pay attention for fluctuation. So these models are not really useful for stabilization policies and so for central banks. And they also do not consider price rigidities. And so if you have a look at this literature, the level of inflation is not something important. And so we want to change this by having inflation as a core variable of the model. There is a second strand of the literature that is related to implementing the DG model with some environmental constraints. And so these models are accurate at the short term to make some prediction about carbon tax changes, but do not take into account the accumulation process from the demography, from technology, or for climate trends. And so the last strand of the literature is based on the new Keynesian literature, so the one of the textbook of Woodford, into a small-scale model or medium-sized scale model, such as the Smet and Wouters model. So the presentation I will do, I will show you first the new Keynesian model. So it will be pedagogical, so I will start with the simple 3-equation new Keynesian model, and I will add some ingredients for the question that we answer. The second part of my presentation will be about the estimation, so how we change the fair-Taylor approach in order to estimate the model and make it quantitative. Next, I will analyze the path of green and climateflation, and if I have enough time, I will show you some preliminary work on monetary policy trade-off. So let's go on the new Keynesian climate model. So let's have a look first at the one in the textbook, but we don't use the linearization technique as in Woodford, so we just keep those equations in a nonlinear fashion. And so you may recognize the first IS curve, the second the price setting curve, and the last one the monetary policy curve. And so the first equation is the IS curve, which relates consumption to future consumption in the future. And you have this negative relation between real interest rate and consumption now. And because we want to work on GDP, we're going to translate and convert any variable of consumption, any consumption into output equivalent through this additional auxiliary variable. The second equation is the Phillips curve with the Rothenberg pricing. So this is basically inflation now is determined by the discounted sum of marginal cost in the future. And so the marginal cost here is simply related to the labor market. And so this is the no arbitrage condition from the household on the labor supply. And so the last equation is the monetary policy curve, which was also embedded in the presentation of Florencia before. But we also have the shocks, the demand shock, the supply shock, and the monetary policy shocks. So these shocks are really standard and are just meant to capture the cyclical component of the data. And we also have some specific trends. So in the new Keynesian model, some models have trends, some others don't. Here we're going to have some specific trend, and this one is quite important. It's the inflation target trend. Because I will show you in sample, we do have a lot of structural decline in inflation at the world level, and this is the world level. We want to accommodate that by having an exogenous process for inflation that we will estimate that will capture the structural decline that we observe at the world level, which can be explained as a narrative for the adoption of inflation targeting regime in the world. The second trend that you may have in new Keynesian model, for instance, in the Smet and Wouters model, this is you have some technologies that is exogenous, and so the slope of technology is fixed. And actually, in IM model, most of the technology process is actually deterministic, and will capture the structural decline that we have in the growth of TFP over time. And so here we just do exactly the same. We are just going to estimate how TFP is increasing, but less and less over time in order to accommodate the structural decline in growth that we have in sample. As we work on the new Keynesian model, maybe you're familiar with some kind of controversies that we face when we use this model, especially when we have to work with expectation policies that are announced in advance. And for the green transition, this is exactly the same issue because we're going to announce some carbon tax pass in the future. And when we do that with the new Keynesian model, the model is extremely forward-looking and we get extreme results in present value terms. And so some ways to accommodate this is to include some attenuation challenge on the expectation side of the economy. And so here we're going to use the Mackay approach and a BILB approach in order to implement some discounting in the Euler and the Phillips equation. And just to give you the intuition back in the three equation model, you can see in red the differences with the new Keynesian model, in which there is some discounting in the Euler equation. And so omega is that probability for the household to have some income risk and to be unemployed. And if he's unemployed, he will simply consume D, that is a transfer from the government. And this way, you can see that the higher omega and the lower the effect of expectation on current output. The second one is discounting on the Phillips curve, which is simply a signal that firms have each period of leaving the market, of exiting the market, and if they do so, they simply consume their dividends. And once again, the higher the VAR theta, the lower will be the effect of future marginal costs on current pricing of firms. But now I can also discuss about the climate, so how the climate is going to affect the new Keynesian model. So let's do it in the most simplistic way. And so we propose here to simply keep to track the climate change. So this is the climate change equation, the CC equation, by simply tracking the number, the level of the carbon stock that we have in the atmosphere. And if we know the carbon stock, we can predict temperatures and so predict also the damages that you get when the carbon stock is increasing. And so the carbon stock is a slow-moving process, extremely slow-moving process, such as any decision that we take not to reduce carbon emission will have implication for a long period of time, for decades, because of this slow-motion process of carbon stock. So carbon stock in the atmosphere is increasing through carbon emission, and so the right term that you have in this equation is the level of emission, and actually emissions are typically proportional to output, but is adjusted with some exogenous technology, which is called in the field the decoupling rate of carbon emission. And so once again, we are going to borrow on the IAM literature by having a decoupling train that is an exogenous process that we will estimate. And so sigma will also naturally decline over time through some exogenous technological change on energy efficiency, but that will not be enough to avoid climate change. And so on the right-hand side, you have the level of GDP. And you know the carbon stock, it's the cumulative process of the carbon stock that triggers climate change. This is why we cannot use our usual detrending approach, our tricks that we use in growth model, in which we stationarize the model by detrending. Here we cannot do this shortcut because we want to have the cumulative effect to play a role on the equilibrium of this economy. So the emissions are determined by the TFP level, so how much we produce based on technological gains on the TFP side of firms. We also have the extensive margin part of emission. And so L is once again the deterministic process that will capture the UN forecast of population that should reach 10 billion of people by the end of the century. And the last one is a shock in order to capture the cyclical component of emission in sample. So if we have carbon emission, the usual way to implement, to have an effect of the climate on the economy is to have those damage function in a similar fashion than in the presentation of Rick. And you can see here that if firms are getting less productive because of climate, it's going to affect their production function, and this will materialize in the new Keynesian model by increasing the marginal cost of production. So we have a positive link between the carbon stock in the atmosphere and the marginal cost of production for firms. And obviously, this will have some implications, some structural implications for the inflation rate. We can also have some carbon taxes. So we're going to have the usual microfundation, in which we'll have some mitigation possibilities, some abatement possibilities in a very similar fashion as in Francesca's presentation, in which we can implement some mitigation policy, some abatement efforts. So we rewrite all this abatement effort in proportion of the carbon tax. And so tau here is going to be an exogenous carbon tax that we decide based on the path of carbon emission that we want to have in this economy. And so tau here is going to be, when we increase tau, is going to increase investment of the private sector to reduce carbon emission, and this materializes as an increase in green investment in the demand side of the economy. It will also affect the pricing of firms, because firms will have to pay the abatement cost. So this is going to be expensive for them to reduce their carbon emission, but they will also have to comply with the carbon taxes by paying the tax if they emit carbon emission. And these two effects are going to bring greenflation into the new Keynesian model. And the goal of this policy, obviously, is to reduce carbon emission. And so this is just the fraction of abatement that is written in proportion of the carbon tax. And so if tau here is 1, it means that we fully implement the decarbonization, so we have achieved the green transition, and so we stabilize the climate. If this is 0, we are in the laissez-faire equilibrium. So once we have this 4-equation model, we can use it to estimate the structural parameter of the model. And the way we do it is we are going to consider world data from 1985 up to the latest data that were available when we ran the estimation. And we're going to estimate, we have 4 equations, so we will have 4 endogenous variables to inform about the parameter. So output growth, inflation, interest rates, and carbon emission growth rate. But the way we achieve the estimation is going to be sequential. So for each iteration of the likelihood function, for each evaluation of the likelihood function given a set of parameters, what we're going to do is to first compute the long-term path of the economy, so the structural path of the economy, given some specific initial condition that we can possibly estimate, and the long-term equilibrium that is the true steady state of the model that we will reach, but in decades, in centuries. The second equation is the way we accommodate to include shocks. And so agents are going to be surprised by a set of shocks. And in order to keep the computational speed to be acceptable, we are going to use the extended path approach of Fair-Taylor. So we are going to shorten, the size of the horizon of the perfect foresight solver in order to update after the realization of the shock. And so S here is going to be the size of the window that we open for each realization of shock to update the path up to the fact that we go back to the deterministic path that we computed before. So as long as S is large enough, shock will have disappeared in the meantime, and then our approximation will be all right. And so the third equation is simply the measurement equation, so how we map a subset of endogenous variable to some observable variable. And the last one is simply the distribution of shocks that is meant to build a likelihood function. And so for each iteration of the likelihood function, we can compute, we can maximize it, and then we can use the metropolis hastings in order to compute the uncertainty on the parametric side of the estimation. The issue when we have to deal with the estimation of the model is that any policy that is implemented in the future, so basically policies after the end of our sample, will have some implication in our sample because of the expectations. So any of the expectation that we have in our model for the estimation is going to be built on some specific scenario that will happen in the future. And we have no idea, and I'm sure that you don't have any idea either, about the future of carbon taxes. And so the way we're going to accommodate that is simply to implement a path of the carbon tax. So we compute the path of the carbon tax that should be implemented at the end of the sample, in which we assume that the Paris Agreement is implemented, and so the carbon tax is increasing linearly over time, up to reaching the backstop price, in which we achieve the green transition by 2050. And then the carbon price will naturally decline as the backstop price decline as well through technological change. And what we do is that we're simply going to estimate the fraction of people that will believe in the realization of the Paris Agreement. And this way, we're trying to be as agnostic as possible and letting the data be informative about what is the stance according to the data about the future of environmental policy in the future. So once we have estimated, this is the calibration part. So we do calibrate some structural parameters, some state variable, and so on. We also estimate structural parameter related to TFP growth or to Rothenberg cost and so on. And this is once the model is estimated, this is the structural path, for instance, for TFP, population, the decoupling rate, how quick abatement is decreasing over time, how quick the inflation target is decreasing, and the path of the carbon tax from the Paris Agreement that I showed you before. So this is the structural component that is generating the path that you have here in red. And so basically, what you have in blue is the additional, Fair-Taylor approach in which we also include the shock and so the cyclical component of the data. And so you can see, for instance, that the inflation target decline is going to capture the structural decline in inflation. And if we don't have this trend on the inflation target, we will have, the model will accommodate with extremely large markup shocks that we don't believe in. So this is a way for us to purge, the data from the structural component of it. All right, so now that the model is estimated, we can use it for quantitative purpose and use it for forecasting. So basically, the way we're going to achieve this is that we're going to assume in our forecast that there is two possible scenarios, or three possible ones. One in which the agent was believing that the carbon tax was going to be implemented as in the estimate, so 53% of the carbon tax will be implemented, of the 53% of the Paris Agreement carbon tax will be implemented. And then at the end of the sample, they get the news that actually this carbon tax is fully implemented, so it's like a surprise for them. Or the opposite, Trump is going back to office, and so no carbon tax is implemented in the future. And this way we can accommodate some differences about the two extreme scenarios for the transition to a no green economy or to the green economy. And so this is in black the out-of-sample forecast of the model. So you can see the out-of-sample forecast. So this is in sample. And in color here, these are the out-of-sample forecasts based on different scenarios of the carbon tax. And so this is, for instance, the scenario when the Paris Agreement is implemented, or when there is no Paris Agreement that is implemented. And so you can see here that when the Paris Agreement is implemented, the carbon tax is meant to have the natural decline in carbon emission, such as we reach the Paris Agreement by 2050. If we don't do that, so this is a quarterly model, so don't be surprised by those numbers, because these are usually reported in annual terms. And so this is the emission that will keep increasing because of the population that is growing, because the economy is still growing, and this increase the flow of emission and hence fuel the climate issue. If the carbon tax is implemented, you can see that we have a quite large recession that is driven by the carbon tax itself. And next is followed by some kind of expansion that is driven by the green investment. And so I will go into the details in the next slides. You can have a look here as well. If we don't do anything, you can see that damages are going to increase. And this will make our economy to be 2% or more lower than the technological neutral trend. In terms of inflation, which is the goal of the paper, we do have more inflation if we go into the Paris Agreement because of the inflationary effect of the carbon tax. And so I will show you the size of the effect that is driven by the carbon tax. And so as long as the inflation is high, the interest rate of the central bank will also be higher in response. Because the model is really simple, when I mean simple, it's tractable enough in order to play and make some decomposition analysis, we can use it in order to split the aggregate demand equation into 3 complementary forces. So the first one is simply the consumption, and so the consumption from the Euler equation is simply the forward path of real interest rates. You also have the effect of green investment, so the fact that if we abate carbon emission, firms will have to increase their abatement, and this will have a positive effect on GDP. And the last term here is the kind of residual that is not really interesting with the question at hand, but basically the effect of the nominal cost from Rothenberg pricing or the cost of exiting the market for firms. So basically, this is the decomposition of the aggregate demand equation. So this is, you should recognize the graph that I showed you before. So the A panel is the graph that I showed you before. And we can split it into 3 different complementary forces. So the B, the C, and the D. The B about the effect, the IS effect. The C about the abatement expenditure. And the last one is the nominal cost. So I won't pay much attention to it. You can see that if we go under the Paris Agreement, we will end up with more abatement expenditures that would represent at the peak about 5% of GDP that should be devoted to reduce carbon emission. And by doing so, it should boost output, but not enough, at least at the beginning, because we do have an increase in the real rates of the central bank in response to inflation. And by doing so, we have a decline in IS, which will create the initial decline that we have following the implementation of the Paris Agreement. And you can see that at the end of the century, if the climate is stabilized, we will end up with 0.5% of GDP that is lost because of climate change. If we're in a laissez-faire economy, the damage are going to increase over time because of climate. And so you can see that this is driven by the IS effect, simply because the monetary policy will react to more inflation. And this will make the IS to be lower than its technological level. And this way, this will drive the output down by the end of the century. And this is the typical damages that you have, for instance, in the presentation of Rick, due to climate. If we look now at the PC curve, so at the Phillips curve, we can also try to do some decomposition analysis in order to look at green and climateflation. And so we just pick the marginal cost of production. And so you may recognize here the marginal cost from the textbook of Woodford. And we do have 2 new terms. One that is related to the damages from the climate, that will be the climateflation contribution, and the other from the abatement cost or the cost of the carbon tax, the marginal cost of the carbon tax. And so we're going to approximate the effect of these on the marginal cost, and if we can approximate them, we can translate them into inflation equivalent. So we're going to split inflation between the standard term from the labor market equilibrium, from the climate, and from the greenflation. And the rest here are just the contribution of shocks, and once again, I won't pay attention to the markup shocks.
So here, we're going to get inflation whatever we do, right? So either greenflation or climateflation.
Can you tell me again? I have some difficulty to hear.
So here in this model, we're going to get inflation whatever we do in terms of environmental policies, right? Yeah. So either we get climateflation or we get greenflation.
Yeah, we do have always inflation because the climateflation will bring you in a structural fashion additional inflation. greenflation will bring an additional point of inflation. So we always get inflation, and I can explain this through some general equilibrium effects that are probably different from the yours that you have in your paper. So we never have deflationary effect, even if we push the model as much as possible. So we do have a big robustness check section, and we really struggle to generate deflation. So once again, this is the inflation path that I showed you before, and we can split this into 4 different forces. The one that is related to the labor market, the one that is related to the climate, so this is the climateflation, the one that is related to the greenflation, and the one from shock that I will not discuss. And so let's have a look at the Paris Agreement, so the green one. You can have a look on D here, the greenflation. If we implement the carbon tax, the firm knows that in the future they will have to pay the carbon tax, and so this will create an additional force in terms of inflation that could be about 6% up to 7% of inflation, which is huge in terms of magnitude, even with the attenuation channel and the quite big nominal rigidity cost that we have in the model. So we're really conservative, but we get a huge effect on the greenflation side. But you know, this is not all the effects that are playing in the economy. We have the general equilibrium effect that plays here from the labor market, and you can see that because we have that boom in green investment, it lowers consumption, and this will make the wealth effect to play a role a lot on the labor supply side, and so the wage will fall in response in such a way that it will, you know, reduce partially the effect of the greenflation term, but not enough to avoid completely inflation. And so we have an add-on of 1% of additional inflation net that is driven by the green transition. And you can see that by stabilizing the damage now through the Paris Agreement, we still have a lot of inflation. I mean, the greenflation, the climateflation term is stabilized, okay, but not sufficiently. I mean, we still have 3% of inflation that will remain just because of climate change. Under the laissez-faire scenario, you can see that if the planets keep warming, the marginal cost of production will keep increasing because the resources are getting scarcer, and we could have, you know, a strong inflationary effect that is driven by the climate, up to 9% of inflation by the end of the century that could be driven by climateflation. And you can see that the disengagement, I mean, firms were expected to have a carbon tax that would be implemented, but the disengagement will contribute in the opposite side. The greenflation term will disappear because the carbon tax will not be implemented. And so in equilibrium, the standard term, the labor market will adjust, but because of the climate issue, the standard term is going to structurally decline over time. Okay, so for the 2 minutes for me that are remaining, I will show you a bit the big picture of what can do central bank in that context, or cannot do. So just to be the most simplistic in order to show you the first order effect, let's just change the parameter in the output gap, I mean the way central bank react to output gap imbalances in the Taylor rule. And so in the left-hand side here, you have the frontier in the short term, you know, between now up to the end of the transition, and on the right-hand side you have the same frontier from when the transition is achieved up to the end of the century. And so you still have here the deviation of detrended GDP from its technological level, so the square deviation, and the same one for inflation with respect to the inflation target. And this way we can see how the usual substitution of central bank between output and inflation dispersion are going to be affected over time by climate change. So what we can see here is that in the short run, during the transition, you can see that if we engage into the Paris Agreement, I mean, monetary policy will be less efficient. We will live in an economy in which the deviation in terms of output and inflation will be relatively larger with respect to the business as usual situation. And obviously, I mean, greenflation and the boom are going to drive the dispersion during the transition. But this policy has some goal, even in terms of efficiency of monetary policy, because you can see that in the long term, when the transition is achieved, we'll have a structural decline in the frontier of the central bank. That is due because we have solved the climate distortion, and so we will have the climateflation to play a role. The greenflation does not play a role, and so we will be net winner in the future in terms of efficiency of monetary policy. So short pain, but long-term gains from this achievement. But if there is no policy, you can see that we have a structural shift of the frontier on the right-hand side because we have more damages, which will make our economy to be even far from the technological level, I mean from the natural technological trend. And this will shift on the right-hand side as long as the carbon stock keeps increasing. And so it will be more and more difficult for the central bank to reduce those dispersion in GDP. So conclusion, so we have shown that we can explain in the most simplistic for equation Keynesian climate model the climate and greenflation mechanism, and we can see that there is some kind of cost for the society in terms of output and inflation stabilization to be done now in order to avoid some larger costs in the future. So thanks a lot for your attention, and let me know for your questions.
I have a question. Great presentation, thanks. So I have a question. So I understand this point on the long-term gains, actually, because so related to output, what I saw is that in the Paris Agreement style case, you have actually that the economy stabilizes in the longer run to a lower level with respect to baseline, right? And this, if I understand correctly, is because actually the damages from climate change that you have in the path actually cannot be actually, so the economy cannot catch them up, so at the end. So, but what is the point in which actually climate policy becomes effective in reducing these damages? So, are these damages clustered in the first part of the sample of the time horizon, or they are still spread out throughout the whole horizon of the estimate?
So you do have always damages because the carbon stock, our contribution on the stock of carbon is already sufficiently large, even right now, to have some effect, on climateflation. And so we won't be able to remove the carbon stock that we emitted, I mean, in the atmosphere. So it's the irreversible, nature of climate that is already taking place, even in sample, Okay. So. I think it's answer your...
That's why you are so pessimistic.
Yes. One of the reasons. But the debate last night was also another reason. And I live in France, so I mean, we are living in turbulent times, so I'm not really optimistic.
I just wondered, your paper and Florentia's paper seemed a fairly slow reaction to inflation. I remember a paper by Nel Negro, which I think you cite, which is also a new Keynesian model and looks at the climate shocks and things like that. And the BIP to inflation is very quick. Now, he does have a network structure there, which you don't have. Would you comment on that? And then secondly, the second question was, when you specify your Paris Agreement, I presume that corresponds to a cap. The path for carbon prices is concave, whereas if it's a hoteling path, it will be convex. You have your cost of full decarbonization at the end, that's the tail, and then you run it back at the risk-adjusted rate of interest. But I don't think that's what you do, because that looks different. So can you explain how do you do the carbon tax path, and secondly comment on the difference with Del Negro, why it takes 20 years or so rather than 3 or 4 years for the inflation blip?
I think this, for your first question, it's related to how we conceive abatement costs. And we use the DICE, abatement cost, which is a flow variable. And so you need to have, a lot of expenditures on a yearly or quarterly basis to reduce your carbon emission. It's not once for all, effort that you do once and then you have no more emission. And I guess this is just related to the fact that we don't conceive, abatement as a stock variable, but rather as a flow variable.
And Del Negro does he?
And?
Del Negro, he does, but he has the quick response.
Okay.
So why does he have a quick response? He says it's a very temporary blip problem. We can deal with it. Go home and go to sleep. Whereas in your case, it looks a bit more serious.
I need to see the Diego's paper. I don't know the assumption that he has on his model to generate that. For your second question, that is related to the tax implementation at the past, we just assume that the emissions are going to linearly decrease over time up to we reach the Paris Agreement. But we're working on some version in which we will front load, so increase the carbon tax in a concave way, so what you had in mind if you have the Outling approach, or the opposite, if you postpone as much as possible and then you increase it few period before the 2050 date.
Oops. Because in a sense, your estimated policy path is very restricted. It's just a fraction of what it is, what it should be. But you would maybe have two parameters, like do they expect it? How long do they have to wait, and then how much do they do it? Then it would already be a bit more interesting than would be more interesting than how interesting it already is.
I agree with you. So we're working on having different paths of the carbon tax and see how the results are going to be affected. But the list of the robustness check that we do is huge, and this is on the pile of what we intend to do in the next version of the paper. So thanks a lot.
Yeah, great paper and presentation. So just on monetary policy. When I think about policy, and I think many people around central banks, well, you guys, Frank is right there with you guys at the ECB, but often you think about it in terms of the neutral rate of interest, not so much in terms of the trade-off frontier. And so, I'm just wondering in your framework, you could think about having precautionary saving that would put downward pressure on R star. I don't think that's present. You could think about having investment in green technology, and that would tend to boost the neutral rate up. I'm not sure if that's in there. I didn't see it. Or you could have just an impact on growth, and I think that might be there actually. Your maybe growth is pushed down, and that's sort of your neutral rate is down. So it's kind of an interesting thing. So it pushes you down towards the zero lower bound. If anything, it aggravates what we've been going through over the past, the 15 years before the pandemic. But it's never clear when. So anyway, I think that's where I would focus on in terms of policy. And in terms of the previous question, I think what might differ from Del Negro is your path for the carbon tax. Your carbon tax is rising for a long, long time. So it's adding inflationary pressure over time, for decades before it decreases. So if you were to just increase the tax and then keep it constant, your impact on inflation would be completely different.
Yeah, I really do agree on your second point. But this is related to how we conceive the abatement problem. We wanted to take the one from DICE because it's a kind of benchmark. But I do agree that the way they conceive it as a flow variable rather than a stock have some large implication, especially on inflation. So once again, this is also on the pile of the robustness check that we want to see how much, inflation will be lower, the green inflation term will be lower if we have different assumption on the abatement. And the first question about R star, Frank is obsessed with R star, and so we had a lot of discussion about R star. So there is a section on the paper about R star, whether it grows or it increases because of climate, because of the taxes. And so I can send you the paper, you will see all the different cases about R star. I'm not a central banker, so I see R-star as something that is like some kind of occupation for central bankers, but I see, I recognize also the kind of question that can emerge, from an audience of central banker. But basically, R-star is decreasing because of climate change. And if I remember well, it's increasing because of the boom following the implementation of the green investment. So this is going in different direction based on the carbon path that you implement.
Okay, maybe we can continue the discussion during lunchtime. So thank you again, Florencia and Gautier, for the great presentation.
Sorry, let me provide some information about lunch. So we are having a lunch in Sala Bonsantis, just to the left in the courtyard. We are having 1 hour and a half, more or less. We reconvene at 2:30. And as Eleonora mentioned, we had a large number of submissions, so we asked a few authors to prepare some posters. So after having some food, please have a look also at the posters. Thank you.
Okay, I think we can start the first session of the afternoon, and I leave the floor to Samuel, and thank you.
Good afternoon, all. We're going to start the third session. We're going to have the presentations by Sylvain and by Filippo. It's 2:30, so we're going to go until, what is the time? 4:10? Oh, sorry, 3:50. And each speaker will have 30 minutes, followed by 10 minutes of questions. If you want to ask questions during the presentations, please only clarification questions and leave the comments and more difficult questions towards the end. With that, Sylvain.
All right, great. Okay, well, thanks to the organizer for putting the paper on the program. It's terrific to be back in, at the European Institute. Okay, so this is joint work with my colleague, Dan Wilson. This is one project, part of a bunch of projects we're working on. So we have a new paper coming up in a week or two, and we also have kind of a similar exercise on the euro area. So at the end, I'll show you a slide to tell you a little bit about how the results in Europe compare to the result in the US in terms of mobility and the impact of climate change on mobility. Okay, so it's increasingly easy to motivate this work. So first I should say typical disclaimer apply. Increasingly easy to motivate this work. In the US right now, we're just the start of the summer and basically recording record heat in many areas. If you're in Phoenix right now, it's not that pleasant, and I can assure you, or Southern California. The same thing, so much so now that there's pressure in the US for the federal government to consider extreme heat as a major disaster, just because it's leading to so much economic disruptions, and not only on the sectors that you might think would be the first on the line of defense, agriculture and other sectors like that, but also manufacturing, just because the power grid is often overtaxed. And many areas, you don't have AC in manufacturing plants across the Midwest, so it's very difficult to work. So basically, like, the idea here is that all this might affect productivity, of course, might affect amenities to living in different areas, and giving those changes in amenities and productivities, people might decide to change location, so we might have impact on population, employment, wages, and house prices. So if you think about a spatial equilibrium model, changes in amenities and changes in productivity would basically lead to a reallocation of resources across the country. So what's the this is an empirical paper. It's not a macro paper. It's basically a micro analysis. So what's the problem with thinking about climate change and estimating the impact? And I like this quote by Tama Carlton and Michael Greenstone. So they say, because the climate has remained stable throughout modern history, it's difficult to isolate experimental variation in the long-run climate. So it's pretty obvious. So what have people done given that? Two things. So you can use theory, and that's completely fine. In particular, if you want to think about policy, that's probably the right approach. So you can use calibrated structural models. Empirically, what people have done typically is infer longer-run climate change effects from estimated short-run weather effect, because clearly we have more fluctuation in short-run weather, and so you can isolate the impact. And so then there's a stretch going from short-term variation in weather to thinking about these as representing climate change. So this challenge now is becoming less challenging. It's easier to isolate experimental variation in the longer-run climate, basically for us for two reasons. Clearly, the pace of climate change is increasing, so we see the consequences more and more. And also, there's recent availability of long historical weather data at a fine geographic level that we didn't have, prior to a few years ago. So you can see this here. This is supposed to be red. You see it a little bit. You see the variation here in terms of the change in the number of extreme heat days that we define here above
26 degrees or so, and those below 20 degrees, you see like how it's changed over time. Just like the region, the Sun Belt, across all the southern region of the United States, just extreme heat is rising. And the northern part of the country, the flip side of this is the number of cold days are decreasing. And so there's variation that's happening over time, but also across region. And this is projected to continue. If you look at the IPCC, just kind of middle of the road scenario, you know, the number of extreme heat days across the country, I would say, particularly in the South, Florida, Nevada, all these places, really rising, and the number of cold days diminishing in the northern part of the country. So what do we do with this data? So we have this data, and what we want to do here is estimate the longer run effects of climate change on regional outcomes. So population, employment, house prices, wages. And what we're going to do is super simple, okay, in many ways. We're just going to use kind of a standard long lag panel distributed lag model. Okay, and this it's going to look simple, but we're going to argue that it has nice property that you'll see in a minute when you think about climate change. So we'll show you results. There's just the empirical impacts of climate change on those outcomes, and then I'll go very briefly into the next part. We'll use a spatial equilibrium model to interpret the empirical findings. We kind of want to know, is this coming from a change in amenities, or is it coming from a change in productivity? Okay, so I'm going to be very brief on this. The model is very simple. I'm just going to describe a little bit in word what we're doing. You'll get a sense of what we do. And then what we're going to do is combine those empirical estimates with projections from the IPCC to think about projections of climate change on the spatial distribution of economic activity across the United States. Okay, so I'll show you projection at the end. Okay, so the model, the framework is really simple. So we start with a standard panel distributed lag model of the following form, where we regress the change in an outcome. So population, so it'd be population growth, could be employment growth, wage growth, the changes in house prices, and we're going to regress this on a numerous number of lags of indicators of weather. So we're going to have about 29 years of lags in our weather variables. We're going to include county fixed effect and time fixed effects. Okay, and so like one thing I just want to show here is that all the betas here would be representing the impact of a change in a particular weather variable on growth in that particular variable. If we just accumulate these growth rate like this omega does here, it's going to be the impact, the longer run impact on the level of that variable. So if you take population, just summing all the betas over, let's say, 30 years will give you us the longer run impact of that weather variable on the level of population, level of employment, etc. So we start with this, and then we think about, okay, so what are these capturing? So like the impacts would capture, in principle, two things. They could capture ex post, the delayed lagged effect of past weather shocks, so kind of a reaction function in a sense. You observe these shocks and people are reacting and let's say changing location because of impacts on amenities and productivity. They could also induce changes in expectation. It could be forward-looking agents responding today to expected future climate. So our impulse responses will be a mix of the two. And here we're going to be basically showing that if agents form expectation in an adaptive manner, then our framework basically will capture both ex post and ex ante. And I think thinking about adaptive expectation in this case is not completely crazy. So it doesn't. I don't ever prove that people are doing this, but it sounds reasonable to us. If you look at even the projections of expert, like the scientific projections, they're highly correlated with the recent evolution of weather. So it really seems that people are looking back to projecting. okay, to make the projection. So it seems to us to be reasonable. So basically, if you go with that, you can see in the paper like these would capture these two types of effects. So now, this is more the important part of the methodology here. So to increase efficiency and isolate low-frequency shocks to climate and not weather, we impose structure on lag coefficient, basically using a second-order polynomial distributed lag model. And so now we have like these three terms in particular. So we have like these fixed effect, county, and time fixed effect, but also like the three variables in red, blue, and green. And this is where it's kind of interesting to have a lot of data, basically. So the first in red captures a 30-year trailing average of any weather variables that we'll have in the model. And that's kind of interesting because that's exactly how scientists think about climate change, about a climate normal. Yep.
What frequency is the data?
So we have annual data. Yeah, annual data at the county, basically at the county level. So this will be capturing a climate normal, again, like basically what people have in mind, at least when they think about climate change. The term in blue will basically be a 30-year trailing linear trend in any weather variable that we include. So again, at least you're thinking about the trend in the variable, not just the fluctuation in like year-on-year fluctuation in weather. And then we have in green a nonlinear term, basically the acceleration or the deceleration in the trend. So while we're using weather, because we have so much data, we can think about moments that capture, we think, a little bit better climate change. Okay, so the idea here would be to use this, estimate this model on county level data, and basically report. So what I'm going to do is I'm going to contrast the short run impact. So if you were to just use the change, the annual change in weather to estimate climate change versus the longer run effects that are given by this particular parameter here. Okay, so this is going to be the part of the main exercise here. Okay, so I'm going to do this. And then I'm going to, if you read the paper, there's too many things in the paper. That's why I don't like micro so much, because you can do so many things, so many exercises. It's getting to be a beast. Like we'll do like a bunch of robustness check. I'll try to walk you, like you'll see the slides are a little bit busy. I'll walk you through them to make sense of them. But we do a lot of robustness check just to see like how confident we can be about the results that we're finding. So just in terms of outcomes, so we have population, employment, wages, house prices. The thing to realize, these starts in the late 60s, early 70s. We're going to have data. Basically, our estimation is going to use 1980 onward for this, but our data set on weather will start in 1950. So basically, we have 30 years of lag. Our first observation, 1980. We go back 30 years. So that's kind of the key. We have a lot of data, basically. In terms of weather variables, so this is like the data is coming from NOAA. They've done this at a very precise level, much more disaggregated even than the county level. And we'll construct these 6 weather variables. You can see them here, number of days in a year with average temperature, let's say below 6 degrees Celsius, and then in these different categories, okay? And we'll look at precipitation also, a number of days with extreme precipitation. So we'll have all of those variables in the regressions with number of lags, basically 30 years of lags.
What I don't understand with your model is there's a huge literature on attribution. So whether these climate shocks are actually weather related, or whether the shock you see is actually climate related or it's just the weather. So does your PDL thing, does that pick that up? So there's always, whenever a disaster strike, there are these climate scientists,
yes.
like they featured on the front of the cover of Time. They try to sort out, is it really climate or is it just the weather?
Right.
So and does your shocks and these linear and quadratic trends, it doesn't really pick up the causality thing, does it?
Okay, well, so
or maybe it does.
So that's okay. So I don't know. I don't know if we're like really in line with that. So that's a great comment. I'm not sure. I'm not sure about that. Whether we're in line or not with their assessment. I guess we're like the way we have it, we think it captures better the impact of climate change. Maybe to a scientist, maybe it wouldn't. You know, I don't know about that. Like if they have a completely different interpretation.
So there may be large data sets which attribute where it comes from. Is it climate related or not, the weather shock? And if that's the case, that would be very helpful for you.
Right. So I think what they also do, like they look at the probability of this, right? Like, so we don't do that, but right. Okay, so just in terms of like the results here, so I'll just start with population because I think population is actually the most interesting thing that we're finding, like something that I thought was surprising, if anything. So I don't know if you see, like, so the first column there on your left is below 20, so it's basically like extreme cold to extreme heat, and then after that, precipitation. But you see, so the red dots are the contemporaneous effect. So if you just look at change in weather, basically there's no impact on population. So you would be saying like climate change has zero effect on mobility across county. But if you use a large number of lags, and the model we have in mind, then you have to look at the blue dot, and the longer run effects are much bigger. Okay, and so now you find effects, for instance, when it's extremely hot in particular, or when it's extremely cold. You see population declining in these areas. So the effects, just in terms of magnitude, are not very big. So this is the impact of an extra day in a year on population growth, and it'd be a decline of let's say 0.05%. So it's very, very small. But you have to think about this in terms of the projection. So if you have 10 more days per year for 10 years, you're going to get numbers that are going to be much more substantial. So in terms of employment, kind of the similar pattern. We find decline in employment for extreme cold and extreme heat. So like those are kind of in line and not much of an impact in the short run. And I just want to go back to mobility for a sec. So it's exactly what you would think you would find. It's pretty costly to change location, for instance. And so if you have like just temporary change in weather, you're probably not going to move, given the cost. But if it's really capturing climate and you're thinking that these are going to be more persistent and permanent, you might be more likely to switch location. Okay, so house prices, wages, a little bit more imprecisely estimated here, but you see impacts, for instance, again, for extreme heat, for house price decline, and wages for extreme heat again, and precipitation in this case. Okay, so then we just go through a battery of tests. So this chart and this chart, I debated whether I wanted to put this up, but basically this thing is we're looking at all the impacts, how the long run effect changes. And so you'll see the parameters are drifting up, and they only drift up when we reduce the number of lags. Okay, so it basically tells you the number of lags are important. You're going to miss some of the effect of climate change if you're just using, let's say, 3 lags, 1 lag, 0 lags. Okay, so now you're drifting, all the parameters, all the estimates are drifting up towards 0 in this case. Otherwise, the model, if you put lag-dependent variable, unrestricted model, you get pretty much what we had before in the previous slide. So we did a little bit more, removing coastal cities, removing sunbelts, some of the big sunbelt cities like Phoenix. Like the thing with some of these cities is that people were moving south for the longest time, and maybe like there is kind of a congestion effect. And so those places are warming, but maybe just something natural with migration to these areas have come down. So we remove those areas. The more important thing is that you might be thinking, okay, like in some of these regions, we might be omitting other trends in those regions. So you might be like thinking about confounding factors. So we introduce region-specific time fixed effect and region-specific time trends. So this has a role in some of the variables. So if you look at employment in those cases, then some of the estimates that we had are moving towards 0. So we note that in the paper. You might have a little bit less confidence for these, but for population, the results are very strong, very, very stable. Okay, 10 minutes, perfect.
So, so one thing we do after that is we just put, we look at heterogeneity across region along different lines, income, whether you're accustomed to the type of weather that we're seeing, or whether you believe in climate change. So we found a Yale climate survey that basically asks a simple question: do you believe in that global warming is happening? And so we don't have a whole lot of data. So the data started in 2014, but we use that. And basically, what you find is that that the effects are kind of bigger if for poor county, if you're not accustomed to the type of weather shock that you're experiencing, and if people are less believing in climate change. Okay. So then I've got 10 minutes. Let me run through the rest because I'm going to run out of time. So we try to kind of put some meat around those results, try to think about, okay, what could be driving this, amenities or productivities, a mix of both. So we have just a simple spatial equilibrium model where people are choosing where to live. So there's like different location and they can live anywhere. They compare utilities. The region here will be composed of households and firm and we'll have two types of household. We'll have workers and we have retirees that who don't work, because our results between population and employment differ. So we'll have these two to think about population in a state, in a region, and employment. And then what we have basically is we can write this model in the same kind of panel regression dimension that we had before. And so we can generate, for every location, every state basically, we can generate amenities and productivities based on the behavior of house prices, wages, employment, and population from the model. And so we generate this data based on the movement in these variables, and then we redo the regression. And this is what we find. We do the regression on amenities and productivities that we back out. Okay, and so we report these there. So this is the contemporaneous and longer run effect on amenities and productivity from the model. Mixing the model structure with the data at the local level. And what we're finding is that basically a mix of both. So you see on amenities that when it's extremely hot, amenities are declining. And for productivity, you see this decline in productivity when it's either really hot or really cold. So really a mix of both are driving where people want to live and when they want to work. So basically employment is driven by a decline in productivity. Population is driven in part by a change in amenities. Okay, so then just on to projection, we're going to mix the estimates that we have. So we think they capture better the moments of climate change. So we have these estimates from our model, and we're going to basically generate data at the local level, projections based on the IPCC different scenarios. So here I'm just going to show you the middle of the road scenario 4.5. So we're going to mix both. And here, like the point I want to make, this is all compared to a national average. So, we have time fixed effect in these regression. There's no way for us to make a forecast of the time fixed effect. So this is all local. So this is basically how this thing moves across regions compared to the national average. And so we do that. We do these projections between 2020 and 2050, and we compare them to a no climate change scenario, where in no climate change, we keep the variable at their mean between 1990 or 1991 and 2020, just at their average. Okay, we keep them at the average. So what do we find? So you find just a lot of change in population and employment, for instance. Like basically people moving from the south to the north, employment moving from the south to the north. Okay, so quite substantial. So you might be thinking, okay, Sylvain, this is great, but we see completely the other way around in the data. Okay, so we had a census in 2020. If you read the headline, it's all people are moving south. People are still moving south. The Gen Zs are moving south. So you're thinking, well, this just cannot be happening. People still want to live in Phoenix and in Arizona, as weirdly that it may sound to you.
But one thing is lost in this. So if you look at the data, actually, it's true that in level, people are still moving south, but the migration rate to the south is falling. Okay, so people are not moving south as much as they used to. And you'll see this in the data. So in the data here, I'm just showing you population growth by county, by decade. Okay, so let's say the change between 1980 and 1989 for every county. And on the x-axis is how basically hot a county is historically, okay? So the number of extreme heat days, I think I have here. And they're basically ordered. So you can see that between 1980 and 89, people were tended to move where, it was extremely hot. So they were going to Arizona, all those places, just the movement to the Sun Belt made complete sense. It was true also in the 90s, but this regression line is falling, is diminishing. Okay, and by the 2010, it's kind of disappearing. Okay, so we have another paper that's coming out in 2 weeks that basically shows this very dramatically. It's just falling, and it's the same thing for cold days. So these correlations are basically kind of disappearing. Okay, and so if you project further, then these lines that are flattening, well now they're just going down. Okay. And so it's particularly the case, so I've highlighted in red here the cities, like kind of Phoenix, and so people are still moving to the cities, but the rural areas, those relationships have basically disappeared. They've turned negative. So, people don't want to be in the rural South anymore, maybe because, maybe people in these areas work in agriculture or something like this, and it's kind of getting more unpleasant, more difficult. Okay, and then the last thing here is let me skip. I'm gonna. So we do this also, just to get a sense of how much reallocation you could get. We do we calculate the mean absolute deviation between county growth and national average county growth. So it gives you a sense a little bit of how much. So if you look at population, you get, depending on the scenarios here, you can get up to 35% to close to 100% reallocation over time if these scenarios play out. Okay, so I'm just not going to conclude because I hate concluding, but I'm just going to show you impulse responses for Europe instead. So we use what's called NUTS3 region, and so we had data. We just downloaded data. It took a lot of time to do this. The Europeans have a lot of data. It took us forever to download the data. But basically, so we run the model on population for the US, and that's the blue line. So this basically what I was reporting is the end point of these impulse responses. And we do the same thing on European data, and this is preliminary, so maybe take this with a grain of salt, but I think it kind of rings true in a sense. Surprisingly, maybe you see the same pattern. You see population growth in these counties that are exposed to extreme heat and extreme cold kind of falling, but less than in the U.S. Okay, so that would fit my prior maybe about mobility, and this is mobility in the sense that we take into account births and deaths. So this is really kind of mobility across areas. So kind of the same thing. So it's kind of maybe reassuring to us that even in a place like Europe that probably is experiencing to a similar degree the changes in weather pattern that we're seeing in the US, but mobility, maybe responding less for the typical features that we think to be present in Europe and maybe less in the United States. So I'll stop here. Thank you. Thank you very much, Sylvain. We have 10 minutes for questions, so feel free to open your mics and ask the questions, please.
So I guess Europeans are well known to be less mobile than the US, so that makes sense. But for instance, for the extreme heat days, are you controlling for economic activity in the area? Because in Europe you may have that the south is growing less than the north, so there may be those factors at play too.
Right. So those, I mean, this is where the controls, county fixed effect, time fixed effect controls for a whole lot of things. When we put county time time trend also, or county fixed effects. So, like we try to control for many things that you might think would confound those results.
But in Europe, what's the geographic unit that you use?
Right. Well, so those are like kind of regions that are similar to a U.S. county.
Okay. So it's pretty small.
Yeah. So it's pretty small also. We just have fewer of them compared to the U.S.
Sorry, I guess you control for migration there, right? Because also you could.
So we do one thing for migration. So so that's it. Okay, so coming from an international angle, that's an important. I think like I can see what you're getting at. So when you're moving, right? Like you're not only thinking about what's happening in your county, but you might be thinking about what's happening in the county you're going to move to. And so we're doing so in the baseline we don't do this, but in a robustness check we do exactly that. So we control for weather in distant county weighted by typical migration, historical migration. And so we do this, we look at counties that would be distant by about 500 miles because otherwise the weather is too similar and it becomes multicollinear. But basically you find that. So you find that if, for instance, if it's really hot in a distant county, then you see people moving more into your own county. So we control for that. So the results are holding.
I meant the cross-border, but thank you for that particular. But what about the cross-border migrations, like the influx? The cross-border migration. I was thinking about international migration.
Right. No. So that I think is basically capturing the time fixed effect. So if you have more national immigration, for instance, then it's basically capturing the time fixed effect, right? Yeah.
So related to the comments, so tax incentives and other kind of incentives have varied over time. So I know that in Norway, for instance, we give a lot of tax incentives and subsidized to housing if you want to live in the north. And these change over time. So in the US, haven't it also been less incentives to move to the south over time?
Okay, so we've done something on state taxes also, controlling for state taxes. Those don't change that much. So, in a sense, they're close to be fully captured by a county fixed effect.
Okay.
But they might a little bit. So we control for that, for that as well. Mm-hmm.
So great paper. So can you say a little bit at the end to compare your stuff with people like Esteban Rossi Hansberg, Klaus de Smet, Bruno Conte? They have these geography models with a big emphasis on trade and other forms of adaptation. And then particularly, how are you picking up the adaptation? Now I think you say if you've been exposed a lot, if you're used to a lot of heat, you've made your adaptations. And then the effect is less. That's what you're trying. That's a story you're trying. But then it kind of disappeared towards the end of your talk.
Right.
So can
I
you come
think
back
I was
on these two things?
Yeah. So it's completely related to their work. I mean, in our case, from just a purely empirical framework, whereas they do this more from the model side. I would view kind of the migration as a form of adaptation. So it's this part of it is a form of reaction to what you're experiencing, but also just a form of.
Are you as granular as they, or are you less granular or more granular? But they have quite a granular database. So how big are your cells, or is it districts, or is it counties, or what is it?
So ours county. I think theirs is model based. So I know they've done some kind of similar regressions to calibrate the model, but then when they're thinking about migration, I think this is all model based what they're doing, whereas here it's all empirical.
I'm asking because much of this climate stuff is very micro.
Yeah.
So if you have a cell of 10 by 10 kilometers, it's already a bit large. Because think of being in Berkeley or in Davis. It can make a hell of a lot of difference.
Sometimes what I find are pretty ambitious in a sense, because they do this at the global level, right? Like thinking about migration at that global level, which might be even more complex than what we're doing here. So we're doing this, we have about 3,000 counties in the US, so this is what it is, right?
But I think ultimately they would use data like this to calibrate their framework. Right.
Silvan, have you thought about doing the same thing for firms' plans?
Yes,
location?
from firms' location.
Yeah, I don't know if somebody's done it, or it would be actually very interesting.
We've been thinking about trying to find data on this, because I think that's exactly, because people are moving, jobs are moving, firms are deciding to locate in different areas, depending on the climate, clearly. So this is something we have in mind in trying to do. We haven't done it yet. I think there's some data about this, but I'm not. So if people have if I'd love to put my hands on it. I think that's kind of the natural extension.
I wonder whether location of branches, bank branches, can help you address a little bit going there.
I'm sorry?
Location of branches of banks.
Of banks, yeah, right? Okay, that's
so
interesting.
For plant level data, I think you can use EPA data, Environment Protection Agency. They have plant level data as long as the plant emits, which is always. So for nets, but nets is quite expensive. But EPA is publicly available.
We're the Federal Reserve.
You print the money, right? Go for nets.
Yeah, and in Europe you have studies where, for example, for Italy, there's a guy called Andrea Chiavari, is a colleague in Oxford, and he split up all of Italy into cells of 10 by 10 kilometers. Then got the data and know exactly which firms are in each cell. And then he got how much emissions are in each cell. And you can almost allocate it to the names of the firms in that particular cell. And then you can see them moving along or moving in and out.
Wow, that's fantastic.
So you see the emissions also moving in and out. So if you get that granular level, then you can, and I wonder, following up to Olympiad, there must be that type of data. Because I know there's Solomon's, they sometimes have this very granular stuff as well, don't they?
Okay, wow, that's great. Thanks for the suggestion. That's awesome.
1 minute. Can you go back to the answer to Rick at the beginning? So is there a sense in which, I think the work stands very nicely as it is, no? Because it's basically temperature extreme events, not necessarily connected to climate change narrative or concern, no? Like simply extreme events, unusual weather patterns, no? If I understand. But is there a sense in which we could gain more by recalculating indicators of some kind? I would not know what Rick had in mind,
So you're asking whether we're really capturing climate change, or
no. What I'm saying is that I think that the paper stands nicely as it is, because independently of climate change, you have weather patterns, extreme events. Now the question is whether there could be the regressor more informative about the climate change perception, no? Something like that was Rick questions, but I don't know how to do that. Like unusual pattern rather than intense pattern.
IPCC reports many studies on this, and the key name is Friederike Otto. So she does this, she was on the front page of one of the most important people in the world.
For the climate attribution, you think?
Exactly.
I see.
And then another guy was van Oldenburg, but he passed away.
Okay.
So these were the two gods in that area. But it's worthwhile having a look at it when you do weather and climate.
Very well. In the interest of time, we'll stop the questions, but of course, you can follow up the discussion
afterwards.
Thanks for the comments. So next, we're going to turn to Filippo's presentation. Again, 40 minutes, 30 plus 10 of questions.
Thank you very much. So let's continue with another empirical paper. So this time, jump into the green transition literature. Okay. Thanks. All right, so this is a joint work with Fabrizio and Andrea. We are all at the Bank of Italy, so the usual disclaimer applies to this presentation. And in this paper, we investigate the macroeconomic effects of the green transition by exploring the technology angle. I don't need to convince you that climate change and the green transition are central in the academic and policy debates, but what has been done so far in the empirical literature is mostly analyzing the effects of physical risks. So the damage, to estimate what are the damages that climate change is inducing in the macroeconomy, while the literature on the green transition is still nascent, and on that side, most of the efforts have been devoted to the study of climate policy, while we learned from Rick's presentation and also from Florencia's model that actually the role of technology is key, so technology is pivotal to achieve the transition. It's not possible to have a transition without recomposition of technology towards actually climate change adaptation. And so what is very important here is to understand if technology can have an autonomous standalone role in driving this transition, and what we claim in this paper is yes, actually, technology can be an autonomous driver of this process, and I will show you why we claim this. Of course, understanding what are the consequences on the transition is key also for the implications for monetary policy, so understanding whether there can be some trade-off exactly because of the transition or not. So in this paper, we provide an empirical study of the economic implication of shifting towards a greener technology mix in the United States. And we choose the United States exactly because it's the perfect case study for this exercise, because actually climate regulation has never progressed and become like a full-scale regulation in the US. So study the green transition from a technology angle in the US is actually something that is good because we don't have regulation as a confounding factor of these effects of technology. So what we do for this purpose, actually we provide an identification of some new shocks on the transition, so on the recomposition towards green technology, and we do that by exploiting granular data on patents in the US. So what we do, actually, we construct an indicator that is the ratio of green to total patents, and we use this indicator in a typical time series model, and we estimate its effects of changes in this indicator on the US economy. A quick preview of the results. Actually, the green transition appears to be costly in the short run and appears to act as a negative supply shock, while actually why this cost looks temporary, the fall in emission looks permanent. So in the longer run, it seems that the green transition, the efforts to convert the technological progress towards climate mitigation is something that pays off. All right, so I skip the literature for brevity and go directly to the data. So the data set that we use are two data sets of US patents that we combine to construct a monthly frequency series starting from 1980s to today. So the first data set that we use is PATEX. So PATEX is a patent database that has been constructed for research purposes by the US Patent Office and has been used in a recent paper by Miranda Agrippino and co-authors who explore the macroeconomic effects of technology, of future technology shocks. This data set actually encompasses all patents that are filed at the US Patent Office and encompasses both patents that have been granted and those patents that have been filed but not granted at the end. So we merge this data with another data set also coming from the US Patent Office, that is PatViews, that contains information on the classification on the patent based on its final use. And in particular, we are interested in a particular tag that is Y02, that is patents that are made for climate mitigation purposes. So what does it mean? Actually, we have patents that are made for this purpose in 5 sectors that are the energy sector, the manufacturing sector, the transport sector, the digital sector, and a 5th sector that I don't remember. And so it's kind of patents that are used, for example, in the building sector. So in the building sector, it's patent for building retrofitting technology. In the manufacturing sector is patents for electrification of the industrial processes. In the energy sector, you have carbon capture processes, and so on and so forth. So given that actually in the path of use we just have granted patents, actually we restrict our analysis to patents that have been granted. In the rest of the talk, I will use green patents as a proxy of climate change mitigation technologies, and we will construct this index of the news on the green technology mix as the ratio of the number of green patents that are filed in month T over the total number of patents that are filed in the same month. And I want to draw your attention on the fact that we choose the filing month and not the month in which the patent is granted to impute our patents, to consider our patents. Why? Because actually the time that lasts from the application of the patent to the final moment in which the patent is granted can be very long. It can encompass from months to years, and the information that is what matters, that is released to the public, is released actually at the filing date. And in that month, actually, we believe, and it's not just us, this intuition comes from Miranda Crippino and co-authors, to say the truth, we believe that the news that goes to the industry peers and to the public actually is released exactly at the filing date. All right, so this is just an example of a subcategory of green patent for the manufacturing sector. And this is the snapshot of the time series that we have in our paper. So on the upper panel, you have the number of green patents in thousands of units and the number of total patents filed in each month. These two series are on two different scales. The red series is the number of total patents on the right scale, and the blue series is the number of green patents on the left scale. As you can see, they both experience an upward trend that started in the mid-80s, and then this trend was reinforced in the 2000s. The spike that you see in the 1995 was due to an exogenous variation in patent regulation in the US. It has nothing to do with business cycle things or economic reasons. And so that's it, actually. As you can see, there is this upward trend in patents, and like in the last years, you can see that the number of patents filed, the total number of patents filed per month reach kind of 300,000, while the total number of patents for climate mitigation around 4,000 to 5,000 per month. On the lower panel, you can see the ratio, that is our GP indicator, and you can see that this ratio has been quite volatile, and also it had, I mean, different phases of volatility over time. Okay, this slide is for a disclaimer, actually. So in this paper, we are not investigating the effects of green innovation per se. So what do I mean with this, actually? So there is a strand of the literature that studies the effects of technology shocks by looking only at technology innovation driven by green innovation. So in that case, a green innovation shock in level obviously constitutes an expansionary technology shock. So actually, if you are expanding your technology by using green technology, actually you are exerting a pressure on the economy that acts like a positive supply shock, as a normal technology shock. Here, this is not what we do here. Here we want to capture something different. Here we capture a shock that is a recomposition shock. So we want to proxy the relative increase of green patents with respect to the rest. So it's a shock at the margin, and given the fact that this is a shock at the margin, it has not a clear, an a priori impact on the economy that we know. So the sign on the impact of the economy a priori is unknown, and can be different from the one of a technology shock. All right. This is a pre-estimation step. So why? Because actually patenting, as I showed before, has an upward trend, and this upward trend suggests that patenting can be endogenous really to current and expected economic conditions. How we can test this? Actually, we can test the orthogonality, and actually our proxy of relative green patenting is not immune from this issue. So what we do is that we test the orthogonality of green patents related to a bunch of variables that reflect current and economic forecasts, structural shocks like monetary and fiscal policy shocks, and also commodity prices. And in particular, we look at transition metals. So what we find is that actually our GP measure is orthogonal to the current and future economic condition, to the policy shocks, while there is a significant correlation with the prices of transition metals. And this is quite understandable if you think, because actually the demand for green technology, demand for transition metals is happen exactly because there is a demand to these metals to build green technology. So these are two elements that are really correlated, and we take this point, we propose a robustness estimate in which we control for this element, but actually it doesn't really change the picture because it's really analyzing something that is really a unitary thing. All right, so let's go to the empirical analysis, to the core of the paper. So the identification assumption is very easy. We employ this GP indicator as an internal instrument. We put it in a VAR framework and as a first variable, and we employ actual SK identification. Very easy. Because actually I hope I convinced you that this news effect is something that can be considered contemporaneously exogenous with respect to the other endogenous variables in the system that are industrial production, consumer prices, and all the macro variables that are used in this kind of analysis. Of course, we want to look at the response of CO2 emissions. CO2 emissions are annual, so we interpolate this emission in a state-space model, exactly as Diego Kensick does in his paper for European emissions. And then we run our VAR analysis at the monthly frequency to study business cycle effects on industrial production and inflation. And also we resort to another specification of the VAR at the quarterly frequency to look at the effect on other variables that are available at that frequency, like TFP, for example. We validate this analysis and also provide a double check using local projections that allows us to, as the empirical estimation, the empirical specification is more flexible, it allows us to include more variables to test other effects that I'll show you in the robustness checks. All right, so this is the baseline results that we get. So following an increase, a positive shock in the share of green patents over total patents of 1 standard deviation, what you get is a decrease in industrial production and an increase in both producer prices and headline consumer price inflation that here are defined by the PCE index. So why this actually? Because these shocks induces actually a recomposition of inputs and technology of firms towards greener technologies. This recomposition is costly, of course. If it was cheaper, they would have done it before. Very easy. All right, so this recomposition puts an upward pressure on the costs that are passed through the final prices. So that's why you see an increase in the headline PCE. And the fact that industrial production falls is related to the fact that this that's passing to some green technology is less productive in the short run. So this green technology are still in their infancy, and this recomposition is something that will force you to lose some of your productive momentum of your firm. So looking at emissions, actually the response is lagged because actually it takes time for the new technologies to be effective in reducing emissions. But what you see is that after a while, emissions are reduced, and this reduction looks quite persistent over time. The response of the short rate is at first increasing because actually it increasing to counteract the inflationary effect, but then the interest rates goes below zero because the recession kicks in and the economy tumbles in recession, and central banks needs to accommodate actually to sustain the economy. All right, this is the forecast error variance decomposition. I'm showing you in this picture to reassure you on the fact that actually the variance explained by our shock is kind of on a reasonable ballpark. If you see for industrial production, the variance explained by this recomposition shock is around 4%, and the same for the PCE index. And this is reassuring on the fact that we don't get crazy numbers, and actually we are not estimating the effect by confounding the effect of our shock with something else. All right, this is just a summary slide. And before going through the main channel that we have in mind, so the effect on TFP, I first want to show you some further evidence that we get by including alternative variables in the VAR one at a time. On the left hand, on the upper left panel, we have the number of the quantity of emission per unit of industrial production. As you can see at the beginning, this emission intensity measure increases, but then in the longer run it goes below zero, suggesting that there is actually this recomposition going on. On the right hand side, you have the consumption of renewable energy with respect to fossil fuels, and you have an increase in the relative consumption of renewables. Then on the left hand side, you have the investment on ESG-related mutual funds. And as you can see, there is also some recomposition of demand by financial investors towards these greener funds with respect to non-green funds. So all this evidence suggests that there is some demand recomposition towards actually greener assets. All right, so let's go to the TFP channel. So we do this in two ways. So we estimate the effect on TFP both with the quarterly VAR, as I told you before, but also with a specific exercise using local projections. And I explain why I'm showing you the local projection here. So what we do is we extract the VAR shock, the shocks that are implied from the monthly VAR. We average these shocks at the quarterly frequency, and then we run local projections with the same kind of Cholesky identification to get the estimates of the effect on the TFP. So on the left-hand side, you have the response of the TFP to a green pattern, greener recomposition shock. And as you can see, TFP goes down, and it goes down quite persistently. Then, I mean, it doesn't. We are not showing it here, but then it goes back to zero. So there is a negative effect on productivity. As the intuition is the one that I gave you before. So the productivity of the new firms is less strong than the productivity of the incumbent technologies, exactly. And this is easy to understand by looking at the right-hand side picture. So here we still estimate the effects on the TFP, but by looking separately at the effect on non-green or shocks to non-green patterns in levels versus the effects of a shock to green patterns in levels. So as you can see, if you increase the number of non-green patterns, actually this boosts productivity, while if you do that with green patterns, the effect is really not significant. The bands are huge, so there is no productivity increase. So this actually picture helps to rationalize the picture you have on the left. So if you think that actually the ratio can move mainly because there can be a fall in the number of non-green patterns, actually this explains why the average productivity falls, because the increase in green patterns cannot compensate for the decrease in productivity caused by the fall in non-green patenting. All right. So, okay, let's go to the local projection. This is just a double check of our results and a way to compare specifically the response that we have at the longer horizons. As you can see, the results are pretty similar to what we get from the VAR. Industrial production falls at the beginning, but then you have a rebound above zero, while for emissions you have that the response remains negative also in the longer run, what you see that is also interesting, that the response of prices is temporary. So in the longer run, the response of prices go back to zero. And also the effect on the short rate becomes insignificant at longer horizons. All right, so if you consider the jointly the response...
Sorry, can I ask,
please.
Do you have any information about entry, exit, or plans? Because, a green transition may activate what is called, like the creative distraction of this blah, blah. What I'm saying is that there could be that the green path is, I may be better off by scrapping what I have and building a new things rather than adapting what I have. So any information about employment flows or across firms or firm entry would be, or investment would be very nice. It may be a problem at the frequency that you have, but it would be very useful.
So actually, we don't have this information here because actually we have the granular information at the patent level. There are in the literature ways to match these patents to the firms, but it's not something that is straightforward. So, but I agree with you that there can be an effect on the extensive margin that can be also something that is working here on top of the effect on the intensive margin. This is what you're saying, right?
It is not obvious. Those effects on the all negative effect is, is still patents, innovation technology. So why? So unless the ratio hides some kind of level fluctuation, but I guess. Again, it's surprising to see what you show. Right?
Yeah, no, I got the point. Actually, we have a robustness exercise in which we engineer some shocks that stabilize the level. So we just actually look at shocks to the relative increase of greener towards non-green patents, but keeping the level of total patents constant. We have this exercise, and results do not change. So it doesn't seem that it's driven by a level effect. So thanks for asking. All right. So as I was saying, as you remember, actually, the picture of the response of the greenhouse gas emission, the response of industrial production together jointly, you see that actually emission intensity falls, and this falling emission intensity is persistent. So what it looks like is that this green transition in the long run sounds like a Pareto improving policy. And the trade-off that you have in monetary policy in the short run kind of disappears when you go to the longer term. I'll propose you two extensions here. 5? Okay. I'll show you two extensions here. One, the first one, I propose a different way to construct our GP indicator, and the difference is in the construct of the numerator. So in our baseline, actually, we just count the number of green patents that we have. Here, we weight each patent by the citation that the patent received, actually. And we think that this exercise is quite interesting because actually it reflects more closely the news effects that patents had on the economy at the time of the filing date. All right. So as I go to the I go to the estimates, I show you that the results are more precisely estimated and even starker than the one that I showed you in the baseline. But I have to acknowledge that there is a trick. So actually, we are using ex post information. So this is just for, to show you that the results that we get are in line with a kind of a news effect. So that's why we are actually proposing this kind of robustness. And the second one is we exploit actually the sectoral difference that we have. So the sectoral breakdown. Yeah. So the idea is that we can have a greener recomposition of patents in the energy sector that has a different impact of a greener recomposition of patents in the building sector, for example. So what we see is actually we reconstruct our GP indicator at sectoral level, and we test separately their implication on the macroeconomy by running separately different VARs. And what we find is that the effects are sharper and more persistent when the recomposition goes towards green patenting in the energy, manufacturing, and building sectors. This is the wall of robustness check. We did many things. One is the thing that Giancarlo was suggested before. Another thing, actually, we drop outliers in the pattern series, or we clean the series of GP from the correlation with transition metal prices. But I want to draw your attention on the exercise number 5, in which we control for climate news indexes. I think this exercise is very important because, of course, as I told you before, the US do not have a full-scale climate regulation, but still green technology can respond to variation in climate policy uncertainty related to, for example, signing of international agreements or discussing about climate policy at the international level. So what we do is actually we include in our VAR some alternatively some different measure of climate news, and we put this measure first in our identification as a first variable. And the index that we use is the Climate Policy Uncertainty Index by Gavrilidis, Kensick, and Stock, the Climate News Index of Strobel, Engel, and Gill, co-authors, and the Media Climate Change Concern Index by Hardy and co-authors. And what we find is that even if you control, this is an example with the CPU index, even if you control for the CPU as the first variable, actually the results do not change. So you still have this kind of a negative supply side effect of this recomposition shock to the economy, and the same effect on the emissions also. So this actually suggests that green technology recomposition really works as a standalone channel for the green transition. So it's something that is really steering the green transition by itself. All right, so I'm at the end of my presentation. So studying transition risk is extremely challenging. The green transition is a multifaceted phenomenon. Here we take the technology angle that is popular in modeling but quite disregarded in the empirical literature. We use this, we build on the intuition by Miranda Grippin and co-authors and construct the share of green to total patents to identify a news shock to a greener recomposition, to a greener technology. We show here the transition is not a free lunch. It's painful in the short run, but in the longer run, it sounds like a Pareto improving policy. So my presentation stops here. Thanks for listening, and I'm open to questions.
Thank you, Filippo. Please, those who have questions, feel free to open the mic and ask the question.
Okay, I got a question. So what's special? I guess what's special with green technology? I think that you have one chart that shows that the impact on TFP is different from non-technology, from non-green innovations. So given that you have those, if you were to do the ratio of non-green technology to the total and rerun your VAR, I guess you should get everything flipped. Mm-hmm. Like you should get kind of a new shock that gives you a boom that's kind of like a demand shock. Demand should be booming. You should get industrial production rising because you get TFP to rise.
Exactly.
In this case. So that would be a great check to see actually.
Yeah, thanks. So yeah, I think so. If you change the numerator of the GP, you will get a positive supply shock, actually, and you will also get some emissions going up, of course. And the fact that we get emissions going down is something that is.
So is it obvious that you'll get that, or would that be?
I think it's not obvious, but it sounds like intuitive to me. So I didn't try to use this ratio.
Because you wonder about, I mean, new technology can be disruptive, right? Like the firm have to implement the new technology, their learning periods, productivity might go down. So it's not clear that there's something really different between green technology and these new ones, apart from the chart that you're showing.
So switching to greener technology is costly. So one thing is that, for example, if you're a manufacturer and you have to electrify your industry processes, it's something in which you have to invest, you have to innovate, and because the technology itself is in its infancy, you have to experiment and lose money. It's a try and error process on top of the innovation process. This is what I have in mind.
It's still a puzzle, right? I mean, apart from my career, I always go to university that pays me less and treat me badly, but a firm chooses a technology when they increase their profits. So so for example, can you do any analysis on the value of the firms?
On the
value of the firms. It could be that the green technology increases the value of the firm, but creates some short-run pain. I mean, I'm not going to adopt a patent that makes me miserable, right? Apart from me, personal. But the issue is very strange, right?
So actually, if you look
I don't have to. You see what I'm saying? There is the green technology. I have to do. No, I don't have to. Unless there is a complementarity with Brussels that say, now that there is technology, you do it. But it's still very strange. So like, it would be very nice to complete the puzzle to see whether the value of the firms goes up there or is somehow...
Okay. So look, this... so one interpretation is that actually there can be some shift in preferences by consumers to buy some products, and firms compete to provide these products that are greener products. So actually, in this sense, actually, they want to switch to green because they will have more profits in the future, in this sense. But switching to green today is costly. The value of the...
This argument completely spell until the end. You should have some measure of the value of the firm. The consumer base changing, I do the green technology, but I'm not an idiot. I'm doing it because my value is at least, is up.
Yeah, but it depends on how the firm is positioned. I mean, it's actually, if the firm is very polluting and is very positioned badly in the green transition, so on the financial markets, investor will position on firms that will guarantee higher profits in the future. So in the short run, brown firms will devaluate their value in the financial markets. This is because of the signaling effects of this news shock.
No, all this is well taken. What is not clear, why all this happens conditional on a patent. If I'm a brown firm that I'm in trouble independently of a patent on green.
Okay, maybe let's talk about it later.
Can I ask a question, actually? So there's this paper by Bolton, Kaspelczyk, and Wiedemann that actually does a further breakdown among green patents, because they classify those that are considered really green in the sense that they allow to transition out of fossil fuels, and those that are just energy efficiency improvements of fossil fuels. So it allows you to produce more by consuming the same, or other way around. So I wonder whether you consider making the distinction here, because the claim is that the energy efficiency improvement is not really a green patent in the end, because it's just sticking you to the fossil fuel world. And I think that if you can make the distinction, actually you can also speak as to whether this is a green innovation thing or just an innovation thing, going back to the previous point. Another thing is also that apart from this Bolton paper, there's another paper by Cohen and co-authors that shows that actually oil firms are making really path-breaking innovation. So maybe you should consider keeping them in, because they make the point that actually those that are in the brown sector basically are actually engaging a lot, despite they are still super brown.
Yeah, no, that's a good point. So actually, I answered the last point first. So we had a robust exercise that I didn't show, in which we exclude the patenting by the oil and gas firms, exactly because this is what, or for the reason you said related to the Cohen paper, those are the most polluting, the brown firms that are more active, but also because they may want to increase patenting for a greenwashing purpose sometimes. So actually, to avoid this potentially confounding factor of greenwashing and not a real news on the technology, we actually provide actually a robustness in which we take out the patenting by the oil and gas firms, and the results remain the same. And also related to your first question, actually, we don't have a we don't do a distinction of, especially for energy efficiency technology related to others. I don't know if energy efficient technologies can be actually classified more in one sector than in other, because we have this sectoral classification. They can be related to the manufacturing sector, for example. So maybe just doing the exercise that we did at the sectoral level actually help understanding also can be kind of at the same level of doing this kind of distinction. I don't know.
Yeah, I think they do it for like a lot of sectors and a lot of countries. So I mean, I think that you can like, in a way, you can say like it's different shades of green or different shades of brown in a way. So like there are those that are really green and those that are less. But yes.
Okay, thanks. Yeah, that's a great suggestion.
I have a question related to Giancarlo's comment. I was thinking that I guess patents can occur because firms are innovative and they discover new technology, or because they're pushed to innovate because of policies, for example. So if there's an increase in climate policy stringency that fosters more innovation, then those innovations are different for me than those that are market-based innovations, say. So I was wondering if you can clear or take out the increase in green patents that comes from climate policy versus those that are I got a great idea for energy efficiency.
Yeah, so actually, so in the US, I mean, correctly, if I'm wrong, actually, the main climate policy that was in place in the sample that we had was the ETS system in California for the electricity trading. But I'm not aware of full-scale climate policies in place at the federal level. So we did the exercise using these climate policy indexes related to international news on climate policy, so uncertainty of climate policy at the global level, and we proved that actually even an increase in these climate policies that precede our shock does not affect the results of the shock. So in this sense, we think to be on a safer side to say that it's really an effect of a recomposition of technology, even if there is something going on outside of the US in terms of climate policy. Yeah.
Okay, so before the coffee break, Sylvain, we have some questions for you from YouTube. There was no time during the presentation. We will forward some housekeeping rules for tonight. Tonight we will have the social dinner at 7:30 at Hotel Baglioni, for those of you that are attending. And after the conference, we will organize some transfers from the Institute to the city center. So those of you that are interested, please reconvene at the entrance of the Institute and we will organize the transfer. Please be a little bit patient because there is the Tour de France in these days in Florence, so reaching the city center is not so easy, but there should be enough time before the dinner. So those of you that are interested, please contact either me, Flavio, or Andrea, or Adrian, that is our local organizer, and we will organize the transfer to the city center. Now we have the break and we will reconvene at 4:10.
Fabrizio, we could take pictures outside during the break, maybe, no? We could have so if you are prepared for that.
Okay, we can start the last session of the afternoon. We can almost start. Yes. So, okay. We start the last session of the afternoon. We have two papers, and Valerio is the chair, so I leave the floor to Valerio.
Okay, good afternoon. We will start this session on the international dimension of the transition, and the first speaker is Pierre Werner, that will talk about real exchange rate fundamentals and dynamics in commodity exporting countries. So I leave the floor to Hilde.
So thank you so much. Thank you for involving me in the program, and thank you for all the great presentations so far. So I guess every workshop on energy transition or climate need a paper on oil, and this is really in that way related to countries which are oil and gas producers. But it's really more generic than that. It's really about how we can think about not stranded assets, but countries who are transitioning for whatever reason. And in this case, it's really about energy producing countries who are transitioning into other industries, and the effect in particular on the exchange rate. So, looking at some data, for the last 10 years, the Norwegian currency has depreciated by 75% against the US dollar, 40% against the euro, and 11% against the Swedish currency. So being a tourist coming to Norway, it's great. Being a Norwegian going to Italy, it's more expensive. And the question is then, why is this the case? Is this really related to the green transition? Are there other fundamentals behind this exchange rate depreciation? Is this temporary or is it permanent? And if you follow sort of like any news related to the Nordic countries, you will have seen that other currency in small open countries have also been depreciating, like the Swedish currency, but not nearly like the Norwegian currency. So this is clearly something which is related to Norway. If you think about what could the fundamentals be for such a transition, then there could be many reasons for this. Starting with going even back to the Mies and Rogoff, we know that there are difficult to find fundamentals to predict the exchange rate, and in fact you cannot really find good models who can beat around the walk if you want to look for fundamentals who can do any well in forecasting. But one of the hypotheses which has been put forward for countries, rich countries in general, is like the Balassa-Samuelson hypothesis. It's been key in explaining how economies adjust over time. And the idea is simply, as we all know, that productivity disparities between rich and poor countries can influence the exchange rate in the long run. So if you have higher productivity in the tradable sector, then driven, say, by international competition, more productive industries, this could result in increased wages and prices, and this inflationary trend is then typically what can lead to a stronger real exchange rate. For resource-rich economies, whether it's producers of oil or gas or minerals or other commodities, theories like the Dutch disease has typically explained how adjustment to windfall can affect the economy. So the idea is that if you have a resource windfall, so like you find oil and gas or commodity prices are increases, that can lead to real appreciation of the currency, and this real appreciation will make the traditional industries less competitive, so you will have a deindustrialization. And there's the original paper by Corden and Neri in the 80s showed how that would eventually lead to lower growth in the economy, because in these more closed economy models, all innovation came through the manufacturing sector, and if the traditional manufacturing sector was declining to this deindustrialization, then the other industry would not be as innovative anymore, and you would have a lower growth in general. And there's a large theoretical literature on the Dutch disease and how that would explain involvement in the resource-rich countries, but there's little empirical evidence who shows that this is the case, or who shows that, or at least give you any empirical validation. Because clearly there's a lot of issues here for you, or there's a lot of issues one has to deal with if you want to go into the empirics here. So for instance, how do you identify structural shocks to windfall gain? So I said loosely that windfall gain could be because you find new fields. So let's say you discover a new oil and gas field. But it could also be that you produce whatever you're producing more productive. So you are extracting more oil and gas than you used to because of new horizontal drilling and other techniques. Or it could be because the real commodity price, like the real oil price or gas price, is increasing, so you get more out of the field you're already producing. So how identify that structurally, and how measure that over time for currencies and the macroeconomy. Another issue is that these theoretical models typically don't specify whether it is due to either of these factors, but they typically analyze the effect on the exchange rate, or theoretical study typically they don't really differentiate, but most empirical studies who look at this have typically analyzed the commodity prices, so like higher oil prices, etc., and found that, i.e., it goes in the way, one of the different ways. But there's more problems to this, and coming from or not having studied resource-rich or the rich resource-rich countries, it's not so that the Dutch disease fits very well anecdotically either, because most of, as I said, that the Dutch disease theory typically predict as the commodities the currency are appreciating, there will be this deindustrialization and you will have lower growth. But countries like Norway and Canada or Australia and others generally has higher growth rates than most OECD countries. And in fact, over the decades. So these countries have seen both an appreciating currency and higher growth rates. So Dutch disease definitely doesn't fit there at all. But there is a potential story there, which I, together with some other authors, have shown in previous paper, namely that these theoretical models, these Dutch disease models, they don't take into account that there are any spillovers or learning by doing in the discovery or extraction of the resource. So it's like, the analogy could be like there's an American company coming to a small energy producing country. It comes with its own resources. It drills a straw or a pipeline into the well, whether it's offshore or onshore. It extracts the fund. Most of it goes to its own company, but the profit goes to the government, who spends the money crazy. And that will typically give the kind of effect you have. But if it is the resources within the country which are extracting and developing the skill, if it is new sectors being developed, then you will have a whole different kind of learning and spillovers. And that's what we show in this paper, previous paper, in the theoretical paper, that when that happens, you will have positive spillovers to other industry, productivity spillovers, and you won't have these negative effects. And the effect of the exchange rate might or might not be as severe. So in that case, you will have having natural resources could actually be positive in that sense for economic growth. So now most of these theories are with regard to the discovery, and now we are with now we are in, or we have been for some time at the turning point, as we have been discussing here today. Because now we are at the shift, at the transition, we are having transition risk, and we are at a point where we are pushing towards green energy, so we are shifting towards renewable. But in any case, petroleum reserves will eventually run out, so eventually these countries which are resource producing, they will eventually face a transition away from this very productive production and into production which are less profitable. And the question is then, how can you analyze this risk or this transition for these countries? Because no other theory really discusses that. It discusses the discovery of oil and what it will do with the country, but it doesn't discuss how we will transition out of that. And that's really what we are interested in. So what we do here is that we want to explore the long-term macro developments in resource-rich countries to analyze the effect on the macro and also on the real exchange rate. So we are interested in the long run, the macro development, and not the identification of specific shocks in specific points in time. So to do that, we are going to estimate, we are using time series, but we are going to estimate a model using slow-moving patterns in oil and macro variables, taking into account international productivity gains and domestic resource extraction. And to do that, we are going to use Bayesian methods to be able to identify these trends and the spillovers between the industries. The framework is a VAR model with common trends, a la Del Negro, Giannone, and Tabalotti, so already here a lot of Italians, but also my co-author, Niccolo Maffei-Facchioli, which is in his job market paper. So we are going to identify structural drivers, and we're going to have 4 structural drivers. We're going to have an oil price trend. We're going to have an oil share or oil production or oil productivity trend. We're going to have productivity, and the productivity is going to be split in 2, one which is related to differential specific to the country, and one which is going to be common across countries. In addition, we're going to allow for cyclical factors such as interest differential and also unemployment rate, etc. And this is still ongoing progress, so we are adding and extracting a little bit the variables at a time. And then we're going to quantify the relative importance of these structural trends for the macroeconomy, currently in Canada and Norway, but we're also allowing for other countries as we go along. And our focus is, as I said, on the long run, as this is really where we think we can, this framework is going to be useful, and this is really what we can say something about. So what do we find? So we find that these oil trends explain a sizable share of the what we call the non-oil trend productivity, and in particular in Norway. That means that there has been a lot of spillovers, both in the short and the long run, for explaining why it's been we had this higher growth than OECD countries, and why there has been a lot of growth and job creations in a country like Norway. So there has been, let me say, positive spillover from the oil to the non-oil macroeconomy. And by the way, when I say oil, I mean oil and gas. We are looking at petroleum together. We have seen a long period of windfall gains, and we have also seen an appreciating currency, both Canada and Norway, and these are due to both the Ballasses-Samuelson, i.e. productivity differential, but also this typical Dutch disease effect, namely the windfall gains and the effect that has on the currency. So oil has mattered for the strong currency in the past, but also other factors. But now we see clearly that the tides have turned and the effects are going the other way around. So we can explain the slowdown, we can explain the depreciation in the currency by a slowdown in the oil trend, together with an unfavorable relative productivity trend in these countries, and in particular in Norway. And we are also now working on projections going forward, which tells at least that looking at the data for how it is, this trend is going to continue. So it's going to be cheaper to travel to Norway and more expensive to travel abroad for Norwegian. But the effects are not so typical in Canada. And to the best of our knowledge, this is the first paper that modeled long-term trends in this way, in particular between commodity prices and macro variables and exchange rate, but it could be any kind of macro applications. It doesn't have to be oil and gas, as I said. The idea is that we model the interaction between different trends in an economy and how that can affect variables like the exchange rate. All right, so the kind of papers we are contributing to are, so there's a long theory of Dutch disease, learning by doing. So there's the original paper I said, and Rick has paper, and there's a lot of papers in the ... for 20 or so years. But we are relating to recent papers in particular, which specifically identify this learning by doing effect by looking at the spillovers between the industries. So not just looking at closed economy where there are resource drainage out of the other industry to be able to extract oil and gas. But there's also a long literature about oil shocks and business cycles, and related also to the exchange rate, separating between exporters and importers, which do find that there are different effects for exporters and importers. But as I said initially, these are not able to identify sort of like the macro implication of having oil or having a windfall, because they typically focus on the oil price shocks. Then there's literature on commodity currencies, which we also relate to. I already mentioned that there were a few papers trying to look at fundamentals, and Chen and Rogoff did so for commodity-rich currencies. They didn't find much of a relationship between commodities and exchange rate. But in a recent paper by Harding, Stefanski, and Tovs, they do find these kind of effects by identifying, so these kind of effect meaning the effect of commodity prices and discoveries and exchange rate by looking at when different fields are discovered. So, but that is focusing on specific episodes. And then, as I said, there is a framework looking at trend cycle VARs quite recently, which we are then building on with the methodology. I got a little bit lost about time because we changed. How much time do I have?
There are 20 minutes.
20 minutes.
The last questions, yes.
Without questions?
The last question.
Plus questions. Yeah, 5 minutes. Okay. All right. So let me go through the econometric models. But since this is not like, so I don't want to go into detail here, but let me at least show you the main model, and so that you understand how we are extracting the different structural shocks. So we are having here a reduced form VAR with common trends, where Y is a vector of variables. Tau is the low frequency movement, is measuring the low frequency trends, and Y tilde is the business cycle. So we are assuming that the trends can load on the variables with lambda, but there's also effect on the cyclical components. So it's a trend cycle model in a sense, a multivariate model. And the trend is modeled as an AR1 here, and the cycle has several lags. And we are going to assume, so this is the reduced form, but we are going to assume, the model is identified so that the shocks to the trend and the shocks to the cycle will be uncorrelated. We are going to have, in this version you're seeing here, we're having 8 variables, and they are from left to right. So it's the price of oil, it's the quantity of oil and gas produced relative to domestic production. It's the productivity differential between foreign and home. It's productivity at home, and it's investment in oil and gas relative to domestic activity. And it's wages, real exchange rate, interest differential, and unemployment rate. And we have quantities in real terms using annual data, and the sample varies a bit, but for both it's around from 1970 to 2023. And we are going to have 4 reduced form trends. And let me explain those, and I do it best looking at this matrix notation. So the loadings here will then define the co-integration relationship, so the long-run relationship between the variables and the model. So we are going to have these 8 variables on the left-hand side there, of which the 2 latter are stationary, but the 6 on top are non-stationary. And the 4 trends to the right here, lambda 1, tau 1, 2, 3, 4, are going to be oil price trend, oil activity trend, productivity differential trend, and the global productivity trend. Think of that as a common productivity across countries. And these are going to be identified through the ones here, so that the first trend is going to be identified through the price of oil equation. The second trend is going to be identified through both the quantity of oil produced and the investment in oil produced. The third, that's, I don't know whether this works. So this here, the ones here, so this relates to these 2. The third relates to the productivity differential, so the set F minus set H. And the fourth here refers to the productivity generated at home, which is common across all countries. So it's like a common productivity across the small open economy and the rest of the world. And then we're going to have loadings from these trends to the other variables. And again, I have to turn here. So if you look at the oil price trend, it's going to load on oil, allows it to load on oil investment, wages, and the real exchange rate. So in the long run, that can matter. For the second, the oil activity trend, which is really like the discovery of new fields or new investment or being more productive, is going to load on productivity, because there can be spillover, which is part of the important part which we are building on the theories with learning by doing. But it's also going to, of course, load on wages and the real exchange rate. Similar with the productivity differentials, wages and the real exchange rate, and the final global productivity trend is can also load on wages. So this relates to very closely to the first relates very closely to the Dutch disease, and the 2 last relates very closely to the Valassa-Samuelson. So we are going to estimate this with Bayesian method. So we are going to impose priors, and we're going to have priors which have quite wide bands, so that data are going to be allowed to speak. But for instance, if we look at the oil price trend, we're going to center the lambda 1 and lambda 2 around 0. And that means that we generally don't think that the oil price matter much for oil investment and wages, because every year we don't think that there's a strong link there, but if data tells us so, that will be identified. But we're going to identify lambda 3 with a -1, so that higher oil price means appreciated currency. Similar with the second trend, the oil productivity or oil activity trend, is going to be identified here with a lambda 7 or -1. So a new field or more investment in the North Sea or in Canadian oil and gas is going to mean an appreciated currency. So higher oil price, more productive fields or more new fields, appreciated currency. But also for the productivity differential, looking at 9, we're going to think that if Norway or Canada becomes more productive relative to the world, then, which, because the way it's identified, means that this has to be a 1, means that the currency will appreciate. So there's going to be potentially 3 sources of this appreciation: the oil price, the oil trend, and the productivity differential. All right, let me skip this. So we estimated with Gaussian state space models, or at least be very brief. We're going to have initial condition for the trend and cycle, which are going to be where we're going to use pre-sample averages. And then we're having a bunch of additional priors, or at least some. But we're going to be, the results are not very dependent on that, but we are going to be, and we're going to be very flexible towards the trends and the variables, but we're going to be very restrictive with regard to low frequency components, meaning that the trends will have a trending factor. Okay, final thing before showing you the results. So if you saw the matrix notations and you saw the reduced form trend, they were almost zero of the diagonal, meaning that the trends were almost uncorrelated. But we cannot exclude that they can be correlated, and it's not our purpose to have them. They don't have to be, the reduced form trend don't have to be they don't have to be uncorrelated, but for the structural trends and the historical decomposition, we need them to be uncorrelated. So what we are doing as a second step, we are estimating the trend component of a vector by using, assuming there's a linear relationship between the structural shocks and reduced form shocks, and then we are going to, so that we can write this in a structural way, where our new epsilon will be the structural shocks, and then we're going to assume that in the long run, these shocks will be, or these trends will be orthogonal by assuming a long run relationship between the four trends. And here we are trying out different ways of identifying this as well, and it doesn't matter at all, this kind of assumption, because they are pretty much uncorrelated. But generally you can think that we allow the oil price and the oil trend to affect productivity in the country in the long run, but not the other way around. Meaning that there are potential spillovers from the oil, but the productivity in the oil has to be generally an oil productivity trend. So it's not just because foreign productivity has become more productive. So that is the assumption.
10 minutes plus 5.
Yes, 10 plus 5. Thanks. All right. So let's just look at some of the results. And I think there's a lot of priors and posteriors, and there's two countries. So let me just focus again on the exchange rate. So there are, the red here is the priors, and the blue is the posteriors. So if you see here for the lambda 3, which was the effect on the oil price on the exchange rate, we see that data is pretty much centered around the prior, but with a much wider margin. So, and this is the only prior which actually matters. For the others, it doesn't really matter. Data speak loudly. And what I'm telling you here is that it matters whether we think that the trend in the oil price is permanent or whether we think that everything happening to the oil price will die out. So we are building alternative models also where we look at the effect of whether the oil price should be stationary. But main conclusion doesn't depend on that. But here the prior matter is what I'm telling you. The two other effects on the exchange rate is lambda 7, which was the effect on the oil production or oil activity on the real exchange rate, which was centered on -1. Here data wants to push it a bit further below. So yes, the oil trend appreciates the NOK and the Canadian currency, but not by so much as in the prior. But the productivity differentials goes the other, here the data pushes it even further away, so it means that productivity differential has a large effect on the exchange rate. So that's really an important factor. And here again, it doesn't really matter what we put in the prior. All right, let's look at the historical decomposition with the structural shocks. So having identified the four trends, what we can do then is to look at how they have contributed over time. So looking at the oil trends for Norway first and then for Canada, we see here on the left the oil price trend. So this is the permanent component of the oil price. And here is the oil share trend. So what you see on the right is clearly that Norway has gone from being an active producer and an investor to having a declining trend. And here this is based on the long-run components in oil production and oil investment in real terms. So oil share seems to be primarily driven by what's happening in oil productivity trend and oil investment trend in the long run. And we clearly see that it has peaked, which is why we have gone maybe if it has appreciated the currency from appreciating to depreciating. For Canada, the picture is also clear, but there's another thing which is a little bit interesting, and that is that the oil price the light gray, also has an effect on the oil share trend in Canada, meaning that oil price has, the trend in the oil price has had an active role in the extraction and development of the oil and gas sector. But we see that they have also peaked, but they are not on the kind of, it has been more stable since the 80s than typically what you see in Norway. And the left is the oil price trend. It looks a bit different from the Norwegian because it has a big peak at the start, but that's because we have a longer sample. And this is also the real oil price. Okay, so to the more interesting part, how does that, how has the trend affected non-oil GDP productivity? So what we measure here is productivity in GDP without the oils, everything related to oil as far as possible. For Norway, it's quite easy because national account produces something called mainland GDP, but for Canada, we had to extract oil and gas out of the national account. But what you see on the left and for Norway and the right for Canada is that, if you can't see the label very well, the dark, what's that in English? Purple. Is the productivity share trend, and the dark gray is the oil productivity trend. And those are the two who mainly matters here. But what you see is that clearly it matters more for Norway than it does for Canada. So there has been some spillovers in both countries, but in particular for Norway it matters quite a lot and has done so for some time, but it has peaked around 2000-2005 and has declined since then. The most important factor still is, however, productivity differential in both countries. So that's clearly, the productivity trend in both, the common productivity trend in both countries. That's clearly what has been driving the productivity in the non-oil sector. But interesting is also that you see for Norway, the trend in the productivity has peaked and is flattening out relative to what it has done prior to 2010. Which could be related very much to the decline in the productivity in the oil sector. Whereas for Canada, we see more steady increase and not so dependence. The dependence on oil seems to be less. And finally, we see that for the effect on the mainland productivity, there's no effect on the oil price, or at least very marginal. So it's not like the higher real oil price has made these countries more productive. It has to do with extraction and the development of the oil and gas sector. Clearly, models who want to study the effect of oil and gas or Dutch disease on resource-richer countries and try to just estimate models with the commodity price will fail substantially because there's no effect in the long run from the oil price in these countries. So what matters is how productive the oil and gas sector is. And clearly what's also matters now is that these sectors and the productivity in that sector has gone down. And for that reason, we also see less productivity in these countries. Looking at the productivity differential, Norway left and Canada right. Here we see, here I have to explain things. So because this is foreign relative to domestic, so if productivity in the domestic country is doing, so down means that productivity increases in these countries. So here we see that productivity, this is the productivity differential in Norway and in Canada. And we see that most of the increase in the productivity, most of the contribution to the productivity differential, which has benefited the Norwegian economy in this period, is due to the oil and gas extraction for the long run effects. For Canada, similarly, but here also oil price a little bit, which might be related to the effect we saw also on the oil and gas extraction. Productivity differential in Norway has generally been negative, meaning that it's not worked to increase productivity in Norway, meaning that if Norway now is transitioned out on oil and gas, it needs some other industries, some other technology, some other factors to be able to generate the kind of high productivity and growth it has had in the past. because this contributes negatively. So this means that Norway has not, at least when it goes up, it means that Norway has become less productive. Here it has been a little bit more productive. For Canada, it's mostly flat in this period, meaning that there's no specific effect, but relative to, but in the past it has become less productive and then more flat since then. So not this very steep decline as in Norway, more a pattern which is varying over the decades at least.
Can you say again, sorry, what's the productivity differential exactly?
So it's productivity, sorry, thanks, I should have said that. It's productivity in these each of these countries relative to the G7.
Okay, thanks.
Sorry, yeah. Then we're getting to the final part here. So looking at the real exchange rate and the structural shock. So here for Norway, we are identifying the trend in the real exchange rate is identified very closely with the data. So we see here this depreciation I talked about initially, which is substantial for the real exchange rate. And we see that that's primarily driven by, or the history is the following. So before, oil has been contributing to appreciate the currency. Oil activity, the dark gray, and oil price in particular. So here oil price matter. It didn't matter for productivity in the economy, but it matters for the real exchange rate. So higher oil price appreciate the currency and also higher activity in the oil sector. But this tide has turned since 2010 and it's worked to depreciate the currency. But the main factor behind the depreciation of the currency is the weakening of the productivity in the Norwegian economy. So that's one of the reasons for the weaker exchange rate. So we haven't been able to replace the oil and gas with something as productive. That's how we can see it, and that has affected the currency negatively. For Canada, the real exchange rate for Canada, we see that both oil price and oil activity affects the Canadian currency, as for Norway, they work to appreciate the currency, but has now contributed less and less, and hereby to the depreciation. But most importantly is this weakening of the productivity differential also in Canada. All right, so let me just conclude. We are working now also on forecast scenarios, but I didn't have it ready for this talk, so let me just conclude with what we have. So energy clearly explains a sizable share of domestic productivity in these countries. And for the exchange rate, also the case, but there's evidence both of the Balassa-Samuelson effect, namely that these countries in period have become richer and therefore have had a currency which has appreciated. But now the tide has turned, so the slowdown in the oil trend together with an unfavorable relative productivity trend has weakened the currency exchange rate and in particular in the Norwegian economy. For Canada, the productivity differential explains most of the recent depreciation, while oil price trend still works to appreciate the currency, so that there is not a clear hypothesis there going forward. Okay, so I think I'll leave it at that. There's some robustness, but I think to go.
So we have a few minutes for some questions.
There we go. Thank you very much. So I just wondered, these quaternary stories, they rely on, you get this appreciation of the real exchange rate only because the country is not smoothing. So because they invest the whole windfall today, and they don't smooth it over the future. No. But a country like Norway has got a huge reputation for actually smoothing, because they invest everything abroad, in the sovereign wealth fund, it's the largest in the world. So you wouldn't expect these appreciations. So could you comment on that? And Canada doesn't do that, so maybe you would expect a bigger effect on the appreciation of the exchange rate for Canada than for Norway. Then later on, the story of the depreciation I find interesting, but you relate it to weaker productivity you related to those things, but you began with the green transition. So can you say something how that comes in?
The depreciation.
Yeah,
Oh.
but you said originally one of the things was, it may have to do with the green transition.
Yeah.
And then you never came back to it, so I
No.
wonder.
Okay, so I didn't want to give you too much anecdotic about the Norwegian debate, but there's a lot of questioning and speculation in why the currency is so weak. From the central bank having too low interest rate to less oil and gas, etc. So, and of course Norway has a great reputation with the oil fund, investing most of it abroad, but it still has a substantial amount is investing in the Norwegian economy through the increase in the public sector, etc. So I think it's, and the depreciation has been massive. So I think it's, in looking for these factors, I think it's important to understand that despite the fact that Norway has a good reputation and has invested well, so compared to a lot of other oil-producing countries, we are doing well, if I can use the we word. But compared to other OECD countries, we don't have a great productivity story, and we have a huge public sector, and we have a lot of spending on public services relative to favorable tax increases towards the industry, etc. So I think that's behind some of these numbers we are seeing, and the fact that you don't have exactly, your hypothesis doesn't fit exactly with what we have there. For Canada, we didn't see, as you saw, there was other things going on going forward. With regard to the green transition, I think that's basically, we don't measure that directly, so I can't answer that directly. But I think that in the what will replace oil and gas now comes the energy transition. That's so, as long as we don't find or don't have a lot of investment in new industries or in more renewable, etc., we won't have the same productivity spillovers to other industries. So I think that's the main takeaway from the fact that there is a green transition in all countries, and Norway will phase out oil. But in so doing, it cannot rely on the oil fund and the public spending. It needs to generate investment and more productivity in other industries as well, to a large extent. And in particular, during the COVID, Norway was lagging a lot behind the other Nordic countries, with a lot of subsidies to industries, which is not as profitable.
If we have time, just to clarify, I'm not sure, I want to check whether I understood. So the argument is that the Dutch disease model, the idea that it brings to the industrialization needs to be rethought, because there could be complementarity and proximity in technology, such that an oil price discovery or price spillovers, say, engineering, like in Norway, right? So it becomes the world capital of engineering services for oil. But then the argument is not symmetric. So when there is actually, when there is a down in the price, productivity and oil are decoupled independently of spillovers or proximity. Is that the argument?
So what we see is that productivity is flattening out. It's not becoming negative. So we see that the effect of engineering and so like the horizontal drilling, which is in the US, which came actually from the North Sea, that was a huge productivity boost to the economy. But now we saw that it was flattening out. So what we see is that we don't see that things are going into the negative, but we don't have the extra stimulus in a way. That's what we are.
Because in a way, it looks like the Dutch disease works even stronger down than up. But it's interesting. I mean, in principle, the model is symmetric. But
I think you need to rewrite that story, the Dutch disease story, a bit, because it seems that we have, despite appreciation, managed quite well. And we have saved a lot of money for the future. But now, when there's no much interest in oil and gas anymore, then there's not the kind of money coming to investment in Norway. And that has been seen clearly in the exchange rate.
So, two quick questions. We have time? Very quick questions. So, first one, you're talking about these productivity spillovers to other sectors for these advanced oil exporting countries. Do you have a sense maybe for emerging countries, this channel is not at play. I remember there's a paper by Pescatori and co-authors at IMF. They find macroeconomic effects of closure of big fields or something like this more negative, at least that's the message of the paper. And second one, more technical, would it make sense to have a kind of residual trend in the model? In the sense, obviously, now you have these four stochastic sources that drive everything, and sometimes it seems that the model has to compensate the shocks, basically. So the real exchange rate, there were these movements that were totally opposite. I don't know whether it would make sense to have more, to be more robust to misspecification.
Okay. So with regard to the first, the Pescatori and the other papers, so that's a very relevant paper because they are looking at episodes where there has been decline in the past. I mean, our conclusion is very much similar to what they have, using a very different framework. They have like local projections kind of analysis. But they are not able to separate between the oil activity and the oil price. They look at the oil price, I think, only, or certain episodes. They cannot do the same in one model because they have like one shock at a time at least for the local projection. So, but the main conclusion there is pretty much the same with regard to the exchange rate. That's what they're looking at. Residual, also great point. So we are looking at, so now in a way you can think of the business cycle shocks like the interest differential and the unemployment rate as the residuals in a way. We could have like, or not residual, but the shock to which are stationary. They are not able to explain the trends. But we could have maybe some measurement error if you're thinking of that, because we are not, and that's actually a good point, because, and in other type of models, state-space models, you do that because we don't measure the oil activity exactly. So in theory, in the Dutch disease, it is something, an energy boom, but we are measuring it using investment and oil activity.
So very last question from Chelsea, right? Did you raise your hand? Yes, I did. Okay.
Oh, it's on. I mean, Giancarlo already replied. The underlying assumption is that the trends are linear. Is that correct in your model?
Yes, they are linear.
I think that's quite a strong assumption.
So they have the same, yeah.
Okay, we can move to the last paper of the day from Olimpia Caradori that will speak about the effects of carbon pricing policy on supply chains.
Thank you very much for the opportunity. Last paper presentation of the day. Hold on with me, please. So I will present rewiring supply chains through carbon pricing policy. This is a joint work with Emanuela, who is also SFI with me, Miguel, who is at Nova, and Emilia, who is at Norges Bank and University of Zurich. So to motivate this paper, first of all, is the acknowledgement that governments have been adopting several environmental policies in the last decades to curb emissions. And on the one hand, we observe that these policies are highly heterogeneous across different countries. They are bounded within jurisdictions. On the other hand, however, we see that firms and even more supply chains operate on a global scale. So this contrast between environmental policies being restricted to certain jurisdictions and economic activity operating at a global level could result in the problem of carbon leakage. This has been introduced in previous presentations today. Essentially, it's a form of environmental regulatory arbitrage as economic activity is pushed away from regimes with environmental policies in place to avoid a form of climate transition risk.
This could particularly affect supply chains as they might want to move away from those suppliers that could pose supply chain risk as a form of climate transition risk. For example, we know from the literature, Greenstone in JPE, Ryan in Econometrica, they show that environmental policies do increase the marginal costs for suppliers in carbon pricing regimes. They erode their profitability, and this might pose their foreign competitors at an advantage, giving an incentive to their customers, to their business customers, to shift away their supply chain from suppliers subject to environmental policies to suppliers that operate without any kind of environmental restriction. On the other hand of this tension, we have, however, evidence that supply chains are highly sticky. Just an example from this literature is Barrault and Sauvagnat in JPE, showing that cutting ties with suppliers could be highly costly. So to resolve this tension, we want to ask, are suppliers subject to carbon pricing policies more likely to experience the termination of their customer relationships as they compete with firms that operate in regions that do not have environmental policies in place? So if we look at a bit of anecdotal evidence, it's quite unsurprising that, firms are claiming that environmental policies are placing them at a disadvantage relative to their competitors, and they're pointing at the fear that supply chains might shift away from them. And here I'm just giving some anecdotal evidence from the SEC filings, in particular the 10K reports, item 1A, which is the item of the risk factors, from a couple of firms that are subject to environmental policies. The first example is coming from United States Steel. It mentions other nations, particularly China, have substantially lesser requirements that may give competitors an advantage, while environmental policies could entail substantial costs for allowances and a restriction of production. Similarly, we have some evidence from commercial metals. Any adopted future climate change could negatively impact their ability to compete with companies that operate in areas that do not have such limitations in place. And this is just a couple excerpts while we have a very long list of companies that are subject to environmental policies and claim that these policies reduce their competitiveness, might affect their supply. So what we do in this study, this is an empirical study that we conduct. We focus on one specific environmental policy. We look at the California cap-and-trade policy as our main source of climate transition risk shock. And we look at suppliers that produce their emissions in California. In this case, this would be the supplier that is located in the blue region. And we choose California cap-and-trade for this study because empirically it gives us the ideal setting of within-country environmental policy heterogeneity. Indeed, in the period that we look at, California is the only state in the US that has environmental policies in place to regulate the emissions of industrial firms. So what we do essentially is to compare suppliers that are subject to the policy. Again, the supplier in the blue area, for example. This would be our treated supplier. We match them to their competitors that operate outside these jurisdictions. This would be the other supplier that is located in the white area. And we look at what their customers, their business customers do. And this is a very simple empirical setting. We use a very basic diff-in-diff design, and we ask, does the policy introduction lead customers to end a relationship with treated suppliers? So what do we find? We find that treated suppliers are up to 25% more likely to lose their customers, and at the same time, 29% less likely, up to 29% less likely, to gain new customers after the introduction of the California cap-and-trade. So after establishing this baseline result, we proceed to understand the economic mechanism that underlies this effect. So why does this happen? So on the one hand, we focus on financial mechanisms. In particular, we focus on suppliers' competitiveness. I will show you that the effect is particularly strong when we look at suppliers that operate in less concentrated sectors using different proxies, as well as when we look at suppliers that produce, for example, standardized inputs that they have lower R&D. On the other hand, we show that this is not only a cost story, a purely financial story, it's also a story about environmental awareness. We see that the effect is concentrated among those customers that have a lower environmental awareness. So these customers will be more likely to switch away from the California cap and trade. We conclude the study by understanding what are the environmental implications of these effects. This is what we're ultimately interested in. And we find some unintended environmental consequences that are very consistent with the form of carbon leakage at the supply chain level, meaning that the emissions that are produced along the supply chain of the customers that shift away from the California cap and trade tend to increase. So their Scope 3 emissions tend to increase after the introduction of this policy. So in terms of contribution to the literature, we contribute to two main streams of literature in finance. So the first stream of literature is this bunch of studies that look at how climate shocks affect supply chains and how do they propagate along supply chains. And to this point, the literature has focused purely on climate physical risks. So here we have an example from Barrault and Sauvagnin in QJE that study extreme weather events, or Pankratz and Schiller more recently in RFS that look at temperature levels above expectations and how these affect supply chain linkages. This paper contributes to the literature by focusing on climate transition rather than physical risks affecting supply chains and affecting supply chain risks. Secondly, we contribute to another body of literature that looks at finance and carbon leakage. So in this literature, we're closest to the paper from Bartram, Hu, and Kim that was published in 2022 in JFE that studies, again, the California cap and trade, but a form of within-firm carbon leakage. What they do is to look at a within-firm level, how different plants redistribute their economic activity and emissions following the introduction of this policy. And similarly, another within-firm study has been conducted by Ben David, Young, Clymer, and Weiss in economic policy. Other studies have focused on bank lending, for example, in the RFS. But what we do with this paper is to look at carbon leakage from a supply chain perspective. And this is particularly important to uncover because it can affect production networks on the one hand, but also the way we regulate emissions along the supply chain, the so-called Scope 3 emissions on the other hand. So a little bit of an institutional setting on the California cap and trade so that we are all a bit on the same level. I will be brief. I know the crowd is quite aware of these environmental policies. But just to introduce the key points that will be relevant for this study. So the California cap and trade imposes a cap on the total emissions that firms can produce in their California plants. And then the trade part comes in, meaning that firms need to purchase some allowances, some permits, in order to emit more than the cap. And in brackets you see undisclosed because the California cap and trade does not disclose how many allowances firms own. The price of these permits, of these allowances, is then defined by a market. The policy was introduced in 2013. This is the so-called phase 1 of the cap and trade in California. And this was initially regulating electricity production and import, but most importantly for our study, this will also affect immediately industrial firms that have plants in California producing at least 25,000 tons of CO2 equivalents in the state. And then in the phase 2, this was extended in 2015 to distributors of petroleum and natural gas. This does not directly affect our study as we focus on industrial firms, but this will definitely increase costs for these firms, given that this will affect the cost of transportation. Overall, the policy covers approximately 75% of the total emissions that are produced in California. So a little bit of an introduction on the data that we use in this study. What we need to do first is to understand which firms are actually subject to this policy. How do we do that? We use this plant level emission data from EPA, and this comes from this greenhouse gas reporting program. And an example of what this data looks like is the map that you can see on the right-hand side of this slide. And in this map, we see just an example of one plant that we have in our sample. This is a United States Steel POSCO Industries plant. So it's producing steel in California, located close to San Francisco. And we start there. And then we map from the plant level to the firm that owns this plant. And in this case, this would be United States Steel. And then we look for these firms that own plants in California that are subject to this policy in a database that gives us, on the one hand, supplier-customer relationships, and on the other hand, competitor-group relationships. And this is FactSet Revere, which we investigate from 2010 to 2017. And this allows us to obtain a supplier-customer per-year panel data set. And for the example of United States Steel, FactSet tells us that United States Steel is a competitor of, for example, Steel Dynamics, Nucor, AK Steel, and all of these suppliers supply to the same customer, which is, in this case, an example, Worthington Industries. Among all of these suppliers, however, only United States Steel is subject to the policy, the only treated supplier among this group. And then on this panel data, we just feed in more information from the perspective of financials. So we add CompuStat North America and Global to add more information to the sample. In terms of methodology, as mentioned, this is a very simple diff-in-diff approach. So for treatment, we look at this data and we find all these suppliers that have plants in California that emit more than 25,000 tons of CO2 equivalents at the onset of the EPA program. And then for control, we look at suppliers that are not subject to this policy, but we also match them to the suppliers that are treated. And we use an exact match on sector and country, so only within US. And then we use propensity score for size and profitability, and then a whole range of robustness on a bunch of different matching approaches. What is important for us, as you will see in the baseline specification, is that treated and controlled suppliers have the same customer, have a customer in common, as you can see in this very simplified illustration. Our main event of interest in this diff-in-diff approach will be the introduction of the California cap-and-trade policy in 2013. And then just to formalize this very simple relationship, we will use this supplier-customer year panel data set to study this regression specification. Our main left-hand side variable for most of the analysis will be this ending variable. This is just a dummy that is equal to 1 when the relationship between a given supplier and a customer terminates, and it's 0 as long as this relationship is observed in FactSet and continues. And it's a common approach in the supply chain finance literature. And then on the right-hand side of this specification, you will see the common treatment times event dummy. And our coefficient of interest in red is just the estimate of beta on this interaction. And then for fixed effects, we use a bunch of different approaches in order to saturate this specification as much as possible and to isolate and identify the effect and avoid any sort of endogeneity. So in the baseline results, you will see a supplier and customer by year fixed effect. What this means is that we will compare each treated supplier to a controlled supplier, the two having a customer in common. Essentially, this means that we're going to isolate the supply side and we're going to keep fixed any effect coming from the demand side. Additional results in the baseline will be relying on a supplier times competitor group and customer by year times competitor group fixed effects. And here what we will do is to compare a treated supplier to a controlled supplier that is in the same competitors group as the former one, and both of them are have a customer in common. So it achieves the same objective as fixing the demand side as before, but it additionally also isolates the effect within a group of competitors. So very comparable firms. So heading on to the results. For the baseline results, we find that there is a rewiring effect. So treated suppliers are indeed more likely to lose their customers. And what you see in the first specification is our baseline with supplier and customer year fixed effect. In the second column, we have the same specification, but we exclude all of those customers that are themselves subject to the policy. So we want to avoid that any effect could come from the customer side. And then in the last specification, we restrict our analysis to the group of competitors. And what we find is that the effect is there, and it's also economically sizable. So treated suppliers are between 2.5 to 5.3 percentage point more likely to lose their customers, where the unconditional probability of losing customers or ending a relationship in our sample is 21%. So we do find that indeed customers shift away their supply chain from regimes, jurisdictions with environmental policies in place to jurisdictions that do not have these policies in place after the introduction of the policy. And then if we want to look at it from a dynamic perspective, we see that first of all, we have no pre-trends. And second, we see that the effect is there and sizable after the first year from the introduction of the policy, and then after the amendment and extension of this policy. The reason why you see that the effect does not continue to be there is because we're not showing here cumulative effects, but once the relationship between a customer and a supplier terminates, the pair drops out of our sample. So what we show until now is that there is a rewiring, or our interpretation of these effects is that there is a rewiring of supply chains shifting away from the California cap and trade. However, to this point, until these results, we could have other interpretations. For example, it could be possible that the suppliers are losing some customers, but potentially gaining some new ones. So our evidence might not be showing a rewiring away from the California cap and trade, but just a shift in the customer base of these suppliers. And we want to test for this. And in our robustness test, we also look at the beginning of new relationships. And we find that treated suppliers are also less likely to begin new relationships with new customers after the introduction of the policy, suggesting that this is not just a shift in customer base. And then we run a whole set of robustness tests that I have in the appendix in case you have some questions. For example, we look at different matching approaches, we look at different treatment definitions, different specifications such as logit approaches, and placebo tests of different sort. What I would like to move on to, however, is the economic mechanism that underlies this effect. And as mentioned in the preview of results, I will focus on two main economic mechanisms. On the one hand, I will show you some purely financial story. On the other hand, I would like to show that this is not just a financial story, the environmental aspect matters as well. So, first of all, what we show here is that by conducting some sample analysis, so some heterogeneity tests, we find that the probability of losing customers due to climate transition risk or the fear of climate transition risks affecting supply chains is higher when markets are less concentrated. So, for example, we find that the result is stronger when the Herfindahl-Hirschman index of the sector is relatively lower. And here we compute it at the SIC 3-digit level, but we also compute additional tests using the competitors group measure as a measure for a market. And the result still holds. We do the same using the Lerner index of the sector, and also there, when markets are less concentrated, so more competitive, it's also easier that the rewiring happens. And additionally, we will also find the same effect when we look at very large competitors group, essentially when customers can choose among a lot of different suppliers. Similarly, the story holds on when we focus on switching costs. So when suppliers produce standardized inputs, like in the second column, the effect is particularly strong, as well as when they have relatively lower R&D investments. So in this case, it's easier for customers because to switch away from suppliers subject to the policy because the switching costs will be lower. So the incentive to move away from these climate transition risks will be like a no-brainer for these customers. And the results are also similar when we look at different measures of relationship strength. So, for example, in pairs that exist since a shorter period of time, or when customers and suppliers are geographically farther away, the effect is stronger. In order to confirm this intuition of this financial mechanism, we also collapse our sample from a pair year panel dataset to a supplier year panel. And what we want to see is whether it's true that these suppliers subject to these policies are indeed facing some sort of financial constraint of different sorts. So we face very heterogeneous suppliers, a very large sample with different characteristics, and therefore we choose to use a very wide range of indicators. What I'm showing here is just an example. What we find is that suppliers, for example, after the introduction of the policy, do face a higher drop in their profitability, in this case measured as net income over assets, but we use other measures as well, and the results hold. They also face an increase in their costs over assets, and this is particularly true if they produce standardized inputs. So if they're particularly exposed to the risk, to the transition risk from a supply chain perspective that this policy introduces for them. And then in additional tests, we also find that these suppliers shrink in size after the introduction of the policy, therefore confirming the intuition behind this economic mechanism focusing on competition. As I was mentioning earlier, however, this is not only a financial story, meaning that we also find that the customers' environmental awareness does play a role. So, on the one hand, customers might want to shift away from the California cap and trade due to these increased costs and increased risks that they might face at the supply chain level, as mentioned until now. However, there could be another narrative as well, because if suppliers are subject to the California cap and trade, then eventually their transition performance will improve, their emissions will reduce, they will become greener, meaning that the supply chain of these customers that have such suppliers will actually become greener itself. And therefore, we thought that customers' environmental awareness might play a role. And indeed, we do find that customers, that the effect is concentrated among customers that have a relatively lower climate change awareness, while customers with higher climate change awareness tend to stick to their suppliers subject to the policy. And in order to proxy for climate change awareness, we're using a firm-level time-varying measure that has been developed in the literature by Sottner, Van Lent, Vilkov, and Zhang in the Journal of Finance in 2023. And then we use other proxies as well. For example, if the customer is headquartered in a state that is a Republican state, and if it's located in a state that is relatively more likely to adopt environmental policies in the future using climate alliance participation of these states. So in conclusion, I would like to show a little bit what could be the environmental implications of this shifting, of this rewiring that we find. And what we do here is, so consider that on the one hand we have data on supply chains, on the other hand we have data on the emissions of suppliers. So we can compute our own measures, different ranges of measures of supply chain emissions. So what we do is to use different approaches. For example, we just sum up all the emissions of all suppliers of a given customer, and this is time varying, and it will also change if the customer moves its supply chain away from the California cap and trade. And then a more reliable measure or more insightful potentially measure is the average supply chain emission intensity of all of these customers. This is the average emission intensity of suppliers of each customer over time, moving over time. And then we use also the more traditional measures that the literature uses from data providers. We use their estimates for Scope 3 emissions of our customers. And we collapse our sample at the customer year level. And we find that customers that are indirectly treated, meaning that they have at least one treated supplier, and as per our baseline results, this means that on average they shift away from the California cap and trade, they experience a worsening in the supply chain emission performance and Scope 3 emissions after the introduction of the policy, essentially after this rewiring. So, in conclusion, what are the environmental implications, the economic and environmental implications of environmental policy heterogeneity for supplier-customer relationships? Well, we do find that affected suppliers are more likely to lose pre-existing customers and less likely to gain new ones after the introduction of the California cap and trade. In terms of mechanism, I've introduced to you two key mechanisms. On the one hand, a so-called competitiveness channel. This is a purely financial channel of carbon leakage. On the other hand, a more of an environmental channel in terms of environmental awareness of customers. In terms of implications, we do find some unintended environmental effects of this policy in terms of supply chain level carbon leakage. And from the policy perspective, insights are that action on customer supply chain emissions, such as Scope 3 emissions, can help mitigate this type of carbon leakage. And obviously, homogeneous environmental action across jurisdiction is as crucial as environmental action itself, but I'm not the first one to claim this in today's conference. Thank you for your attention.
Okay, any questions?
Actually, it's not a question, it's a suggestion for the next paper. There is a paper that has been just accepted at RFS that shows, is a theory paper. The paper provides the evaluation of a firm and asset pricing, basically, conditional on the rewiring on the supply chain network. So maybe you can extend this going to the evaluation of the firm, what is the value of the firm. You have all the data, you can do that.
That would be great. Thank you so much. Maybe we can talk later, ask you which paper it is. Thanks. That's great.
I was going to ask a question, but you already answered. because you can think of this as trade diversion, but reputational effect or branding are very important. Is there a way to have a quantitative assessment of that? Because that could actually be part of soft regulatory measure, to make sure that you put in your product the carbon footprint, so the switching would create this offsetting. It would be interesting to see whether you can push it a little more on the environmental awareness. I understand that proxies are difficult and whatever, but it could be great.
Thank you. Thank you for the question. Yeah, it would be great. And I think that using this measure from Sotner and co-authors could actually allow for that if we extend the measure a little bit. The reason why we stopped there is that we received some comments, fair enough. This time frame that we're using, this is 2010-2017, and US. And considerations on reputation linked to supply chain, scope 3 emissions were probably not as established and strong at that point. But would be good to maybe establish an empirical result on that. Thank you.
So the first one is related to this, as you mentioned, the paper by Sotner, even just to know if you have any differences among the measures that Sotner provides, just in terms of also opportunities related to this, and probably you can also have a joint venture with Prometheia guys that have a great paper promising on the different measures on of firms' exposure to climate change. So the first one, if you have any evidence on this. The second question is, you show some, let's say, general overview on differences in terms of sectors competition. If you have any evidence of how across the different sectors these changes, for instance, just to tell that for some specific industries the effect is much larger or smaller compared, so just to have an idea of what are the sectors that are more exposed to this type of shock.
Thank you. So about the measure, we tried different measures, but the opportunity one itself is a bit sparse in our data, so we got a lot of zeros for a lot of firms, so that doesn't really help a lot. But it would be really cool to use the measure that I discovered today during the poster session. And in that case, also look at the interaction between physical and transition risk would be very interesting. So instead, about your second question, so apart from competition, maybe what could help understand a bit which sectors are more affected is this measure of standardized and specialized inputs that we use. This is a measure that was initially developed by Rauch in 1999 and then was further extended by Giannetti and co-authors later on. And in this measure, essentially standardized inputs are all those inputs that can be traded in centralized markets. So for these ones, this type of very easily substitutable inputs, then we do find the strongest effects. Metal is one example. Yeah.
Okay, thank you. Thank you so much.
So we now have the concluding remarks. We now have the concluding remarks from Banca d'Italia Deputy Governor. If you
Maybe we should say a few words that we are very...
So, okay, so thank you to Chiara Scotti for being here. She is the Deputy Governor of Banca d'Italia, and she was involved in let's say, with us with the organization of this meeting, and I give her the floor for the final remarks of this conference.
Well, thank you all. Clearly, the conference is coming to a close. I know I'm the last one, and I know it was a long day, so hopefully it won't be too long. First of all, let me thank you all for being here today and having contributed to this conference. This is an initiative co-organized by Banca d'Italia, the European University Institute, the Euro Area Business Cycle Network, and the Center for Economic Policy Research. I don't have to remind you that the value of this kind of events lies not only in the attempt to shed light on key economic and financial issues that are linked, in this specific case, to energy transition and the ongoing decarbonization, but is also in gathering together academics and researchers from central banks, policy institutions, and universities in an attempt to foster critical thinking and new collaborations. Needless to say, the analysis of this great pool of experts is really important for policymakers and decision makers in general who have to cope with the multiple challenges of the transition. Yet today I would like to take you along a slightly different road, in that you have focused on climate-related challenges today. And I would like to highlight yet another challenge that I think warrants further investigation. And this is what is called the twin transition, which lies in the intersection of the green and the digital transformations. We are living in a world where the digital transition and the green transitions are mostly taking place on parallel tracks, but as some commentators have highlighted, there are also some possible interactions. When people think about this transition, they tend to highlight the negative impact of the digital transition on climate, and specifically that the expansion of power-hungry digital technologies and services will increase their environmental footprint. And indeed, according to the International Energy Agency, data centers, cryptocurrencies, and artificial intelligence in 2022 have accounted for about 2% of global electricity use. The US Information Administration calculates that in 2022, cryptocurrencies alone may have drained more than 2% of the national annual power use. And the recent study shows that on average, generating an image through AI consumes as much as electricity as charging your phone. And this is on top of training the algorithms. This should serve as a warning, as you might know, the number of people worldwide using these tools, even for entertainment, is actually increasing at a very high rate. And in addition, there is the dreadful prospect that in a high-demand scenario, digitalization-related energy needs could even double by 2026. Clearly, all these developments call for further progress in increasing the share of low-carbon sources in the power mix and for measures to improve the energy efficiency of these digital services. Luckily, on the other side, we have to be a little bit optimistic, so now I'm looking a little bit at the other side. There are many good things that the digital transition can do for the green transformation. AI tools such as machine learning and deep learning can, for example, assist economists, investors, portfolio managers in improving the use of ESG data to build efficient portfolio, as well as help scientists in assessing the extent of biodiversity loss or water availability. And so in what follows today, I would like to mention some practical uses of digital innovation for the green transformation that should be taken into consideration and studied further, potentially also among economists like you. Although at the moment these potential positive uses are still overshadowed by the large amount of energy that is required by the digital technologies, this does not mean that researchers should not try to push the frontier in these areas. So I will start by discussing AI-generated energy demand and supply, as well as weather forecast, and how they can support climate mitigation and adaptation. And I will then turn to the use of digital solutions to reinforce the green transition. So let me start with whether AI or how AI can help with climate transition and adaptation. AI solutions can foster the reliability of energy system. They can deliver higher living standards. They can ensure safety for population and production. The power of AI possibility is something that we can experience directly. Nowadays, our smartphones and digital assistants provide us with a number of cheap and simple home automation solutions. By coupling the Internet of Things and AI techniques, we can monitor and optimize, for example, the heating and cooling of our homes. But outside of these day-to-day examples, there are many more ways that AI can be seen as a climate game changer, and our smart home solutions are just the tip of the iceberg. Gaining a greater understanding of both when power is available and when it is needed is crucial to ensure energy efficiency and reliability of the power grid, especially once the increasing share of intermittent renewable sources are integrated. The deployment of smart meters to collect information and of digital technologies such as machine learning techniques for data analysis can lead to better forecasts of energy demand and supply, can lead to improvements in energy efficiency. In addition, by supporting demand response, technology could minimize discrepancies between demand and supply, reducing peak loads and the need to add capacity to manage those peaks, and in turn, supporting the resilience and the security of the energy infrastructure. In addition to enhancing energy demand and supply forecast and management, AI technologies can help improve weather forecasts, as well as the early warning detection of acute climate events, which are essential tools for mitigating the impact of adverse events on population and assets. Progress in forecasting weather patterns and building climate scenarios could help vulnerable communities and authorities to adapt to climate change and could transform climate adaptation strategies in agriculture and in the insurance sector. Let me now turn to how digital solutions can help with climate disclosure and climate risk identification. This is another area in which digital innovation can help, in particular with climate transition, in particular with the assessment and selection of tools to channel funds toward green and sustainable finance, to make progress in sustainability disclosure, in the collection of climate-related information, but also in the evaluation and monitoring of climate-related financial risk, just to name a few important themes. So let me briefly discuss some of the efforts in this area and give you also some examples of how Banca d'Italia has been contributed to those. So first, the BIS Innovation Hub and Banca d'Italia launched the G20 Tech Sprint Initiative in 2021, a global technological competition in the form of a long hackathon designed to show the potential for new technologies, big data, and other innovations to leverage on the potential synergies between digitalization, finance, and the energy transition. Another initiative in which Banca d'Italia was involved is the 2021 first call for proposal by the Milano Hub, which is the Banca d'Italia Innovation Center. Some of the projects that were developed under this umbrella showed how technology, and particularly AI, can contribute to improving financial services in terms of ESG data collection and production. Second, supply chain partners, financial regulators, and financial entities increasingly require companies, including small and medium enterprises, to provide some kind of sustainability reporting. Digital platforms could reduce the disclosure burden. And within this context, the United Nations Development Programme, the Monetary Authority of Singapore, and the Global Legal Entity Identifier Foundation proposed a framework to address SME sustainability disclosure, harnessing technology and verified data to improve sustainability reporting while lowering costs and barriers to reporting. Third, AI, particularly large language models, can help analysts and supervisors in collecting climate-related information from corporates. The BIS Innovation Hub, Banco d'Espagna, Deutsche Bundesbank, and the European Central Bank launched a project that leverages LLMs to automatically extract climate-related indicators from publicly available corporate reports, thus enabling a widespread and cost-effective analysis of climate-related financial risk. Finally, digital platforms can support sustainable finance by integrating a vast array of regulatory and supervisory data together with market analytics in order to support central banks and financial supervisors to improve their monitoring of climate-related financial risks. In 2022, the BIS Innovation Hub and the Monetary Authority of Singapore launched a climate risk platform exactly for this purpose. The green energy and the digital transitions are happening whether we like it or not. We need research to try and understand how they can reinforce each other. One possible area of work is trying to further improve our understanding of which AI tools and other digital developments can be used to support the green transition and improve climate science. For example, AI techniques could be exploited to improve the preparation of climate scenarios, replicating the results of conventional models, but taking less computational time and consuming less energy. AI solutions could also be used by governments to leverage massive sources of freely available climate-related data and to generate tailored insight. In addition, some efforts should focus on assessing how some disruptive technologies can help to decarbonize hard-to-abate sectors. In imagining future decarbonization pathways, researchers should, of course, take into account the disruptive impact that digital technologies could have on energy demand, economic growth, and social development. Last but not least, another potential area of research is the crucial issue of how to design incentives that could help the two transitions co-evolve and reinforce each other. Historical evidence suggests that the twin transitions tend to be lopsided. While we will probably experience increasingly fast progress in the digital world, the transition away from fossil fuel will require extended period of development. In this context, how can we maximize the synergies between the two transitions in order to gradually win future economic growth away from fossil-based energy? We have to consider that green policies also encourage firms' digitalization. For example, environmental regulation as well as market-based measures promote resource efficiencies, and digital solutions are essential in achieving this objective. These are just a few examples, of course. What I would like you to take away is that it is really important that the community of academics, central bankers, and practitioners put some of these topics on the research agenda so that we can do our best to maximize the benefits in our quest for achieving twice the win in the twin transition. Thank you.
Do we have time for questions? Just we thank. Would you like to have a couple of questions, or why not? Anybody feels really? Just let me notice that both transitions are coming much faster than we thought. So this is an element that is also an issue for us, no? To keep up the pace of what's going on on both sides of the transitions. Anybody? I guess the end of the conference. So
no, but the conference, exactly, is just food for thoughts. So clearly everyone is thinking about the issues. So very happy.
So before thanking everybody, I should say that I know Chiara for a long time, and I admire the ability of managing a formidable career on both sides of the Atlantic, and both in policy and in academic work. I think as European, we are happy to have you back. And we should again, thank Chiara for the closing speech, and thank those who are organizers for some reason cannot be here, like Barbara Rossi, but she was very important for organizing this conference, and of course the support of Adrian and the other people in the staff that really made it possible. So I should say that we should just conclude with a round of applause and move towards the dinner. And thank you. Thank you to everybody for a successful conference, I think, no? We could say that.
Just because all the speakers are, of course, extremely grateful to the organizers and to the Deputy Governor for organizing a splendid day. I mean, with lots of food for thought. I thought the papers were excellent. Thank you very much, Giancarlo. Thank you very much, everybody from the Banco d'Italia. Thank you, Barbara, who's not here. And thank you, Deputy Governor. It's a free gift as far as we're concerned, so thank you very much.